Well, I think traders and investors don't want to take a risk over the long weekend, and that's why we're seeing a very range-bound trade when it comes to the Nifty 50, as well as the overall Bank Nifty as well. The Nifty 50 trading around 0.12% higher, the Bank Nifty trading around 0.3% higher. Let's try to pull up the Nifty 50 heat map and see how counters are doing in trade today. It's largely led by a lot of IT names. Wipro up 2.5%, Infosys up 1.8%. There's also Eternal that's doing well in trade today. HDFC Life, Eicher Motors are some of the counters that are in the green and doing well today. There is also Titan and Asian Paints, which are seeing gains of about 0.8 to 0.7 odd percent. But counters that are under pressure includes Tata Steel down 2.6 odd percent, Adani Ports down 1.6%, Hindalco also down by 1.1 odd percent, Tech Mahindra also seeing losses of around 1 odd percent, and BEL also seeing losses of about 1 odd percent. There's Hero Moto, JSW Steel, Ultratech also in that red space. Let's also try to pull up the advanced decline ratio and see how that's doing in trade today. There you go. There's around 1400 odd declines. Of course, the market is skewed towards the sellers, and 880 odd advances. So slightly below that 2:1 mark there with respect to where declines are concerned. But in terms of the sectoral heat map, let's try to pull that up and see what's happening there. There you go. It's the Nifty Metal that's losing grounds today, down by about 1.5 odd percent, followed by oil and gas down by about 0.7 odd percent. Nifty Realty also seeing some profit booking there, down by about 0.6 odd percent. But something that's doing well is Nifty IT up 0.6%, largely led by Wipro that we saw in the Nifty 50 heat map. Nifty Consumer Durables doing well. Nifty Finance Bank, so largely the BFSI in the green today. In terms of the PSU Bank also in the green. There's Nifty Pharma, which is slightly in the green today after the kind of gains it saw yesterday. But otherwise, there's Nifty Auto, which is trading flat almost, but there is profit booking seen in FMCG as well. So that's with regards to where the sectors stand. But how are the broader markets doing?
Yeah, I mean, that will give you an indication, Mahima as well as viewers, good afternoon, as to how the broader markets are functioning as well, because you're seeing a relative outperformance in banking and IT, and which means that some of the broader market indices are facing some bit of pressure. The Nifty mid cap there down around a third of a percent thereabouts, and the Nifty small cap as well down by a similar kind of a number. When you're looking at the range and it's a fairly range bound day of trade, and that's the other thing that stands out for me across the market. Activity levels are slightly on the lower side, and it's very, very range bound. As Mahima said, most investors, traders are not or keeping chips to themselves and keeping chips off the table. That's what it seems. BSE 500, top gainers, top losers. Of course, there are quite a few. Muthoot at the top of that list. It's also a stock of the day. So that one is up 10%. And not every day that a 1 lakh crore market cap company moves by that much. Then you have Kalyan Jewelers also doing fairly well for themselves. Chalet, Sterlite, Pfizer, again on the back of numbers. Manappuram is up 4 as well. Probably some bit of knock from the way in which Muthoot is doing. You have some names which are not doing as well. Cohan's Life, again, maybe 40,000 crore, 7% move is a large one. Bata, EIH, EIL are just some of the names. A CSB Bank, again, not particularly positive with regard to how the commentary shaped up yesterday, and therefore you're seeing that 4% knock in trade. Mahima.
So that's with regards to where the markets are concerned, and let's bring in Kush Bora joining us today. Kush, very good afternoon to you. With respect to where markets are concerned, I believe you will also be, taking careful positions right now going into the long weekend. Is that reading correct with respect to where Nifty 50 stands?
Hey, hi, Mahima. First of all, very good afternoon. A very happy Independence Day in advance to you and to all the viewers. That's right. See, my bias on the market remains long. If you see the kind of moves that we made yesterday, even today, consolidating with this mild positive bias, I think, from a near-term perspective, there could be an upside that could come about to 24,800, 25,000 levels. 24,400 remains a strong support zone. But this is the known unknown that the market is perhaps, cautious about. We all know that there is a big meeting lined up anyway, ahead of a long weekend. In volatile times like these, markets would have perhaps cooled off a little, consolidated and traded with low volumes. Now more so, as I said, because of that known unknown of the meeting, I don't think anyone wants to take a very big position home. Despite that, as I said, the bias should be on the long side. if you have a position on the Nifty, perhaps even on Bank Nifty for that matter, not a bad idea to hedge that or maybe go a little light just because of the nature of the event that's lined up.
What about the top picks for the day?
So more of updates on the picks this morning. On the morning show we had discussed a call. DMCC specialty chemicals seems to be doing well right now. Volumes a little muted, but that's been the case across the market. So I'll take that as a positive on the price action. So from the current levels, 345, 356 target still intact. 320 is where you place that stop loss. The other one is also an update. GPIL Godavari Power is something that we discussed yesterday for the first target of 205 that was hit today. In fact, even yesterday for a brief bit, the stock actually hit that level. I think it's a good idea to continue holding on to this one, perhaps add a little, since it's seeing some sort of profit booking with a stop loss around the initiation price of 198 now for targets of 212 and 219.
Okay. All right. So those are the picks that Kush has on his radar today. But it's time for an NDTV Profit exclusive. Now, Indian tax authorities are sending inquiry notices to several individuals over foreign accounts and mainly in the UK and European countries. And we have Shimi joining us with more exclusive details on that story. Shimi, what are you picking up?
Yeah, so what sources tells us is that, the income tax department has started sending inquiry notices to several individuals over its foreign holdings. And in fact, the notices were issued under section 131 pan-India, across India, where they are seeking explanation over that how and where the money has been disclosed, the account has been disclosed. Now, the move comes after the Indian authorities have received a huge number of data, and in fact, what we understand from the sources that around 2.5 lakh of account have been shared under common reporting standards via automatic exchange of information, and basis of those data and those intel, now the income tax department started sending inquiry notices in most of those numbers and those data. Now, the critical point here is that if the account remains undisclosed and they are not able to kind of disclose, they won't come forward and say that we have not disclosed these data, then they may have to face action under Black Money Act, which is a very rigorous law under Income Tax Act, which actually attract jail term up to 3 years plus above 100% penalty on the total undisclosed amount. The important point here is that Income Tax Department notices is at inquiry stage, and where the signal and the messaging tax departments want to send that, look, you have chance, you can come forward and disclose these numbers, otherwise you may have to face rigorous action. And of course, with the global cooperation with all foreign jurisdiction, they are getting these data to kind of go after those individuals who used to easily stash money abroad and were difficult earlier to kind of trace those foreign accounts earlier, but with real-time access to these financial data, now Indian authorities are clearly going after those tax offenders.
Okay, thank you for that, Shimi, for that perspective as well as for that cover of sorts coming in. Okay, viewers, stay with us. We have Kush with us. Kush, quick take with regard to the auto space, because I read a tweet today by Sandeep Sabharwal, who's also a guest speaker on our channel, talking about how the auto space on charts looks extremely interesting. The Nifty Auto Index apparently, and he's referring to a head and shoulders pattern that it has made and believes that this is probably one of the very few times where a perfect chart pattern is being seen. Wanted your take on this, and is there a possible opportunity in this pocket?
Harsh, so there's definitely traction in the two-wheeler space, and the two picks that I've also discussed a couple of times on the channel are TVS Motors and Hero MotoCorp. In fact, I remember a conversation, I think it was with Tavanna in the morning show, where the 4200 base was a very solid one, and we said it's not a bad idea from a risk reward perspective also to go long. The stock was around 4350 or so at that time. It's shot up quite a bit. even now, if you see the volumes on the way up are very, very encouraging. So definitely, as far as the two-wheeler space goes, TVS Motor, Hero MotoCorp, both these stocks look very, very interesting even now. The issue is with the passenger vehicle space, where the only candidate, suppose, if you suppose standing out is actually Mahindra and Mahindra. It's had its period of accumulation with positive bias, seems to be moving higher. It's perhaps just the market hangover that's holding it back. Otherwise, the stock perhaps would have run to 3,400 and higher levels, which in time, in all likelihood, it might. So I would actually be constructive on Mahindra and Mahindra. Now, concern is with the likes of Maruti, which has faced 13,000 as a resistance level multiple times and dipped from there. So if 13,000 is taken out, I would be constructive on Maruti. Tata Motors, we all know, is a long-term play and hasn't really done much in terms of momentum. So yes, I would be constructive on the auto space, but selectively. And the three picks in this space would be TVS, Hero, and Mahindra and Mahindra.
Thank you for that, Kush. Stay with us. As always, 2:10, we have a special conversation lined up for you. We have Prashant Khemka, founder, Vito Capital, joining us on this Independence Day special conversation. Welcome, sir. Harsh here. Always great chatting with you. So let me start off by giving or asking you for guidance. What's the best space to be in this 79th year of independence? If I were to ask you for that, one big sector or space or pocket in all of this uncertainty that we are seeing globally that could outperform this year and could maybe help some of our viewers gain financial independence, maybe not in this year, but maybe a couple of years from now.
Thank you, Harsh, for having me here on the show today.
It's a pleasure, is totally ours.
So, see, I would answer the question a little differently, not trying to avoid the question.
Sure.
But actually, some of these questions are of the nature that the answer is impossible for anyone to know. Not just myself, I'm saying impossible for anyone to know. So it's impossible to know which sector is going to do better next year, according to us. But what I can say is, for financial freedom that you talked about, longer term financial freedom, the few steps that one needs to follow, first of all, depends on whether an individual has a corpus to invest or not, whether they have the savings that they can invest in equity market. If they don't, then start saving. That's the first step. Obviously, a lot of people end up spending, nowadays I see younger folks end up spending almost everything that they earn and take some borrowing. Then there is no room for investment or financial freedom. You have to decide what is a priority. Your priority to have a $200 mocha or $100 mocha ahead of building a path towards financial freedom, then that is your choice and you have to decide. Otherwise, you can start with a target to save on a monthly basis. What is the minimum that you would save? And just I'll give you a hint, the higher, the better. And then from this savings, you determine an asset allocation program. Maybe you can, take help from a financial advisor on this front, depending on your risk appetite, your time frame, your expenses that you see ahead of you. You can come up with what is the right asset allocation. Risk appetite plays a very important role. And also the comfort with equity markets. For me, only feel comfortable if 100% is invested in equities. If anything less than 100%, it's very discomforting to me, and hence have always been 100% in equities and fully invested at all times. So that comes me to the third point. Once you've determined your asset allocation, don't, flog it around. It should be truly a structural asset allocation. It should not change month to month, quarter to quarter, depending on macro headlines. Like Trump is imposing tariffs, Trump is reducing tariff. All these things, they should not lead to, I would say, there should be hardly any events or instances where you have a step function change in your asset allocation other than an evolutionary manner where depending on your age and risk appetite and responsibilities as they change over time, that may have an impact on your asset allocation. So to recap, if you don't have a corpus, start saving. If you already have a corpus, or once you have a corpus, determine an appropriate asset allocation program and then stick to it. Don't get whipped around by the market volatility and media headlines. Harsh, back to you.
So you've given us a fantastic 30,000 feet view. If I were to just probably ask you a follow-up, so a lot of investment analysts and big investors say that you should sit on cash at certain points in time, and that really helps you deploying cash at the right time, especially where equity markets is concerned. You are more of the view that be fully invested at all points of time. Give us your take on why is it that you feel so? Do you just see that that's the quantum of opportunity always available in equity markets? There's always inefficiency somewhere. Is that where you come from when you give us that?
So Harsh, few things. First of all, I've heard many market gurus talk about the beauty of keeping in cash, staying in cash and whatnot. I'm yet to see one that has really benefited over a long period of time by doing so. And for every one example that you might be able to cite, and I won't go into verification of that, there would be dozens, if not hundreds, who have lost money doing that. Okay, I don't believe that it is doable, and hence I have never even tried. So long ago, I saw a movie about the time when I started investing in equity markets in the mid-80s. I saw the movie Dawn, where there's a dialogue, Dawn ko pakadna mushkil hi nahi, namumkin hai, which applies, though Dawn gets caught in the movie market, you can't catch the bottoms and the peaks and whatnot. So I've never tried to catch bottoms or find bottoms in the market at a market-wide level. You can do it for individual stock basis. So now that is one perspective to look at it. Now there's another perspective I'll give of why I believe fully invested makes sense. It's a bit mathematical. I have at least reached the conclusion that of all the asset classes, equity gives the best returns over time. Yes, it is a little bit more volatile in the short periods, but in the time horizon, which is over decades, over a lifetime, that volatility is nothing. So longer term, equity provides the best return. That is number one. Second is that timing or calling the market direction in the near term is impossible. So first, hypothesis that I believe in longer term, it's the best. So it is obviously going up at a faster pace than any other asset class. Second hypothesis, it is impossible in the shorter term, it is impossible to predict where it's going. Yeah. When you combine the two, it's almost like mathematical, A equal to B, B equal to C, so A equal to C. So when you combine the two that I talked about, then to me it makes tremendous sense to stay fully invested at all times. That's the only logical conclusion if you agree with the first two, that A, stock market is the best return over time, and B, it is impossible to time. If you combine the two, the only conclusion is to stay fully invested at all times, Harsh.
Makes absolute sense, Mr. Khemka. Hi, Mahima also joining this side. Just want to understand in terms of where earnings stand, right? We are almost at the fag end of where Q1 FY26 numbers have almost come out for most of the companies. Just wanted to get your sense from the first reading of it as to how earnings will pan out for FY26 going forward. And a follow-up with regards to that, do you think now valuations perspective, do you think it's attractive enough, markets are attractive enough, and if one wants to go ahead and invest today, do you think this will be the reasonable valuations to enter at?
Mahima, I think it's very reasonable valuation to enter at. It is in line with the last 11 years, let's say. Since 2014, the multiple has hovered around 20, 21 times. Right now, we are right there. It's not I'm not saying that's the right multiple or wrong multiple, but one of the measures or parameters that people call a market expensive or cheap is by looking at how is it trading relative to history. So right now it is trading right in line with the last 11 year since 2014 average multiple the market. So that is one. Second, to your point of earnings, I think the first quarter, everything that we've seen so far, obviously there are always puts and takes. Certain sectors have done better, certain sectors not done so well. Within sectors, there are certain names that have done even better or not done so well. So that's always the case. But in aggregate, the numbers of the quarter are consistent with what we believe would be a year of low double-digit corporate earnings growth.
Okay.
And that's in line with longer-term normal. I think we had, after COVID, 4 years of super normal or above trend line, I would say, above trend line earnings growth. Last year was a bit softer. And this year we're expecting in line with the trend line, which is a low double-digit earnings growth from the market.
Understood. Mr. Khemka, in terms of where the flows are concerned, DIs have been resilient enough to keep the markets in check. But year to date, we've seen that FIs, has been net outflow only. It's around 1,92,000 crores. Just want to understand as to, what will be the next trigger that will bring back FIs in India when it comes to, the overall net inflow position that will be in positive.
See, the market is the biggest trigger. The market is going higher. There's some puts and takes. So see, first of all, we have to understand that out of $800 billion or so invested in India by foreigners through the FPI route, 600 or so is as part of multi-regional funds, be it Asia Fund, EM Fund, or Global Equity Fund. Only approximately 200 billion is India dedicated funds, people choosing to invest in India, whereas the vast majority, 75% or so, is people choosing to invest in emerging markets, and a small allocation flows through to India. So if there is a situation where people are negative, investors globally are negative, say on emerging markets, even if they're positive on India, even if the 200 billion has grown by, let's say, 5% to 210 billion due to net inflow of $10 billion, but what if this $600 billion sees a 10% outflow or even a 5% outflow? So then that is minus 30. So that minus 30 would be far bigger. And that's because not people are just cutting down on India exposure within EM, but just overall global investors are cutting down EM exposure. There's been 5% outflow from EM funds, let's say. That would lead to 5% outflow from that $600 billion bucket, vast majority of which is EM, and 200 billion would only get 5%, which is 10 billion. So even though investors are allocating to India and are positive, the overall flow can be negative. That's an important point, my view, to understand. And what we've seen over the last year, 2 years, is exactly the same phenomenon where EM has seen considerable outflows, and that has dominated the flows in India. I'm not saying all throughout India flows have been positive. Of late, India dedicated flows have also turned somewhat weak and negative, and that is to do with Indian market underperforming this year by about 20% relative to the rest of the EM. Markets everywhere, investors everywhere are extremely predictable in that they put money in what has recently done well, and they take money out of what has recently done poorly.
Sure. So you've been an investor for a very long period of time. So you've seen various cycles, various themes play out over 3, 4, 5 years. One or two or three of those likely themes may be energy transition, maybe data centers, maybe AI and technology. How do you suggest, or how are you playing some of these themes? Or do you believe that some of them are premature and maybe others will do well? So give us your take.
No, Harsh, you're right. You look, there are two things. One is the themes playing out in real world, and B, is there a way to benefit from them in the stock markets, from the equity markets? Yeah. So some of the themes that you mentioned are very true. I'll throw in AI as well. into that, along with energy transition, and so on and so forth. Now the question is, what are in the listed market space, what are the opportunities either directly or indirectly benefiting from them? And B, how are they valued? Whether investing at current prices, even if the theme does extremely well as expected or better than expected, whether investing at current prices, would they deliver good returns? Obviously, we would like outsized returns, but even whether they would be able to deliver better or superior returns. So those analyses have to do. As an example, let's say during 2003 to 2007, infrastructure, real estate, and major boom in the real economy was there. And those were the strongest themes at that time. But most of those sectors didn't end up making money. In fact, if you invested beyond a certain point in time, let's say 2005-06 time frame, those who might have invested in 2003-04, got in very early, could have made money since that time even till today. But those who invested in 2006-07 time frame, even the themes were at their strongest in the real economy, in the real world, in fact, might still not have recovered their money, at least not recovered inflation adjusted or market adjusted. Yeah. So those are important considerations. So I agree with you in terms of the themes that we'll see in the real economy play out very well globally as well as in India, this whole energy transition and the AI phenomenon. The challenge is to identify names that directly, indirectly benefit and whether they are at appropriate valuation at this time.
Right. Thank you so much, sir, for coming in, speaking with us on this very special day. Wishing you and yours a very, very happy Independence Day, sir. And thanks for coming in and giving us that.
Thank you, Harsh. I'm sorry, not dressed for the occasion, but thank you for having me.
Not at all, sir.
Much appreciate you.
Not at all. I'm sure that all of your views, sir, resonated very well with the viewers.
Wish you and all your viewers a happy Independence Day.
Thank you, sir. Thank you. And with that, we'll slip into a short break. On the other side, of course, we'll continue India market close. So stay with us.
जब मुंबई से वापस कोल्हापुर शिफ्ट हुआ तो सबने कहा कि ड्रीम सिटी को छोड़ रहा है। ड्रीम सिटी, तो मैंने कहा ड्रीम में तो यही गलियां आती हैं। तो जब ये रियलाइज हुआ कि कुछ बड़ा करने के लिए बड़े शहर में रहने की जरूरत नहीं है, तब लगा कि लाइफ में ग्रो किया। कशी ताई, ऐसे बॉय मिलते मुंबई में? चांस ही नहीं।
SIP करो, इन्वेस्ट करो, लाइफ में ग्रो करो। प्रतिभूति बाजार में निवेश बाजार जोखिमों के अधीन है। निवेश करने से पहले सभी संबंधित दस्तावेजों को ध्यान से पढ़ें।
मुझे तोड़ लेना वनमाली, उस पथ पर देना तुम फेंक, मातृभूमि पर शीश चढ़ाने जिस पर जाएं।
वीर है, क्या बात है भाई, वाह वाह वाह। अगर चीरोगे ये सीना धड़कता देश निकलेगा। मैं वो हनुमान हूँ जो दिल में हिंदुस्तान रखता हूँ।
भूल गए क्या युद्ध भूमि में कीमत बड़ी चुकाई थी।
तुमने तो अपनी ही मर्जी से वतन छोड़ा था।
तब ये वर्दियां खड़ी थी तान करके छातियां।
खून माटी से जा मिला वरना आज सिंदूर ही नहीं होता।
जय जवान जो मैंने शुरू किया था ये एक्चुअली मैं दोबारा आया हूँ आप लोग से मिलने के लिए। मुझे बड़ी खुशी है आप देख रहे हैं YouTube पे मेरी फिल्म। वाह क्या बात है, क्या बात है।
देखिए जय जवान मेरे साथ 15 अगस्त को सिर्फ NDTV पर। जय जवान जय जवान जय हिंद जय हिंद।
They're the force behind some of India's most respected business empires. But you've rarely heard them speak. Now, for the first time, these leaders open up on succession, conflict, governance, and inheritance. Join me as we step inside boardroom.
Welcome back. You're watching India Market Close. Now it's that time of the show where we invite Soumit Sarkar and who is joining us with all the chatter that he's hearing from the dealing room, and he's picked up some things today. Soumit, what are you hearing today?
Well, definitely nothing on the consumer stocks, but multiple stocks that remain in focus. Firstly, it's blue.
She just breathed. She just breathed a sigh of relief because a long weekend is something that Mahima is really
waiting for.
That Soumit was planning to spoil. But okay.
Well, yeah, multiple stocks that remain in focus. Firstly, it's Blue Jet, and dealers are indicating that the company might announce a fundraise as soon as on Monday, and the QIP amount could be around 1,000 odd crore rupees, and the pricing could be at a discount of close to around 5%. So keep an eye out for Blue Jet Healthcare. For BPCL, dealers are indicating that there are buy flows seen at lower levels on this counter. Dealers believe that BPCL currently is the best bet among the oil marketing companies. For KPIT Tech and Oracle Finance, multiple dealing rooms are suggesting buy calls to their clients, and this is based on completely technical charts. For Ola Electric, dealers are indicating that there are buy flows on large HNI desk on anticipation of some positive announcement that could come in on their annual event that will be held tomorrow on August 15th. For RBL Bank, dealers are indicating that the fundraise announcement could come in anytime soon now. But do remember that this news has been doing rounds for quite a while in market. And lastly, when it comes to Vedanta, there are buy flows seen at large HNI desk on lower levels on anticipation of some positive announcement that is expected to come in soon from the company's side. So keep an eye out for Vedanta as well.
Very interesting. Soumit, on the BPCL front, you're seeing buy flows at lower levels. You also mentioned today morning that the results were largely in line, you would say, and you felt that there was still some bit of constructiveness left on the stock.
Well, yes, if you look at, if you compare all the three oil marketing companies, HPCL, BPCL and IOCL, BPCL is currently has the cheapest valuation. It posted a much better result compared to what HPCL and IOCL has reported numbers right now. So on that front also, BPCL numbers are much better and valuations are cheap. So on that basis, dealers believe that it is currently the best bet among the oil marketing companies.
Interesting, and we will quiz some of our guests on that as well. BPCL clearly finding favor from someone who tracks this space very, very closely, which is Soumit. So thank you so much, Soumit, for that. We'll let you go. All right, we still have Kush with us. Kush, BPCL on the charts.
Afraid I still don't share the same enthusiasm as Soumit does. I will give the entire OMC pack a miss. Let's see, even if the price action does take off, and then if there are some resistance levels taken out, I might change my view. But at the moment, I wouldn't really venture a trade. And if you see all three of them after a good run are actually seeing some sharp rounds of profit booking, trading close to the low point of the day. So yeah, that view remains. I wouldn't trade them just yet.
Okay, all right. So that's with regards to where BPCL stands, but we're also joined by Nirav Ashar now. Nirav, hi, very good afternoon to you and a very happy Independence Day in advance. I'll take up what Somit was talking about. That's RBL, a possible fundraising on the cards for the counter. Your view with regards to where RBL stands?
Yeah, good afternoon and thank you for the invite. And here is wishing everybody at our NDTV team and all our viewers a very happy Independence Day in advance. Yeah, I think with regard to your question, I think RBL planning a fundraise at this point of time. I think it's the most opportune time to do a fundraise because we are seeing an uptick in the credit offtake and the loan sanctioning disbursement has been going up. And I think this seems to be an opportune time to do the fundraising as far as the bank is concerned.
Nirav, thank you for that. The S&P has upgraded India to a BBB, outlook stable versus a BBB negative. This is of course substantial positive just on the eve of Independence Day, Mahima, that we're seeing. Wonder what's happening on the 10-year yield. If we have that, let's quickly pull that one up and let's see if there's been an impact on that. But this is obviously big news, positive news coming through that S&P has upgraded India to a BBB. Of course, this will lead to lower funding costs from a fiscal deficit standpoint, which is clearly a positive. And clearly all positive from a macro perspective where India is concerned. Nirav, any thoughts with regard to what this will mean broadly?
Well, I think it's a very big positive at this point of time, especially if one were to consider this on a relative basis, if one were to compare this with the rest of the world. We are seeing the world is going through a lot of turmoil at this point of time. As far as the different geographies are concerned, we are seeing that there's expectation of a slightly lower growth as far as the US economy is concerned. Europe is already going through a sluggish growth period at this point of time. And we have China, which is showing resilience at this point of time. So I think especially in this entire context of things, I think it's a very positive development. And one should not forget that all this upgrade has come on the back of some very strong fundamentals. So we have the rain gods with us. So we've had a very good Kharif crop as well as a Rabi crop. So this is one big positive. And the second big positive for the Indian economy has been the food inflation has been tamed. And we have the commodity inflation which has been tamed to a large extent. And we have crude oil prices which have behaved. So they are hovering currently at around $66, which gives a lot of comfort to the Indian economy. And this is not to forget that we have a good growth story ahead of us, especially the focus on the infrastructure spending, etc. should augur very well as far as the economy is concerned.
In fact, there are lines also coming in on the same, and that says that they believe that the effect of US tariffs on the Indian economy will be manageable, and that's one of the reasons as to why they've upgraded India. In terms of the 10-year bond yield on bonds that Harsh was talking about, that is also taking a sharp fall. It's come down by 7 basis points, which opened at around 6.47% mark, which has come to around 6.4% right now. So that's the effect of this particular upgrade that S&P has given to India, and that's probably S&P's way of saying Happy Independence Day to us, it seems, Harsh.
Well, it does, and what this does even to the currency, which is the rupee, will be crucial to see. Some bit of rupee strength prima facie being witnessed clearly on the back of this. The chart has gone a little bit awry, but we'll have to wait and watch as to, the dollar rupee chart. Can we pull that one up? There you go. So we're seeing some strength where the rupee is concerned as well against the dollar. Clearly positive from that perspective, even though IT seems to be doing well on a day like this. So yes, interesting stuff playing out at this point on the back of that substantial upgrade, Mahima?
Absolutely, and we have Hiral also joining us with more detail as to how this will, overall impact.
What's interesting over here is, this upgrade is coming in because the last time what S&P did was in terms of the FY26 growth forecast. They had last upgraded that, I think, if I'm not mistaken, a month back to 6.5%, and their entire conversation was that the upgrade in terms of growth is coming in on the back of a resilient, domestic demand as well. So that was the time when they actually went ahead and raised the growth forecast to 6.5%, and the reasons that they cited for the same was normal monsoons, soft oil prices, tax reliefs, monetary easing. All these were the key drivers as well amid the global headwinds that they were looking at. But now, following this upgrade in terms of growth, upgrade coming in to a BBB with a stable outlook does come in as a key positive, and this is coming in at a time when you're talking about threats from a US tariff perspective. Now, to be noted, tomorrow you have Trump and Putin that will be meeting as well. So just ahead of that, this is a crucial step. The impact that you're seeing in terms of the bond deals, the impact that you're seeing in terms of the Indian rupee as well, pretty interesting, and this is an absolute positive news, Harsh and Mahima, that we're picking up. So one, an upgrade in terms of a growth forecast, which is now followed by an upgrade in terms of the credit rating. So you know where India is headed towards.
And the report also is quite interesting because it says that they've given the reason as to why they've upgraded the counter. They're saying that India is prioritizing fiscal consolidation, and the kind of government's political commitment is there to deliver public finance as well as maintaining strong infrastructure drive. That's something that is one of the reasons as to why they've upgraded India as a whole. And they're saying that robust economic expansion is having a constructive effect on India's credit metrics as well, and they expect sound economic fundamentals to underpin growth momentum over next 2 to 3 years is what they're saying. So these are the two main reasons and overview of the overall upgrade on India.
Yeah, and it makes sense, right? Because Hiral, Mahima, largely the Indian economy and the Indian fiscal prudence has been on the conservative side at a time when other economies of the world have been focusing more on spending, and therefore, this is very, very welcome, and this has been an appeal which has been in the works for a while. We are joined in by Gaurav Sen-Gupta, who's the Chief Economist at IDFC First Bank. Mr. Sen-Gupta, thanks so much for joining us at very, very short notice. Talk to us about what this means structurally and what this opens us up for. Was this something which was in any case warranted, or is this a bit of a surprise? Give us that perspective first.
It's definitely a positive surprise. The fact that the rating upgrade is a positive surprise, and it reflects the fact that India, especially at the center level, the central government has stuck to its fiscal consolidation plan. In fact, for the last couple of years, the center has also outperformed in terms of reducing the deficit to below target levels. And they've done it in a very challenging environment, and I think among emerging market countries, if you see the overall trajectory post-COVID of fiscal deficit to GDP, India will be one of the few countries where overall fiscal deficit to GDP is coming down, led by the consolidation by the center. And this upgrade actually reflects that, because the only thing that is holding back India's rating or keeping us in the BBB bracket is the fiscal side, where we, relative to other BBB rated countries, are slightly on a weaker footing. But the fact that we are making them right in terms of fiscal prudence, we are making the right moves in terms of sustained reduction in fiscal deficit as a proportion of GDP for the last couple of years. The fact that the center has done a lot of reforms, for example, getting off balance sheet items on balance sheet, also trying to streamline the cash management, the sort of fund release from center to state governments with their real-time, or I would say just-in-time cash management using the Sparsh system, etc. So this upgrade reflects the fact that at least on the fiscal side, our fiscal deficit to GDP has been coming down, led by the center. Even our government debt to GDP, while it's on the higher side, it is on a moderating trajectory.
Mr. Gupta, hi, Mahima also joining in. Just want to get a sense, the report also says that they believe that the effect of US tariff on Indian economy will be manageable, and that's been the case so far, that a lot of market experts, economists have reiterated. Do you also believe the same, and do you think that this upgrade will further probably help India when it comes to the overall tariff impact that's going to have?
Definitely, the good part is right now in this sort of global slowdown, high external uncertainty among the Asian countries, India is one of those few Asian countries which is domestic demand driven. So we are more dependent on how our domestic consumption and our domestic investment cycle performs. We are a net importer, so there is some downside risk from the US tariffs, but it's much more manageable due to the nature of our growth dynamics, being a domestic demand-driven economy. So, for example, if let's say the US persists with its 50% tariffs till March, we see a downside risk of maybe around cumulatively of around 40 basis points. If let's say our base case is that India does reach a agreement with the US, that would limit the downside risk to growth. But given the nature of our growth, being domestic demand driven, also the fact that if you see our export basket, it is, yes, US is our largest trading partner in terms of 18 to 20% of our exports go to the US. But if you see the merchandise export basket of India, it's well diversified because we have got almost an equal distribution between developed markets as well as emerging markets on the merchandise front. The other saving grace, or I would say protection from external volatility, is the fact that on the services trade, where these trade tensions for now have not spread, India has really post-COVID, if you see, there has been a very strong pickup in our services exports, especially software, professional services, etc. So that has limited the impact of external volatility, global growth slowdown on India. So we do agree with the S&P assessment, but for us, I think the limited impact is also assuming that India is able to reach an agreement with the US.
All right, thanks a lot for that, Gaura. Moving to Madhavi Arora, who joins us as well. She's the lead economist at MK Global. Madhavi, hi, I hope I'm audible.
Yes, very well.
So, Madhavi, any first thoughts, long sort of impending upgrade, and what are you making of this?
So, Gaura has largely covered bits of it, but of course, I think we are finally getting to enjoy the fruit of the last 10, 12 years of consistent fiscal consolidation across the board, across entering states to some extent. And the fact that we've sort of managed our balance sheet, not just in the government side, but as well as other economic agents, both household as well as businesses, have actually been very clear, very manageable in terms of their own balance sheet assessment. And I think the external sector also has been, pretty well managed. From the internal as well as the external balances, I think India has been steadily improving, its case for an upgrade. And I think it was long impending and finally it's happening. So, it's a good news, that's it.
Madhavi, I do want to understand. So, with most, all three of the global credit rating agencies, they've consistently focused on how the fiscal consolidation path is, sort of India's Achilles heel. Also, the other factor they've consistently spoken about as the reason for India not having been upgraded earlier was the debt to GDP ratio, the general debt and those levels. So, of course, while we've made immense progress on fiscal consolidation in recent years, on debt, while we have seen some reduction, it has not been to that extent. So, I mean, how are you sort of piecing that together?
Oh, post-COVID, I think across the board, we saw worsening debt to GDP ratios. Was not just India. But if you look at the Western world, their debt to GDP ratio actually worsened dramatically. even China for that matter, last 2 years, the consistent fiscal expansion has led to the debt-to-GDP ratio now going above 90%. For India, if you look at the trend, I think we reached close to around 89% post-COVID. We're now currently somewhere close to 83%. And given the fiscal consolidation path that we have in order, I think next 3 years, it should be able to touch somewhere close to around 80%. Of course, going to a 60%, which is what their main aim is going to be a long-drawn process. But at least there's a direction, there's an intent. And our debt-to-GDP ratio has worsened much lesser than our peers in emerging markets. Or if you look at the DM market, which is developed world, there the trends are very different from what you're seeing in India. So at least on incremental basis, there is a hope that India, if it continues with fiscal consolidation, should be able to see a much lower debt-to-GDP ratio in the coming years.
Okay, Madhavi, I do have one last question for you regarding what you think are the immediate implications of this upgrade. What can we expect in terms of any reaction, immediate as well as in the near term, on the bond yields, on currency markets? What can we expect the implications of the upgrade to be?
So any upgrade, investment upgrade that any country sees leads to a big increase in the passive flows as far as some indices are concerned. So you are going to be seeing, and you're already seeing the first impact, the major impact across asset classes, be it INR, be it bonds, or be it equities. So that beyond that, I think because of this upgrade, you should see some passive flows coming into India, which would ideally be good for the quality flows that that would stay back instead of just being hot money flows. So I think any kind of upgrade leads to a relatively lower risk premium of the economy, which again has impact on the overall financing ability of the country. So of course, broad-based gain that we should be seeing across sovereign as well as corporate when it comes to borrowing abroad and even domestically.
Okay, thank you, Madhavi, for some of those views coming through. Gaura, thank you as well. We'll let both of you go. Thanks so much for joining at short notice and giving us that perspective. Pallavi, thank you for joining in to that conversation as well. Let me bring on board Gurmeet Chadda, who's also here to give us a perspective on what this means. Gurmeet, uncertain global macro, but India getting a big thumbs up on the eve of Independence Day.
Absolutely, couldn't have come at a better time, especially when we are grappling with host of issues. If you see, India is probably the only market which has underperformed in last couple of weeks, largely due to tariff and trade war issues. Japan made a new high. We've seen US markets scaling new high. S&P made new highs. Most European markets made new high. And I think this couldn't have come at a better time. And I think it was long due. With a series of reforms government has done, fiscal consolidation, India now being the fourth largest economy and the fastest growing. So I think it was long due. Ideally speaking, although you may say that asking for more, I think we deserve much better. We were ranked at par with likes of Thailand, Romania, etc. With our external debt position is much better. And, I think couldn't have come. And I think the banking, cleanup which has happened, corporate balance sheet being deleveraged, this will have a lot of long-term implications, including to flows in bonds as well as, a serious reduction in FPI selling.
Gurmeet, hi, Mahima also joining in. Just want to get a sense, we've already seen the fall in the 10-year yields already. What do you make of this in terms of where the yields go from here on, as well as the India dollar impact, rupee dollar impact?
I mean, very good question. I think, and I've been making this point, Mahima, with Harsh and Neeraj also for a while, that long duration bonds are the juiciest in terms of asset allocation right now. And I've been saying this for almost 12 months when the yields were 730. I think now with inflation being 1.5 and WPI being negative, I think the terminal repo rate can go to 5, maybe 25 bits below that. And with 10-year GSEC typically, is about 50 to 75 bits over repo rate. So we can see 10-year yields sub 6, which means, you can see another 30 to 50 bits rally on bond yields, which also means corporate bond yields will come off and cost of funds come off. And I think that has a huge bearing on the overall system, the credit offtake, the banks in terms of the treasury gains they do and cost of funds falling. And I think overall people have forgotten, because we have been so used to high rates and high yields. What does let's say a 6% home loan do to consumption and housing? What does a 6% car loan does in private consumption? So this has huge ramifications, along with, I think, interest rates coming down. I think, as I said earlier, couldn't have come at a better time.
Our Executive Director Neeraj Shah also joining us on the phone line. Gurmeet, be with us, please. Neeraj, what do you make of this? What's the editorial take? Neeraj, can you hear us?
Yeah, loud and clear. Can you hear me?
Yes, we can. Please go ahead.
Yeah, I'm saying, Harsh, it'll be interesting to see if there are further dead economy tweets or social posts coming out. But be that as it may, I mean that's the joke that every corporate leader that I sent this message to sent back to me. So this is a shot in the arm, right? I mean, and it has immediate repercussions, some of which Gurmeet spoke about. And I wonder if there is a pattern in the way global rating agencies in the last 12 months have gone ahead and given a thumbs up to India's economic standing is. Now, whether the economy is slowing down and the pace at which it is slowing down is a different question altogether. This is more about the balance sheet strength of India and whether India's economy is able to absorb shocks, if any, right? In some sense, the rating does that. And I think that is, therefore, this is a thumbs up to my mind. I would love to hear, of course, what Gurmeet and other people have to say. But yeah, this is a well-expected shot in the arm, if you will, for India. It's just coming at an interesting juncture, Harsh.
Right. So, Gurmeet, we've spoken bonds, and Neeraj also, please be with us. Gurmeet, we've spoken bonds and how you're positive there. What's the immediate bond impact, and what do you believe the cascading impact on equities will be, Indian and in the global context? Give us that perspective.
So purely from an investor point of view, because we manage public money, I think if you see, there's a lot of gap even between the 10-year and the 20-30-year bond. Traditionally, this gap is not more than 10-20 bits, but because of the FI selling, post RBI change in stance even in bonds, and the market is slightly illiquid, relatively liquid versus 10-year, not liquid in absolute sense. The gap almost went up to 50 basis points. So I think any long duration fund, from an investor point of view, you will benefit from the compression as well as the overall fall in yield. So I'll not be surprised if the next 1 year return in bonds could be double digits. Won't be surprised there. Secondly, as I said, there's a lot of impact on the overall cost of borrowing and the perception in general. Because see, mind you, we have just got included in the global bond index, and there were already some news of JP Morgan reconsidering India's weight, etc. So I think we need long-term bond flows as well. A lot of time we are so focused on SPI flows in secondary market. We forget that we need bond flows. And look at this way, income tax amendment has happened, and I'm surprised it hasn't been covered as much. I was speaking to Neeraj also on this, that now the sovereign funds, the pension funds can invest in infra sector with exemption on dividend and capital gain. Now, if you add all of these things together with the rating upgrade, higher FPI flows in bonds, income tax exemption towards infra, you can see massive foreign capital coming. I think just need to act on this now and do more things to deepen the corporate bond market in particular. I think that could lead to significant benefits for the overall economy.
Okay, all right. Gurmeet, we've also got the short-term ratings from that report, and we've got that upgrade there as well from A3 to an A2 is what the short-term ratings have also been raised at. In terms of what Neeraj was also earlier indicating, saying that the tweet about the dead economy that was just defied by this take that S&P has given on India overall. Any message, according to you, that you would want to give the viewers through this particular upgrade in terms of, because this move is coming on a fantastic day, just a day before Independence Day. So your view, one message that you would want to give the investors.
I always say, and this is my favorite quote, that every past correction was an opportunity. The current one always looks like a risk. And I think don't lose, belief in the long-term story of India. And I think time and again, different names come. Sometimes it's the wars, Sometimes it's COVID. Sometimes now the tariff is the new war. I think things will keep coming. The names keep changing. Use these disruptions to build onto your portfolio and have the asset allocation in place. Sometimes what we do is we get carried away by a lot of noise in the near term and forget about the asset allocation. We missed out on gold giving 40% last 1 year. As I said, the last 1 year return for long end bonds is also double digit. So be more balanced in your approach, and any sharp correction due to external events in India, in my 20 years has always been an opportunity. So I think you first have to be a believer if you are an equity investor, and overall as a balanced investor, don't miss bonds and other asset classes like gold.
Right. Gurmeet, good afternoon. Hiral on this side. So, another question I have is if you have to look at corporate India, basis the upgrade that we've gone in terms of India, companies which have a rating which was as what it was for India, do you see an upgrade coming in on that front as well, number one? And two, if that happens, how do the dynamics change for any of these companies?
No, it will happen. There will be definitely a rub-off even on some of the better rated papers. Now, if you already see, the bank credit was a little slower, but the corporate borrowing has picked up because AAA issuers like let's say Reliance and some of the NBFCs were able to borrow more from the corporate market. And, a lot of bond issuances in the last 2 months. So, it always happens in terms of, that's why I said it's very important to deepen the market, even beyond AAA. I also see some of the better run AA plus, also the spreads getting reduced on the credit side as well. So it's huge benefit overall. And, once you have low cost of borrowing, it also encourages you to borrow and do capex, especially in companies which are in capital goods, power utilities and broad capex sector. So I think it has a lot of implications, and I just hope these tariff issues are resolved because the market would want to see that before making the next leap forward. That's why you see the reaction so far. I don't know what the reaction will be in the next half an hour, and today's expiry also has been still pretty muted. In a normal day, an event like this would have led to a big surge, while the bond market is showing it, equity is still not showing it. So I think it will have broader benefits for the economy and cost of borrowing and capex, and I think eventually it will get reflected in the markets too.
Right. Gurmeet, thank you so much. And, while I bid you goodbye, let me also take it as an opportunity to wish you a very happy Independence Day, you and the entire organization, of Complete Circle. And also to let viewers, all of you know, that the India Chief Economic Advisor has also issued a statement saying that the S&P upgrade is actually a motivation for them to maintain that path of fiscal prudence. And that, of course, at such a juncture, when you've already seen an upgrade, continues to resonate with what the establishment has always said, or the government has always said in terms of its positioning. Let me also slip into a quick break. On the other side, we'll continue and we'll take top buy today, sell tomorrow picks. We'll talk about some stocks which are really buzzing in trade, the likes of a Muthoot and more. Stay with us on NDTV Profit.
मुझे तोड़ लेना बनमाली, उस पद पर देना तुम फेंक, मातृभूमि पर शीश चढ़ाने जिस पर जाएं।
वीर, अरे क्या बात है भाई, वाह वाह वाह। अगर चीरोगे ये सीना धड़कता देश निकलेगा, मैं वो हनुमान हूँ जो दिल में हिंदुस्तान रखता हूँ।
भूल गए क्या युद्ध भूमि में कीमत बड़ी चुकाई थी।
तुमने तो अपनी ही मर्जी से वतन छोड़ा था।
तब ये वर्दियां खड़ी थी तान करके छातियां।
खून माटी से जा मिला वरना आज सिंदूर ही नहीं होता।
जय जवान। जो मैंने शुरू किया था ये एक्चुअली। मैं दोबारा आया हूँ आप लोग से मिलने के लिए। मुझे बड़ी खुशी है आप देख रहे हैं YouTube पे मेरी फिल्म। वाह क्या बात है, क्या बात है।
Welcome back. You're watching India Market Close here at NDTV Profit. Well, the markets are extremely flat. The Nifty 50 trading about 0.05% higher. So I think, as we mentioned at the start of the show, the investors don't want to take a risk over a long weekend is what the prima facie reading is. The Nifty Bank also up 0.3%. The mid cap 150 is gone back to the red territorial. It's down by about 0.3%. The small cap 250 also down by about 0.3%. In terms of the overall heat map, if we can try to pull that up and see how counters are shaping up right now, I think Wipro is still leading the entire pack. Tata Steel still under the red and with a lot of pressure, down by about 3%. Tech Mahindra down by about 1.3%. There's Hero Moto down by about 1.19%. But Wipro and Infi, the IT majors stealing the show. Wipro up 2.2%. There's Infosys, which is up 1.5%. Gains are also seen in counters like Eternal, HDFC Life, both seeing gains of about 1.5 to 2%. There's also good moves in Asian Paints as well as Eicher Motors, Maruti Suzuki. So auto names also doing well. Let's try to pull up the sectoral heat map and see what's happening there. In terms of the overall sectoral picture, it's divided into the red and green. There's good moves in the Nifty IT where we're seeing good gains in Wipro and Infosys. There's Nifty Bank, Finance and PSU Bank doing well in trade today, but the Nifty Metal seeing cuts of about 1.4%. The Nifty Oil and Gas down by about 0.8% and Nifty Energy also seeing losses of about 0.7%. But sticking with the story where S&P has upgraded India to a BBB, Hiral, give us more perspective as to what's happening there, and we've also guests joining us.
Yeah, what's interesting is, the commentary which is coming in that the strong growth track record is the major positive, because the report has stated that India's growth track record is pretty strong. And this is especially after the pandemic that, they saw the GDP growth average at around 8.8% between that FY 22 to 24 period. And this was the highest if you have to look at the entire Asia Pacific region. Now, in addition to that, what they've indicated is that it remains the best performing economies in the world from a growth perspective. And it has actually staged a remarkable comeback as well since then. In fact, let's also get in Manishi Rai Chaudhary to tell us more. Manishi, good afternoon and welcome to the show. A big rating upgrade coming in for India. And this is at a time when we have the 79th independence celebrations tomorrow as well. How do you read this upgrade, number one, and the back of this upgrade, how do you see FI inflows reacting to this?
Okay, great. Thank you very much for having me here. I think this upgrade was in a sense long overdue, because if one compares India's, the usual parameters like debt to GDP ratio or fiscal deficit, and, inflation, which basically gives more room to the Reserve Bank of India, then pretty much India would compare favorably with all the other economies which are rated similarly. So, I think it's a reaffirmation that India's stable fiscal and monetary policy is bearing fruit, and it's also giving a good deal of policy stability and policy room to both the government and the central bank.
Okay. So Manishi, overall taking these into consideration now when you're talking about the growth momentum moving ahead, and because this rating upgrade was long overdue, do you think the FIs that have been sellers in the last 1 month, there is a potential for that buying interest to come back?
It's definitely a sentiment boost, no doubt. But at the same time, I think FIIs, or why FIIs only, pretty much all investors would possibly wait for the earnings environment to catch on. As I have said repeatedly, that the strongest reason why we have seen foreign outflows and the market coming down is that the earnings estimates have been coming down over the past 1 year, right, from September 2024. So we would need the earnings estimates to bottom out and then begin moving up before we see a sustained revival in the inflows. So I think that could happen, and most importantly, I think this rating change also reaffirms that there is enough policy wiggle room for both the government and the central bank to provide some stimulus so that earnings estimate revival and even the consumption revival can be hastened.
What, Manishi, in your opinion, and this is Harshya, sorry, what in your opinion will revive consumption in a big fashion? Because while we talk about fiscal prudence on the one hand, and that's probably likely one of the big reasons for this upgrade, it's also a bit of a concern that an economy of $4 trillion odd dollars still is looking or gunning for 6.5% growth. Would that in any way disappoint you, and do you believe that a solid stimulation on the consumption side is still required, or all of it is done? What's your opinion there?
I think the government has done its bit in terms of giving more money in the hands of the urban taxpayer. Also, the 16th Pay Commission awards are likely to be implemented in the near term. But at the same time, what we need possibly is more job creation, and which also needs some degree of, what should I call, clearing up of the policy environment. Right now, much of the, basically the lack of job creation or the job losses are happening in the tech and service sector. Like TCS talking about 12,000 reductions in the middle and senior to mid-level is sort of a proverbial canary in the coal mine. So until and unless we have some revival on that side, it is difficult for consumption sentiment to pick up on a sustainable basis.
So much, Manishi, for coming in, giving us that perspective. Voices coming in thick and fast. Also wishing you a very happy Independence Day, Indian Independence Day. Hiren Ved joining us, Director and CIO, Alchemy Capital Management. Hiren, great having you. It's Harshya. Sir, I'll pose the same question that I posed to Manishi. What should priority be at this hour? Of course, we've got this big rating upgrade, long awaited, positive sentimentally, as well as honestly on rates. So across the board, a positive. What should the current priority be from a market's perspective? Where's the boost required?
I think, I think what has been happening in the economy is that the consumption is still struggling at the bottom of the pyramid, right? And, while ratings upgrade is good news, as you rightly said, much awaited, should bring the overall cost of capital down for Indian companies who want to borrow abroad over the medium to long term. But what is most important at the current point in time is two things. One, I think from a consumption side, I think that we probably need one more rate cut. We continue to have the RBI to keep liquidity surplus, and the impact of the tax cut to flow through, which should typically flow through now. On the investment side, I think there is a lot of uncertainty that has been created because of the trade and tariffs that have been imposed on India. And unless there is clarity or some resolution over the next few weeks, people, at least private capital investment might be held back because nobody would want to start new projects in the face of this kind of uncertainty.
Hiren, 100 bips cut already done. You're calling for maybe another cut or so, 25 bips. How long does this take to impact consumption? Give us your view there.
Yeah, I mean, 100 bips is done. I think another 25 to 50. Typically, it takes, 1 or 2 quarters for the cuts to seep through. I think that the one of the reasons why it's got a bit complicated is that despite the cut, we have not seen the transmission of that is because currently unsecured lending and retail lending is going through a little bit of a soft patch, given that NPLs have spiked seasonally for all lenders, and lenders may be a little circumspect to go out and dilute their lending standards. So my guess is that it is going to take a little bit of time, but it should definitely happen by the second half of this year or going into the festive season. We should be able to see some bounce in discretionary consumption.
Okay. All right. Hiren, thank you so much for taking out the time and speaking with us at NDTV Profit. We really appreciate that. We've also Rajesh Palavia joining us now from Axis Securities. Rajesh, hi. A very good afternoon to you and a very happy Independence Day in advance to you and your family and your team, of course. With regards to where markets stand, what is your view right now? Will you be taking any positions?
Good afternoon and happy Independence Day to the NDTV Profit team as well as to the viewers of NDTV Profit. With regards to the market view, Nifty is very sideways, and the kind of supply pressure which we are witnessing at 24,650, 24,700 range is as the major call writing activity is still intact around those strikes. So I think till Nifty not crosses about 24,700, I think range bound activity is likely to be there in Nifty. On the downside, 24,500, 24,450 is the immediate support area, and on the higher side, 24,650 to 700 is the supply zone. So I think till this uncertainty is there as we are going for this long weekend. So I think nobody wants to take any big bets in the market, and everybody is light in terms of position. So I think everybody is waiting for some news flow to to react to. So I think any positive news towards any tariff or something can boost some sentiment, and we may see some buying action to emerge in this market. Till the time there is no news flow, I think range bound activity and stock specific activity is likely to be there, and Bank Nifty is not able to cross 55,500, which is the immediate and major supply zone for the Bank Nifty. So if Bank Nifty crosses 55,500, then some short covering could trigger. Okay. On the stocks fronts, two stocks idea where we are focusing at this juncture. One is Uno Minda. If we analyze the weekly structure, almost consolidation of 7-8 week, there is a breakout on Uno Minda. And looking at this breakout, we believe that this momentum can extend further, and possible upside towards 1200 to 1220 we can see. So Uno Minda one can buy with stop loss of 1120. Another stock where we are focusing is Asian Paint. After a long corrective move, now stock is showing sign of bottoming out, and the kind of recovery which we are witnessing on the weekly as well as on the monthly chart, that clearly shows that now again the fresh buying interest has been emerged in this counter. Looking at chart structure, we are projecting target towards 2575. So one can buy and accumulate with stop loss of 2495.
Okay, the stock of the day, Muthoot Finance, Q1 complete beat across the board, 7% ROA. The longer term guidance is 3 to 4%. They've been doing 5 to 6 typically over the last 3 years, 7 this time. Margins better than expected, both YOY, QOQ, things get better. Higher yields, lower cost of funds, lower OPEX to assets, all three of those aiding the operating profit side of things. Then you have lower credit costs coming in, both YOY and QOQ, led by recoveries, which was aiding the numbers, and a very, very strong growth of 40% on the gold loan side, 37% on consol, 42% on standalone AUM. Extremely robust numbers overall, 90% YOY growth on profitability, 2100 crore, near 2100 crore in terms of profit after tax versus the 5200 crore PAT number they clocked for the full year FY25. Very, very strong numbers, and therefore stock of the day, stock on a tear. Nirav Ashar, quickly your view with regard to a Muthoot, and also if I can ask you, Nirav, give us a take on Manappuram as well, that arbitrage between Muthoot and Manappuram in terms of valuation, what looks more attractive to you?
Well, I think it's been a dream run as far as the gold loan companies are concerned. And I think as far as Muthoot is concerned, they've had the best of all the worlds. I think a very strong performance since the last 3 quarters. I think apart from having a strong reach, apart from having the technological know-how, the more important thing is to spread awareness about the effectiveness of this product. I think we had a lot of informal players and unorganized players who were quite active in this particular space. But I think now that awareness has been going up, and I think consequently we are seeing the organized players begin to perform quite well. Their margins have improved significantly. And I think the concentration of gold in the southern part of the country, South India holds about 40% of the gold holdings, and we have a large part of the gold holdings in rural areas and the semi-urban areas. So I think the spread of this awareness has definitely played an important role as far as these gold loan companies' performance is concerned. If from a valuation perspective, I think Muthoot trades at closely 4 times price to book. So I think a lot of the upside is captured into the price at this point of time. And I think on a relative basis, I think Manappuram looks, there is scope for some appreciation from the current levels.
Okay, so that's the take coming in from Nirav. Nirav, Rajesh, right at the outset, I'd request you to be very, very quick because, of course, we've had a truncated show, or the show has been affected due to that rating upgrade that we got. Rajesh, quick take, Muthoot Manappuram.
Muthoot Finance is looking very attractive. The way stock is moving up, I think furthermore upside we may see in the continuation of this up move. So one can remain invested in this counter at this juncture. Even in the minor decline, one can add the position with stop loss of 2650. On the high side, I think 2950 would be the next trajectory for the stock. Even Manappuram is also showing sign of good buying interest, and looking at the overall structure, we believe that till stock is trading above 255, there is a possibility of upside towards 280, 290 in the short term.
Rajesh, BTST?
For BTST, I think we are focusing at this juncture at Uno Minda. I have already recommended. So another stock where we are focusing for BTST is Indian Hotel.
Okay.
Indian Hotel managed to give breakout on the falling trend line on the weekly chart. Looking at the structure, we believe that some more upside towards 790, 800 we may see in the near term. So one can buy Indian Hotel with stop loss of 765.
Okay, on to our bull versus bear segment. The stock we've chosen today is Senco Gold that we're going to discuss about in terms of both the bull and the bear case for the counter. It came out with its Q1 earnings, an impressive set of numbers. I mean, in terms of the overall numbers, it was not a disappointment at all. Sales growth was largely in line with what peers did. In fact, a tad bit better than what Titan and Kalyan did. But overall, high gold prices is a concerning factor, plus competitive intensity going up is also one of the reasons as to why they had to go to higher discounting in terms of their making charges, which is where they make maximum profits and margins from. In terms of the EBITDA margin, it expanded 230 basis points YOY to that 10.1% mark, but the guided range is between 6.8 to 7.2, and there is inconsistency when it comes to their operating margins because of fluctuating hedging that they're doing. So that's a concern with regards to where margins stand. Moving on, in terms of where the return ratios are concerned, they are set to improve going forward in the next 3 to 4 years to that 17 to 18% mark, because they are adopting FOCO model, that is franchisee model instead of company owned model. But overall store expansion when it comes to Senco is not as aggressive as something like a peer Kalyan Jewellers or Titan for the matter is doing for Tanishq as well as Carrot Lane. Lastly, in terms of where valuations are concerned, it is trading at an inexpensive valuation as compared to its peers, because 36 times P trailing 12 months is not cheap, but compared to a Titan, Kalyan, it is cheap. And going forward, the valuations to come down to around 24 times, so cheapest amongst the pack of that retail jewelry space. But overall working capital days have significantly gone up, which could be a concern when it comes to Senco Gold. So this is the overall view of the bull and the bear case of where Senco Gold stands. Nirav, I'll come to you quickly on this one. Your view according to how Senco Gold has done this quarter, and if you were to play the theme of the retail jewelry space, which one would your bet be on?
Well, I think Senco continues to be a consistent performer. It's focused more on the eastern part of the country. Typically the ticket size tends to be on the lower side. I think lower than 50,000 rupees. I think there has been a strict focus on margins. So the results have been pretty decent. But I think from a valuation perspective and from an investment perspective, I think we would prefer a Titan at this point of time.
Okay, so that's with regard to Senco Gold. Rajesh, do you have a view on Senco?
So there is a breakout on near-term chart, and looking at breakout, if its stocks continues to hold above 348, I think some more upside we could see towards 375 to 380. That's the next level where we can see stock to continue this up move.
Some other stocks moving as well. One is Ventive Hospitality. That one is down 6%. Do you have a view on that, Rajesh?
Ventive, again, the major supply zone for this stock is placed at around 800 rupees, and we have seen again, the same kind of corrective move from the stock. So if I analyze on the short-term behavior, stock is still consolidating in a broader range. On the downside, 700 is the lower band of the stock, and on the higher side, 800. So I think looking at the overall structure, we believe some more consolidation is likely to remain in this range. Only 700 to 800 would be the range for the stock for next couple of months.
Quick view on Sami Hotels. The stock is taking a beating today on the back of its earnings. It is because a lot of other peers in the same space have done exceedingly well despite of the geopolitical tensions. But as compared to that, I believe Sami Hotel was not up to the mark, and that's why investors punishing the counter. Are you of the same view?
It's a corrective move in this counter. This is the fourth consecutive week in this counter. We are seeing sustained supply pressure is there. So looking at the near-term structure, there is a breakdown. So if it continues to trade below 215, maybe we may see further lower level. Possible downside can extend towards 190 also.
Thank you so much, gentlemen. We'll let you go on that note. We're 2 minutes from close for the day as well as for a truncated week. Wishing both of you a very, very happy Independence Day. And we hope you have a great long weekend. You too, viewers, but we've still got 2 minutes to go. So we're going to quickly take you through how markets have been. Absolutely flat on the Nifty. We've given up the very, very marginal gains, if at all I can call it that we made through the day. Let's look at the intraday chart, a very, very tight band in which the Nifty has traded in. You look at the day's high and the day's low, probably just about a 60 to 70 point differential in that high and low. So very, very tight band. Let's look at the heat map as well, and what we'll see is largely the breadth is even Steven. 22 advances to around 28 declines. Wipro is the top gainer. Some IT stocks showing zinc, the likes of an Infosys, a Wipro, of course, out there. So those are the two IT stocks doing fairly well for themselves. Pharma also doing all right, but largely flat. And the financials have done a little bit better than they have all through the week. So some outperformance in those two pockets, but despite that, we're not seeing a lift with regard to where the Nifty is concerned. Absolutely flat. Let's look at the sectors as well, and that's likely what we will see in terms of the texture IT, banking, finance, consumer durables has done fairly well for itself. Metals languishing at the bottom, 1.4% down. Oil down as well. Energy, oil down around 1%. Realty is down 0.8%. So within the broader market pack, that one is the one to pick. Nifty FMCG also down around 0.8% odd. So that's the texture. Broader markets not doing as well. Let's pull up the advanced decline all through the day, and you'll see that the advanced decline is reflecting some pessimism in broader markets. We are at the days, possibly at the day's low where the advanced decline is concerned. So the breadth clearly unfavorable, and therefore there you go. The Nifty mid cap down around a third. Again, a very, very range bound day that the Nifty mid cap has seen. The index itself, the Nifty small cap too, down around 0.5%. So closing very close to the day's low where the Nifty small cap is concerned, despite being a range bound day of trade. Let's look at it intra-week as well. The Nifty 50, mid cap, small cap. Let's also look at banking and IT, because those ones did stand out a bit in trade today. So 1% higher on the Nifty all through the week after what's been a tough last 3-4 weeks for the Nifty. So we've closed in the green. Nonetheless, 1% higher on the Nifty mid cap as well, despite the kind of fall we saw today, but largely in line with the Nifty, working in tandem. 0.7% higher on the Nifty small cap this week. So slight marginal underperformance seen here on this index. Let's also look at the Nifty bank and the Nifty IT and the Nifty metal if we can. 1.5% up on the Nifty IT, so outperformance seen there. Within the larger counters, that's where some outperformance was seen. Nifty Bank, despite the outperformance today, is up just about 0.6%, so has still underperformed the Nifty. Last off on the Nifty Metal, well, 0.8% higher. So despite the fall today, and that's possibly the reason for this underperformance on the Nifty Metal. So that's broadly the take coming in. Last off, the BSE 500 top gainers, top losers. Those are some names for you which are in focus. Muthoot Finance, we spoke about that. Coromandel has bounced back up 4% higher. It was impacted due to China urea yesterday, and we've seen a bounce back on that one. Easy Trip doing well for itself, 4% up. Chalet Hotels, Manappuram Finance on the back of that zing seen in Muthoot Finance doing fairly well for itself. Cohance Life Sciences on the back of numbers, 8.5% lower. Clean Science, well, just some of the other names which are buzzing in trade. Hotel stocks were one of the culprits in trade today, but broadly, that's how it played out. Let's look at the weekend. It's going to be a packed one, of course. You'll have US initial jobless claims, China industrial production, but more importantly, it'll be everything about tariffs. We'll have to wait and watch as to how that plays out and what is in store. Some corporate actions for you on your screen, some dividend adjustments which will happen come Monday. You'll also have a few earnings which are still left. Those are the earnings post-market which are expected to come in. That will be awaited on the weekend, but that's the boring stuff. Let's talk about the interesting stuff. Let me bring in Shreyansi to tell us about all that's happening beyond markets during this weekend.
Well, absolutely, and there's a lot that is happening beyond markets, because you do have coolie fever that has in fact gripped the nation. Of course, you do have that one big release. That's the one that we're going to be talking about in just a bit. There's another one that you should be looking at. The next plate is about the War 2. That's a sequel made with a big ticket budget. In fact, let's take a look at Coolie first things first, because that's the one that you should be looking at. Budget of about 350 crores there, about 350 to 400 crores is something that you're penciling in terms of the budget. And when you take a look at the recovered about 60% of its cost just before the release. And those are what some of the reports in fact are indicating. 100 crores is the kind of pre-sales figure that this has managed to rake in. The fan frenzy, of course, like we've seen, is crazy. It's really something that we're seeing that is unprecedented in terms of the biggest releases in cinema as well at this point in time, and there's no points for guessing. Of course, you can see one of the reasons why this film is doing very well. The next one that we're going to be talking about, of course, is War 2. Like I mentioned, made with a budget of 400 crores. You're looking at a very big release coming in. This is in contrast to War, which was the previous one in this particular franchisee, and you have a strong opening weekend despite the release of Coolie that is being penciled in. 85 to 120 crore rupees. With this one, tickets already priced between 800 to 2,000 rupees in some multiplexes. So it looks like fans are going to be paying big, and there's going to be a hole in a lot of pockets when it comes to tickets for War 2 and Coolie the Powerhouse. But let's also take a look at some of the OTT releases that you have on ZEE5. Of course, you do have Tehran that is releasing. So that's one that you should be looking at. The other one, of course, is Sare Jahan Se Acha on Netflix. That's also one important release that already it's released on August 13th. And there's a lot of expectations around this one because you do have two great actors coming together with this one. And those are some of the releases that you should be keeping an eye on then. But thank you so much for tuning in.
मुझे तोड़ लेना वनमाली, उस पद पर देना तुम फेंक, मातृभूमि पर शीश चढ़ाने जिस पर जाएं।
वीर अरे क्या बात है भाई, वाह वाह वाह। अगर चीरोगे ये सीना धड़कता देश निकलेगा, मैं वो हनुमान हूँ जो दिल में हिंदुस्तान रखता हूँ।
भूल गए क्या युद्ध भूमि में कीमत बड़ी चुकाई थी।
तुमने तो अपनी ही मर्जी से वतन छोड़ा था,
तब ये वर्दियां खड़ी थी तान करके छातियां।
खून माटी से जा मिला वरना आज सिंदूर ही नहीं होता।
जय जवान जो मैंने शुरू किया था ये एक्चुअली, मैं दोबारा आया हूँ आप लोग से मिलने के लिए। मुझे बड़ी खुशी है आप देख रहे हैं YouTube पे मेरी फिल्म। वाह क्या बात है, क्या बात है। देखिए जय जवान मेरे साथ 15 अगस्त को सिर्फ NDTV पर। जय जवान जय जवान, जय हिंद जय हिंद।
They're the force behind some of India's most respected business empires. But you've rarely heard them speak. Now, for the first time, these leaders open up on succession, conflict, governance, and inheritance. Join me as we step inside boardrooms and living rooms of India's most enduring family businesses for real stories, raw conversation, resilient legacies, building legacy.
हेलो
Hello and welcome. You're watching Market Express and I'm your host Malika Mishra. Let's get straight into the show. A range-bound day of trade saw Nifty close flat at about 24,600, while Sensex ended the week at around 80,500. This is despite the positive cues from S&P, which upgraded India's rating to BBB. Wipro was a top gainer in trade, while Tata Steel was the biggest laggard. The broader markets, meanwhile, faced pressure in trade, with both small cap and mid cap indices closing the week with cuts of around 0.5%. Most sectors end in the green. In the red, metal, oil and gas and energy were the top sectoral laggards. IT, finance and PSU Bank were resilient in trade. The market breadth largely favored the bears. Today, August 15th, marks India's 79th Independence Day. This anniversary commemorates the country's freedom from British colonial rule that ended in 1947. The day will be observed with flag-hoisting ceremonies, cultural events and speeches across the country. The celebrations will highlight India's progress, achievements and ongoing development efforts. This milestone provides an opportunity to reflect on India's history, its people and its ongoing journey towards growth and development. And today, in a significant boost to India's economy, S&P Global Ratings has upgraded the country's credit rating from BBB- to BBB with a stable outlook. S&P says effective US tariffs on Indian economy will be manageable. It also says that our monetary policy is more conducive to manage inflation. The upgrade in rating reflects India's robust economic growth, improved fiscal management and strong external balance sheet. The BBB rating is a testament to India's solid growth performance and promising economic outlook. The country's GDP growth is expected to remain strong, with projections of 6.8% in FY25, 6.9% in FY26 and 7% in FY27. JSW Cement made a muted debut on the stock exchanges today, listing at a 4% premium over its IPO price of 147 rupees, opening around 153 rupees per share. Despite the brand's strength, subscription was tepid with a 7.77 times overall subscription, led by strong QIB and NII interest, but weaker retail participation. The company reported losses in FY25, with revenue slightly down from previous years and EBITDA margin contracted to 12%. High debt burden of 6,166 crore rupees against a net worth of 2,352 crore raises concerns. JSW Cement plans to double capacity and improve its industry low realizations, but lack of North India presence remains a challenge for the company. JSW Cement lists at a 4% premium today, as I said before. Brigade Enterprises posted a robust Q1 with revenue up 18.9% to 1,281 crore and net profit soaring 79% to 150 crore rupees. Pre-sales held steady at 1,118 crore despite a 17% drop in sales volume to 0.95 million square feet, buoyed by a 24% rise in realizations to 11,782 per square feet, rupees per square feet. Office leasing revenue grew 15% with 92% portfolio occupancy. The company launched 1.36 million square feet, including Brigade Morgan Heights in Chennai, and committed 803 crore rupees in capex. Management targets a 15 to 20% pre-sales growth, with 13 million square feet of launches planned across Bengaluru, Chennai, Hyderabad, and Mysuru. Samvardhana Motherson's Q1 FY26 consolidated results showed revenue growth of 4.7% to 30,212 crore rupees, slightly beating estimates. However, EBITDA declined 11.4% to 2,458 crore rupees, dragging margins down to 8.1% from 9.6% last year. Net profit dropped sharply by 49% to 512 crore rupees, impacted by exceptional expenses of 136 crore due to phased European operational restructuring. Segmental margins in modules and emerging businesses were affected by one-offs. Management confirmed no material impact from new US tariffs on India, while being cautious about global demand and acquisitions. The company is optimistic about margin recovery, with cost optimizations underway in Europe. Prime Focus delivered a strong Q1 FY26 performance with consolidated revenue rising 26% year-on-year to 1,023 crore rupees. EBITDA surged to 244 crore from 75 crore rupees, expanding margins sharply to 24% from 9% earlier. The company swung to a net profit of 110 crore rupees from a loss of 158 crore last year, aided by sharp increase in other income to 167 crore rupees. In July, Prime Focus approved a preferential allotment worth 5,552 crore rupees, issuing 46.27 crore shares at 120 rupees each, largely to acquire subsidiary DNEG. DNEG specializes in visual effects, animation and immersive content, reinforcing Prime Focus' global media footprint. Allied Blenders and Distillers posted its fourth straight quarter of strong profitability in Q1 FY26, with net profit soaring to 56.6 crore rupees from 11.2 crore rupees last year. Revenue grew 21.8% year-on-year to 923 crore rupees, driven by a 17.2% rise in volumes to 8.5 million cases and a 6.2% improvement in realizations. EBITDA rose 50.5% to 112 crore rupees, expanding margins to 12.1% from 9.8% earlier. Premium and above volumes formed 46.2% of the total mix, reflecting accelerated premiumization. The company launched Golden Mist in Karnataka and Telangana and expanded its international footprint to 27 countries, up from 14 countries last year. Ethos Limited reported a strong Q1 FY26 with revenue jumping 26.7% to 346 crore rupees, driven by robust demand in the luxury watch segment. However, net profit fell 16.6% to 19 crore rupees and margins slipped to 13.3% from 15.8%, impacted by higher promotional costs despite a 6.6% rise in EBITDA to 46.1 crore rupees. All Time Plastics made a robust market debut, listing at 314.3 rupees on BSE at a 14.3% premium and 311.3 rupees on NSE, a 13.2% premium against its 275 rupee issue price. The 323 crore rupee IPO, comprising 160 crore fresh issue and 163 crore offer for sale, was subscribed by 3.6 times, driven by strong retail and non-institutional investor interest. Funds will support capacity expansion and debt reduction, capitalizing on growing demand for plastic houseware. The listing outperformed grey market expectations of 10 to 12% premium, reflecting high investor confidence. Dixon Technologies strengthens its growth strategy with two major joint ventures. The company received MATI approval to form a JV with Longcheer Intelligence, a key smartphone design and manufacturing partner with brands like Realme in India, a move aimed at securing higher production volumes. Dixon also signed a binding term sheet with Chongqing Yuhai Precision Manufacturing to produce precision components for laptops, mobiles, IoT, automotive and more. Dixon will hold a 74% stake in this JV, further expanding into high-margin technology-driven segments. Bharat Petroleum Corporation (BPCL) reported Q1 FY26 standalone results broadly in line with muted expectations. Revenue rose 1.2% sequentially to 1,12,515 crore rupees, while EBITDA grew 24% to 9,663 crore rupees, expanding margins to 8.6% from 7%. Net profit surged 90.5% to 6,124 crore rupees, aided by lower costs, even as gross refining margins (GRMS) halved to $4.9 per barrel from $9.2 per barrel due to inventory losses and reduced Russian crude imports. LPG under recoveries for the quarter stood at 2,100 crore rupees compared to HPCL. BPCL saw sharper profit jump on a quarter-on-quarter basis, strong core GRMS at $7.2 per barrel and smaller inventory losses per barrel as well. Vishal Megamart posted an exceptional Q1 performance, extending its growth momentum for the 5th consecutive quarter with double-digit same-store sales growth. Net profit rose 37.3% year-on-year to 206 crore rupees, while revenue increased 21% to 3,140 crore. EBITDA climbed 25.6% to 459 crore rupees, with margins improving to 14.6% from 14.1% on the back of better operating leverage. Store expansion continued with entry into new states, further boosting its retail footprint. The company's quick commerce platform, though currently a small part of the business, is scaling rapidly. Management remains positive on demand trends and operational efficiencies driving growth. Senco Gold reported robust performance with consolidated sales growing 30% year-on-year to 1,826 crore and same-store sales growth at 19.6%, broadly in line with peers like Kalyan and Tanishq. EBITDA margin expanded by 230 basis points to 10.1%, driven by better product mix and diamond sales, although the company acknowledged fluctuating hedge ratios and expects EBITDA margin between 6.8% and 7.2% for the full year. Despite strong growth, Senco employed discounting amid high gold prices and competitive intensity. Return ratios are forecasted to improve to 17 to 18% in 3 to 4 years, with cautious store expansion compared to peers. Working capital days increased to 67.2. Cohance Life Sciences reported a mixed Q1 FY26 with revenue up 12.5% to 549 crore rupees, driven by a 19% rise in API and 28% in specialty chemicals, though tempered by pharma CDMO destocking. Net profit fell 35.2% to 48.9 crore rupees, impacted by one-time ESOP and M&A costs of merger and acquisition costs of 17.1 crore rupees. EBITDA dropped 10.5% to 112 crore rupees, with margins contracting to 20.4% from 25.6% due to talent and business development investments. Excluding destocking, pharma CDMO grew over 30%. The company eyes $1 billion revenue and mid-30s EBITDA margins by 2030. Indian tax authorities are cracking down on offshore tax evasion, issuing pan-India inquiry notices under Section 131 of the Income Tax Act to individuals holding foreign accounts, primarily in the United Kingdom and Europe. Data from 2.5 lakh accounts obtained via the Common Reporting Standard is under scrutiny, targeting professionals and business owners. The notices seek details on account disclosures with undisclosed holdings, facing strict penalties under the Black Money Act, including 10 lakh rupee fine and up to 7 years of imprisonment. Now, this move signals India's push for financial transparency. Top India executives from FedEx, UPS, DHL, and Aramex are set to face cross-examination in the coming weeks in a rare development within an ongoing antitrust probe. The Federation of Indian Publishers has accused these companies of price collusion involving fuel surcharges and discounts. The Competition Commission of India, CCI, had earlier cleared them due to lack of direct evidence, but has now allowed them to move to scrutinize executive statements more closely. Such cross-examination is uncommon in India and may extend the case timeline, potentially uncovering new evidence in the growing $14.3 billion courier market. Premiums for prompt benchmark oil prices globally and are falling compared with those in future months on rising output from the Middle East, Latin America, and Europe, just as peak summer demand ends, traders and analysts said on Thursday. Easing concerns that the US could impose more sanctions on Russia and further disrupt oil supplies are also weighing on oil prices. Bitcoin hit a record high as increasing expectations for easier monetary policy from the Federal Reserve added to tailwinds from recently announced financial reforms. The world's largest crypto asset by market capitalization climbed as much as 0.9% to $124,000 in early Asia trading, surpassing its previous peak hit in July. On the day, the second largest crypto token either hit $4,780, the highest level since late 2021. Infosys and Telstra have launched a joint venture in Australia, with Infosys acquiring a 75% stake in Telstra's Versant Group for $153 million, gaining operational control while Telstra holds 25% stake. The JV aims to accelerate AI-powered cloud and digital transformation for Australian enterprises, leveraging Infosys' Topaz AI and Cobalt Cloud platforms alongside Versant's 650-strong team serving government, finance and energy sectors. Now, this builds on prior collaborations, including a 2024 IT transformation deal and a 2025 Telstra International Partnership for the Connected Future 30 strategy, driving innovation and regional growth. The Indian government has urged the food industry to adopt ethical practices in labeling and advertising food products. Now, this call to action aims to ensure public health and protect consumer interests. The Food Safety and Standards Authority of India organized a national stakeholder consultation to discuss regulatory framework on food labeling, advertisement and claims. Now, during the consultation, MHFW Secretary Punya Salila Srivastava emphasized the importance of truthful practices in labeling and advertising. She noted that with increasing global exposure, the industry must adopt best practices and scrutinize food products more closely. Hearing petitions challenging the Supreme Court order to round up all stray dogs in Delhi NCR and move them to shelter homes, another bench of the top court asked why authorities in several areas started picking up animals even before the earlier order became public. The court also came down heavily on the authorities for not implementing guidelines for animal control leading to this situation. The bench of Justice Vikram Nath, Justice Sandeep Mehta and Justice N.V. Anjaria heard the matter after an August 11th order of two-judge bench of Justice J.B. Pardiwala and Justice R. Mahadevan sparked a massive row with animal lovers hitting the streets to protest the order to remove strays from residential neighborhoods. India has achieved a remarkable milestone by reaching 100 gigawatts of solar PV module manufacturing capacity under the approved list of models and manufacturers framework. This achievement is a significant step towards India's goal of becoming self-reliant in renewable energy and reducing its dependence on fossil fuels. To put this achievement into perspective, India's solar module manufacturing capacity has grown from just 2.3 gigawatt in 2014 to 100 gigawatt in 2025, which is a staggering 43-fold increase. US President Donald Trump said on Wednesday that there will be very severe consequences if Russian President Vladimir Putin doesn't agree to stop the Ukraine war after their Friday's summit in Alaska. While he did not specify what those measures would be in a virtual meeting with European leaders, he said that he wants to achieve a ceasefire at the upcoming summit. Trump also said there was a chance of a second meeting involving Putin and Ukrainian President Volodymyr Zelensky that would be more productive than the one scheduled for Friday. Paris Saint-Germain have beaten Tottenham Hotspur on penalties to win the 2025 UEFA Super Cup. The European champions came from 2-0 down in the closing stages of normal time and then recovered from 2-0 down in the shootout to prevail. Mickey Van Deven gave last season's Europa League winners the lead on 39 minutes and Christian Romero got their second goal 3 minutes into the second half. Coolie, superstar Rajnikant's latest release and a landmark moment marking his 50th year in cinema has hit theatres today. Directed by Lokesh Kanagraj, the movie also stars Nagarjuna in a lead role and showcases Bollywood star Amir Khan in a prominent role. The buzz and the hype that comes with a Talaivar movie is not a secret. Industry trackers expect it to cross 150 crore rupees in collections on its very first day, with tickets sold out for the opening weekend. And with that, it's a wrap on Market Express, but do stay tuned to NDTV Profit as we continue to bring you a lot more news and updates.
लेना वनमाली, उस पद पर देना तुम फेंक, मातृभूमि पर शीश चढ़ाने जिस पर जाएं
वीर। अरे क्या बात है भाई, वाह वाह वाह। अगर चीरोगे ये सीना धड़कता देश निकलेगा, मैं वो हनुमान हूँ जो दिल में हिंदुस्तान रखता हूँ।
भूल गए क्या युद्ध भूमि में कीमत बड़ी चुकाई थी।
तुमने तो अपनी ही मर्जी से वतन छोड़ा था।
तब ये वर्दियां खड़ी थी तान करके छातियां।
खून माटी से जा मिला वरना आज सिंदूर ही नहीं होता।
जय जवान जो मैंने शुरू किया था ये एक्चुअली, मैं दोबारा आया हूँ आप लोग से मिलने के लिए। मुझे बड़ी खुशी है, आप देख रहे हैं YouTube पे मेरी फिल्म। वाह क्या बात है, क्या बात है। देखिए जय जवान मेरे साथ 15 अगस्त को सिर्फ NDTV पर। जय जवान जय जवान, जय हिंद जय हिंद।
In 1942, as India's freedom movement was taking shape, another revolution was beginning in Mumbai in colour. From humble beginnings, Asian Paints grew to become Asia's third largest paint company and a global leader in coatings, combining innovation and sustainability. Today, it operates in 15 countries, leading markets from Nepal to Oman, Egypt to Bangladesh. With $3.5 billion in annual revenue, a $2.5 billion brand value, and a top-tier BSI score, Asian Paints proves that Indian enterprise colors the world. Born before independence, thriving in freedom. This Independence Day, we salute brands like Asian Paints for coloring the globe with India's spirit.
S&P Global upgrades India's rating from BBB- to BBB with stable outlook. India gets an upgrade for the first time since 2017. Commerce Secretary Sunil Bhartwal says India's exports grew substantially in July despite uncertain global policy environment. Adds that the proposed export promotion mission is currently under interministerial consultation. Benchmarks end the week 1% higher as Nifty snaps its 6-week losing streak. All sectoral indices barring FMCG close with the gain. Broader markets underperform marginally. Tax authorities issue inquiry notices to individuals over foreign accounts seeking details of how and where these accounts are disclosed. Notices mainly sent to Indians with accounts in the UK and European countries. Infosys ends over 1% higher after acquiring 75% stake in Telstra's Versant Group for over 1,300 crore rupees. Both the companies will set up an AI-led cloud JV. Supreme Court hears petitions challenging the order on removal of stray dogs from residential neighborhoods, raps the Delhi government for not implementing animal control guidelines. 10 people feared dead after a massive cloudburst in Chashoti region of Jammu and Kashmir. Pilgrims are being evacuated as rescue teams rush to the site. Trump warns Russia of very severe consequences if it does not make a peace agreement with Ukraine. Also seeks a trilateral meeting with Russia and Ukraine in the future. Good evening. You're watching Profit 360 on NDTV Profit, and I'm Sanjana. Over the next half an hour, we're going to bring you the latest in markets as well as national and international news. Big news coming in. S&P Global has upgraded India's long-term sovereign credit rating. The agency cited economic resilience and sustained fiscal consolidation as reasons for the upgrade. Now, S&P Global has revised outlook on India's rating in May last year to positive from stable. But for more on this and what this actually means and what this entails, I'm joined now by Dinesh Khara, former chairman of State Bank of India. Good evening, sir, and welcome to NDTV Profit. Thanks so much for joining us. Good news, in fact, coming in, especially on the cusp of Independence Day. What more could we ask for? How significant is the S&P outlook upgrade for India's global investment landscape and borrowing costs?
No, it will certainly help the country when it comes to the country risk. With the improvement in rating by S&P, the country risk will come down, which actually means it actually translates into lower borrowing costs when it comes to overseas borrowing. So I think it is a very welcome step. And also when the international rating agencies recognize the fiscal prudence of the economy, then obviously it actually goes a long way in terms of demonstrating the commitment of the government and ensuring the growth of the economy while ensuring that there is enough discipline as far as fiscal is concerned. So I think it's a very welcome step, and I believe it will further improve our ability to raise foreign borrowing at even much cheaper cost.
And we're actually getting in word right now from the Finance Ministry that has, of course, welcomed S&P's upgrade, saying that it has become the second global agency to upgrade India in 2025 after DBRS. So this is, in fact, good news coming in, and the government welcoming the ratings upgrade coming in after 18 years. I'm going to go across to my colleague Pallavi, but before that, sir, I'm going to ask you, you had made a comment, and that was here on NDTV Profit, that global investors look closely at sovereign ratings. So now how do you see this playing out in terms of FII flows and foreign investor sentiment towards Indian markets?
No, I expect that it should turn positive. And of course, there are multiple other things also which foreign investors invariably evaluate before they take the final decisions. But this is one of the very important factors which will certainly influence their decisions also.
All right. Dinesh Khara, sir, stay with us, but let me quickly go over now to my colleague Pallavi to actually break this down for us. Pallavi, what does this rating upgrade mean for India, and give us the rationale for it?
Right, Sanjana, like you've already said, it is a positive for the Indian economy. The rating being raised from BBB-, which, let's remember, is the lowest investment grade rating, to a BBB. And a lot of market analysts and commentators did say that this was long overdue. So, looking at what is the rationale that S&P has set out, India has continued to prioritize fiscal consolidation. We have shown a consistent decline in the fiscal deficit, especially at the centre's level, and that does demonstrate the government's political commitment to delivering sustainable public finances. Let's remember, this was alongside the government continuing to maintain its strong thrust on capex. Also, robust economic expansion that's having an effect, a positive effect on India's credit metrics. That is expected to continue to drive growth for the next 2 to 3 years, in addition to fiscal, also monetary policy settings that have been conducive to managing inflationary expectations. In fact, the CPI print that has come in, the latest one, is in fact the lowest in almost 8 years. So these are some of the reasons that S&P too has outlined. Also, let's have a quick look at the outlook. The outlook continues continues to remain stable, reflecting the global rating agency's view that continued policy stability and high infrastructure development continues to support India's long-term growth prospects. That, along with fiscal and monetary policy, is expected to help moderate the government's elevated debt as well as fiscal burden. Let's remember that global rating agencies have consistently cautioned that India's debt burden has been the economy's Achilles heel, but there is expectation that that too is going to narrow along with the consistent reduction we have been seeing in the central as well as general government deficit.
Right, Pallavi, thank you so much for that and explaining that so simply and comprehensively. Let me check if I have Dinesh Khara still with us, sir. So, why do you think it's taken so long? Because the last upgrade by S&P that we saw was actually, some time ago, sometime in 2007.
No, of course, invariably these agencies review the trend for a reasonable time and then only they take a call. And we are observing that for past couple of years, the fiscal consolidation is one of the focus area for the central government. And that is something, and apart from that, when the economy was in fact, was in need of the support from the fiscal, there was enough focus in terms of developing the infrastructure, which has gone a long way in terms of maintaining the stability and the growth of the economy in the difficult days also. So I think the more important aspect is that while supporting the infrastructure growth, the fiscal prudence has been maintained. So I think that is a very clear reflection that we can actually strike a balance between the conflicting goals, but still it is possible when there is a very clear focus in terms of what we want to achieve. So I think fiscal prudence was given enough importance, and at the same time, even the monetary policy is also very supportive, and it is actually getting reflected into the kind of inflation print which we get to see. So I think inflation numbers also giving the indication about the inflation expectation, that being low, focus on the infrastructure, fiscal prudence. These are all very welcome areas when it comes to ensuring the sustainable growth of the economy. And I think once the international rating agencies could develop that kind of a confidence, they have upgraded. This has to be seen in the context that despite the fact that we are currently facing headwinds when it comes to the US tariff rates, but nevertheless they have evaluated all those factors and still decided to upgrade the rating. So that is something quite credible. This I would like to mention.
Would you think, and what kind of macro level changes can Indian banks and corporates now expect following this upgrade?
Well, when it comes to the monetary policy, I had actually already reduced the policy rate significantly. So which means that the interest rate regime has become quite soft when it comes to the domestic interest rate regime. When it comes to overseas also, it has turned to be very positive in the sense that it has come down. Interest rate for the overseas borrowings will also come down. So eventually this should show up in terms of the operating performance of the corporates in the days to come. So I think, which again is a very welcome stage, and invariably the foreign investors look at the operating performance of the corporates. So I expect that even that will also improve, and which will probably help country to demonstrate Indian corporates to demonstrate much healthier position, and should help in attracting the foreign investments too.
Okay, do you think, and we have been saying that India's fiscal deficit has been narrowing, over the past couple of years, and even as per government targets. So how crucial is this sustained fiscal consolidation in further improving India's credit ratings?
No, that of course, I think as far as the fiscal prudence and the fiscal consolidation is concerned, that is very much required, and it has to be maintained in the days to come also. Because when it comes to even the interest servicing also, that actually eats into the significant part of the revenue. With the consolidation happening, that those resources would be available for encouraging the development of the economy also. So I think that is one of the very major focus area, And I would also like to mention that it's not only at the center level, there's a nudge from the center to the state governments also, that they should also follow the fiscal discipline. So I think eventually when we succeed in having the fiscal discipline, even at the state government's level also, that will further enhance the ability of the economy to perform better and grow even faster.
Okay, does a GDP growth of 6.8% then in that case bode well for India's 2047 plan, would you say?
Yeah, I would say that since, for reaching the kind of a developed state by the year 2047, we certainly need to step up the growth rate of the economy beyond 6.8. So I would say that the kind of fiscal prudence which is happening and the way interest rate regime is running soft, so this will eventually support our growth ambitions also, and we can move towards 8% plus kind of a growth rate in the days to come.
I'm going to address the elephant in the room actually, and something that I think has been on everybody's minds because of the recent developments in US policy that have caused a lot of uncertainty on India's trade relations. Do you think that there is material risk for that in India?
See, as far as Indian economy is concerned, it is more domestic economy. So I think, yes, there are challenges. I would not say that there are not, challenges are not there. There are challenges, but I would say that since the Indian economy is predominantly domestic economy, this will certainly, we cannot ignore the risk which is there on the global scene. But nevertheless, our domestic economy should itself be in a position to propel well and should help us in tiding over the risk which is evident in the global scenario.
In terms of these positive indicators and of course this big rating upgrade that has come, what sectors do you think are likely to drive India's next leg of growth in light of all of these positive indicators?
I think there is a lot of focus on manufacturing, so this will certainly help. And apart from manufacturing, when it comes to services sectors also, we get to see that there is a lot of focus on the GCCs. So I think even that will also help in terms of generating the export revenue from the services. And as far as the infrastructure is concerned, that is always having a multiplier effect, which is to the tune of almost about 3. So even that will also help in terms of the growth. I would say when it comes to the infrastructure sector, it's all road, port, and railways. So we are seeing a lot of focus on all these sectors. So I believe that it will also show up. Manufacturing, we are seeing a lot of focus in terms of PLI, and apart from that, manufacturing will also help us in addressing the quality of employment issues also. So I think, to my mind, these are some of the sectors which have got a huge potential to grow. Apart from that, the new sector which we have seen in the recent past, of course, is the defense manufacturing sector. There also there's a huge potential for growth, and I think these are some of the sectors which will be quite a promise for the growth in the days to come.
Sure. So I think, something that we've been talking about since the news actually broke was the RBI's very prudent management of inflation and rates in supporting this improved outlook. One is, of course, how do you think RBI's prudence has helped banks stay resilient, especially in the light of global volatility that we are experiencing at this point of time? And more importantly, what more can be done to deepen India's financial stability?
Well, I think when it comes to the financial markets, risk is a reality. And the engagement of RBI with the bankers helps them in understanding the risk. But being a regulator, they have got a responsibility to ensure that they should put the guardrails in place. And those guardrails actually help in terms of mitigating the risk also to a greater extent for the financial institutions. So I would say that it's more of a collaborative effort between the lending institutions and the regulator, which has helped in terms of achieving this kind of an outcome which we have seen. So I think going forward, I'm quite confident that these healthy practices will be adhered, and which will help us help the economy and also the financial institutions also to tide over the potential risk.
All right, sir. And if I were to ask you, looking forward and your kind of outlook, what policy steps do you think are now essential for advancing towards an actual rating upgrade beyond, an outlook?
I think for the time being, maybe we'll have to wait and watch, but we'll have to see that the performance which you have demonstrated in the last couple of years, even that should be sustained. So once that gets sustained, it will certainly help us in terms of, one, of course, retaining this rating, and then, of course, upgrading this rating also in due course.
And do you think that coming to the trade negotiations, and I know that we actually addressed it, but then do you think that this could potentially put India in a better position to handle the trade negotiations now with a firmer rating?
Well, I think there are multiple other factors also which are forming part when it comes to the trade negotiations. So I would not be in a position to really comment much on that, but yes, nevertheless, it is one of the factors which certainly gives the confidence to the other side also that when it comes to the counterparties, they will certainly be having confidence in the economy, and obviously it can help in sort of improving the trade terms to some extent. But yes, of course, there are multiple other factors which will be guiding the decisions relating to the trade negotiations.
Dinesh Khara, former chairman of SBI, sir, thank you so much for your time and for answering all of our questions so very patiently. This is the big news that's coming in right now, a big rating upgrade coming in for India. The international credit rating agency S&P Global has upgraded India's sovereign credit rating, and it has kept the outlook as stable. This is, of course, big news coming in, especially on the cusp of Independence Day. So quite a shot in the arm, not just for news for all of us here, but even for the economy. And we're also looking at, you know, the reasons for the upgrading and the reasons for this rating. The government, of course, has been steadfast in focusing on keeping public finances healthy with the effort to lower the deficit and, of course, with better financial management as well. Let me, bring in my colleague Pallavi here. Pallavi, we've actually been talking about, the upgrade. We're talking about the rating. We're talking about the economy here. But I think if we were to understand for ordinary people, for you and me, and for all of our viewers watching here, what does this actually mean? Positive for India's image is one thing, but break it down and give us the basics of why this is relevant for all of us.
Right, absolutely, Sanjana. So, we've for long been sort of waiting for a rating upgrade, especially given that the previous rating, the BBB-, was in fact the lowest investment grade rating that was available. And what this could essentially mean, like you said, apart from the fact that it is a positive in terms of the image that the economy is projecting, this most importantly could result in lower borrowing costs for the country, specifically for the government and as well as for corporates. What this could also mean is we've already in fact seen a quick knee-jerk reaction of sorts. We have already seen the India benchmark bond yields ease. We've also seen a slight strengthening on the rupee, and from a medium and longer term perspective as well, these are trends that could persist, especially given how other factors, of course, play out. S&P, for instance, has explicitly said that they do not expect the tariffs that have been imposed by the US to have a very detrimental impact on economic growth. It does, in fact, continue to expect GDP to grow by 6.5%. Right. So while that is on wait and watch mode, from a macroeconomic front and from a financial perspective, this will have implications, positive ones at that.
All right, Pallavi, thanks so much for that. And let me quickly bring in Yifan Phua, Director of S&P Global Ratings, joining us live from Singapore. Good evening from India and welcome to NDTV Profit. Thanks so much for joining us. We're looking at the rating and the fiscal outlook. This is a big rating coming in for India. So give us a sense of what specific fiscal milestones or policy reforms is S&P monitoring for this upgrade in India's sovereign rating.
Hi, good evening. Thanks for having me. Yeah, there were a few factors that we were looking at when we decided to act on the positive outlook and upgrade the ratings. The first thing, as we mentioned earlier, was really the government's demonstrated commitment to fiscal consolidation. The second factor that we were looking at was also the fact that nominal GDP growth continues to be very healthy in India, and this healthy GDP growth is actually helping to steady a lot of the credit metrics, especially given the fact that despite the fact there's still that there is some fiscal consolidation, deficits are declining, but it's declining at a very slow level. So this fast GDP growth has helped to stabilize the debt level of the government, at the same time also to gradually bring it down. The third factor that we saw was very important was the monetary policy settings and its development, how inflation has been controlled at a much durable rate over in recent years, and that we think speaks forth to the increasing strengthening transmission mechanism from the RBI.
All right, so thank you so much for taking time out to join us. I do want to quickly add on to that question and understand a little bit more. Now, for the longest time, credit rating agencies, including S&P, of course, has held back on a rating upgrade on concerns regarding India's central as well as aggregate debt. So what is your current view on that? We do see some fiscal consolidation and consequently some debt reduction as well. But what are the estimates you are looking at? How reasonable are these? Would you rather see debt consolidation taking place at a faster pace?
Pallavi, thank you for that question. I think you hit the nail right on the head. That's actually, in our statements when we talk about future upside movement is really even faster pace of fiscal consolidation. If you look at India's overall fiscal picture, for us, we look at it from a general government perspective, which is central plus the state governments. Now, as you can see, the central governments, in terms of deficit declining, actually has been quite fast, right? During COVID, it was deficits were as high as 9.6, I recall, at the peak of COVID. And back then, the finance minister was already very clear to say that within 5 years, we'll bring the deficit at the central level to below 4.5. And they've certainly achieved that. On the other hand, the state governments themselves, the deficit has been coming down a lot slower, or perhaps even staying at almost the same level, between 2.8 to 3% of deficit GDP every year. So I believe that going forward, yes, the central government will continue to put in a lot of effort to consolidate its spending. But at the same time, I think the state governments perhaps will have to also chip in to help the overall deficit get smaller as well. But deficits aside, the other thing to really take note of is that sometimes it's not just the deficit that matters, but also the quality of the government spending. And that we see has been improving in the last 10 years. Increasingly, the budget has been tilting more and more towards infrastructure spend. And as a share of budget, subsidy also has been coming down. Now, that's very important because as your infrastructure improves, as your connectivity on the ground improves, that actually allows India to grow at a faster pace than what it is right now. So we are recognizing the fact that this is still an emerging economy where spending has to be done to support the economy, to also build infrastructure. But this all we believe that has a positive impact on India's metrics going forward.
Okay, Yi, I'm going to actually address the elephant in the room, and of course in every newsroom at this point of time, which is the global volatility around the tariffs. And I think in the past you have noted that US tariffs on Indian goods will have limited impact due to India's domestic demand orientation. What sectors or metrics would you monitor for any negative surprises if trade tensions escalate further?
Thank you for that question. I think overall our view is that India's, as we said earlier, it's not a very export-oriented or export-reliant economy for its growth. A lot of India growth, I believe, around 60% or so drives from domestic consumption, and therefore, we do think that the tariff story will have limited impact on India's growth, right? As we see right now. India's export to the US is about 2% of its GDP. But once you factor in the sectoral exemptions on certain products like pharmaceuticals and also consumer electronics, their exposure is down to about 1%. So that's the reason why we feel that the tariff, even though it could have some impact, but it will be quite manageable. And overall, the long-term growth story for India remains quite healthy.
Okay, I do want to add on to that. While you have explicitly detailed, even in the report and in your comments, that the tariffs are not expected to have any detrimental impact as such on the long-term growth prospects. Back here in India, we do have some concerns regarding the impact the volatility and global uncertainty is having on investments which have already been fairly stagnant despite the government's bid to push up the number, especially in the private sector. That alongside the fact that we have seen demand, especially in urban areas, remain fairly lukewarm. What are you making of these mixed sort of trends domestically, and how concerned would you be regarding those as well?
Yeah, thanks for that question. I think it's very important to have a sense of relativity here and comparison to India and its peers, right? If you look at a growth number of 6.5% for this year, this clearly puts India in terms of growth compared to other emerging economies as a clear outlier. It probably ranks, top few in the world in terms of its actual growth momentum. And I think that's very key for us. Of course, there could be some divergence in the economy, as you put it. Urban sector is perhaps not growing as quickly, but a lot of the growth is rural and so forth. But if you actually look into the detailed numbers of FDI inflows, especially last calendar year, even though net FDI numbers doesn't look so great, but actually net gross inflow actually continues to be very strong. Coming into sectors like services, into financial services, consulting, IT. We see a lot of that still keeps coming in. I think that certainly speaks to the fact that investors still have a lot of confidence in India as an attractive investment destination, especially the fact that you have a very large domestic market, and also the fact that the middle class is getting larger and larger. So all these are factors for investors to look at India and to come in to invest in various industries.
And Yi, our last question before we let you go, and thanks so much once again for your time. What's the one metric you'll be watching most closely for India in the next fiscal year?
Right. Yeah, great question. I think actually we pointed it out in our outlook statement. It will probably be the deficit that we are watching out for, how quick the pace of consolidation is. One thing also we're also watching out for is the pay commission's recommendations to see how what kind of deficit level we're going to be talking about, recommended by the Finance Commission, and also in terms of its recommendations to states and also to central government in terms of the revenue sharing arrangements and things like that. So we'll all be watching out for that as well. But in our outlook statement, I think we put very clearly that future potential upwards will continue to rely on. Will be dependent on India being able to keep up its fiscal consolidation efforts, continuing to focus on its infrastructure investments. Also at the same time, having a very conducive monetary policy environment and having inflation being kept under control as well.
Right, Yi Fan Phua, thank you so much for your time and for actually breaking that down for us so comprehensively. We'll continue tracking this and can keep coming to you for all of your insight and analysis.
Most welcome. Thank you.
And that's a wrap on this edition of Profit 360. Stay tuned to NDTV Profit for more news and updates.
मुझे तोड़ लेना वनमाली, उस पद पर देना तुम फेंक, मातृभूमि पर शीश चढ़ाने जिस पर जाएं।
वीर है, क्या बात है भाई, वाह वाह वाह। अगर चीरोगे ये सीना धड़कता देश निकलेगा, मैं वो हनुमान हूँ जो दिल में हिंदुस्तान रखता हूँ।
भूल गए क्या युद्ध भूमि में कीमत बड़ी चुकाई थी।
तुमने तो अपनी ही मर्जी से वतन छोड़ा था।
तब ये वर्दियां खड़ी थी तान करके छातियां।
खून माटी से जा मिला वरना आज सिंदूर ही नहीं होता।
जय जवान जो मैंने शुरू किया था ये एक्चुअली, मैं दोबारा आया हूँ आप लोग से मिलने के लिए। मुझे बड़ी खुशी है आप देख रहे हैं यूट्यूब पे मेरी फिल्म। वाह क्या बात है, क्या बात है। देखिए जय जवान मेरे साथ 15 अगस्त को सिर्फ एनडीटीवी पर। जय जवान जय जवान, जय हिंद जय हिंद।
They're the force behind some of India's most respected business empires. But you've rarely heard them speak. Now, for the first time, these leaders open up on succession, conflict, governance, and inheritance. Join me as we step inside boardrooms and living rooms of India's most enduring family businesses for real stories, raw conversation, resilient legacies, building legacy.
Hello and welcome. You are watching KYC. I'm Harsaita, and on behalf of the entire KYC team and on behalf of the entire of NDTV Profit, we all wish you a very, very happy Independence Day. Of course, we're Indians, we're proud of that, and yeah, just spelling it out. Anyway, we'll start off with the KYC today, and it's a stock which has done extraordinarily well for investors but has delivered an outstanding set of numbers as well. The Q1 numbers really stood out. Very little in terms of criticism that one can pull out where a Muthoot Finance's numbers for Q1 is concerned, and therefore deserving and warranting a KYC to try and understand whether there is still some bit of re-rating possible on this one or not. And that's my first question. How much of the growth is driven by the rise in gold prices? They've done a 40% loan growth in the gold AUM. That's what's driven the overall AUM higher. And I want to therefore understand whether some part of this or a larger part of this is driven by gold price rise. The guidance, viewers, mind you, was that they will do a 15% growth in FY26. They have done 10% QOQ in Q1, which means that there's very little left in terms of growth to meet and beat that guidance. Very likely they will beat that guidance, and therefore I'd want to know whether the growth expectations for FY26 are now revised. We've seen a couple of analysts come out and talk about a 25% growth possibility in FY26. I'd want to know whether there's a formal change to the guidance or not. The third piece is therefore, is this a sustainable kind of performance? This beat across all parameters, can this sustain for maybe another 1, 2 or even 3 quarters? And if that is so, is this a blue sky situation, or can we see a more sustainable kind of a performance where the type of performance that we've got in FY26 is concerned. Can we get used to that or not? Or is this just a pure blue sky quarter and we'll start to see normalization as early as Q2? Because that will mean that some bit of the reaction today may not be fully warranted. The fourth piece is with regard to margins. Margins are aided by credit rating, or is it falling on the back of, or is it rising on the, or is it aided by the falling repo? What is it, and how much can I attribute it to each of those parameters? Because we've seen a couple of credit rating agencies upgrade the counter, so maybe some of that also rubbing off on the margins. I'd want to know that. How should one look at yields? The gold lending business is unique. When you have a customer who will come to a gold lender, he'll come in and he'll give you loans, or he'll give you the gold as a lender, and you'll give the borrower a loan, right? Now the value of the gold goes up, which entitles the borrower for a larger loan amount, right? But the rate largely will still likely be the same, and that's what I'd want to know. Whether the rate is also actually tweaked when the loan rates go up, and when a borrower comes in and borrows more money against the same quantity of gold, can the rates remain the same or can they be tweaked? Practically, how does Muthoot do it? And therefore, where do yields go as a result of this? Are they benefiting from that, given that yields have remained on a higher note and the repo has come off sharply post that? Credit costs. What should one make of it, given that they are undertaking diversification? Can we expect the kind of credit cost number that they've clocked? I know probably we'll analyze the more standalone numbers, and maybe at a console level the credit costs are higher and most of the other business are loss making, but I'd want to understand what the strategy is with regard to the diversification as well as the credit costs on the back of this diversification. So that's my sixth point. My seventh is with regard to the possibility of an upside surprise on ROAs. Now, this could be a positive for FY26, and sustainability of that for FY27 is also something I'd want to know. So all of that is what we'll try to explore today on KYC. It's a long one, but let me start off with the parameters. Before the parameters, what the company does. I'm going to first start off with a quick overview. It's India's largest gold loan company. It's got a 135-year legacy, headquartered in Kerala, has nearly 5,000 branches, customer base of almost 2 crore, larger focus on rural and semi-urban markets is what it has. In terms of product, the core product is gold loans. Let me illustrate how much of gold it does. Around 1.3 lakh crore is its total book size, out of which 1.2 lakh crore nearly, 1.12 lakh crore nearly is gold loans. And Muthoot standalone is around 1.2 lakh crore. So when you're looking at it in the overall scheme of things, 80% plus is gold loans. And the growth there is what is driving the overall AUM growth, understandably, because just the size of the gold loan book is extremely large, and therefore no matter how fast some of the other segments grow, gold loans will really dominate in terms of the growth number, and therefore a 40% YOY growth, you can't do it without a gold loans, and therefore that's how it stacks up. In terms of what gold loans are all about, well, they're fast, flexible, short-term credit. I explain as to how a customer comes in, gives in the gold is valued 70% or below of that gold value is given to the customer as a loan. Broadly, that's how the business model works. In terms of others, well, you have personal loans, you have business loans, loans against property. There's money transfer and collection services. They do insurance distribution, affordable housing loans, microfinance loans, vehicle finance loans. But broadly, it's microfinance, housing finance, and unsecured. That comprises of maybe 10% of the book of a Muthoot. Outside of that, pretty much a larger chunk of the loans is gold, which they give out. In terms of the core model, I did explain this model, but let's quickly have that. Customer gives gold as collateral, he gets cash, the branch network collects, evaluates, safely stores the gold jewelry, and if the customer defaults, the gold is auctioned to recover dues, and therefore you likely not see customers defaulting because the value of the gold will always be larger than the value of the loan plus interest that the customer owes. That's broadly the way in which it functions. Now let me start off with the key metrics as well. Try and explore what are the metrics we look at. We look at income statement, balance sheet, asset quality, operational metrics, shareholding, street cred, street coverage, and valuations. We'll cover all of that. We'll cover all of that in terms of the key metrics where a Muthoot Finance is concerned. Let's start off with the income statement, and I'll first look at Q1. And Q1 is essential because the kind of performance they've delivered in Q1 is extremely strong. You'll see it on your screen. 51% net interest income growth, 20% sequential. Again, you'll see that your interest income is rising much faster than your interest expense on a sequential basis. That's what's driving that growth higher, and that along with the 10% QOQ AUM growth is just giving a new fillip to that NII absolute number, which is what is playing out on operating income, which has gone up by 30% QOQ, 63% YOY. Also, your OPEX hasn't inched up in a significant fashion, and therefore your OPEX to assets has come down. We'll look at those metrics as well, but OPEX to assets has come down, which is helping the operating income number. Your provisions largely have come off, you could visibly come off, and therefore you're seeing that surge in profitability, 90% growth in terms of profit after tax. These are standalone numbers. But now let's zoom out, as we always do on a KYC. We don't look at it from a 1 year lens. We look at it from maybe a 3 year lens. And that's what you're seeing in terms of the 3 year picture up to FY25. So why Q1, FY26, very solid numbers. That's the number that we're looking for in terms of the FY25 number. The total PAT standalone in FY25 was 5,200 crore. They've done 2,000 crore in Q1 of FY26. That's why you're seeing the kind of reaction you're seeing. But that's how it's actually played out. And what you're seeing over the slightly longer term with a slightly zoomed out lens is that this business is otherwise not grown at a very sharp pace as some of the other NBFCs have grown. And understandably so, because it's tilted towards gold, and therefore gold prices going up is certainly one of the metrics that you look for when it comes to growth. It's also intense competition, higher yields, and therefore you've got some of these banks coming in and trying to disrupt the marketplace. You've seen an SBI come in aggressively with regard to gold loans, on the larger banks coming in and trying to build a gold loan book. And then you have some of the other NBFCs as well, Capri Global, etc., which have come in and tried to disrupt. And which is why you're not seeing the kind of numbers that we've seen in Q1 FY26. And therefore, we'd want to understand what's changing. But that's broadly the case. But FY24 to FY25, we've seen very good growth. And that is also to a certain extent because of the way the gold price has moved. That's one. And second, it's also because of competition coming off slightly in the gold lending business. Both of those have aided some of the numbers where FY25 is concerned. But the 3 year view, not looking as impressive. We'll be cautious on this one. We'll give it a neutral where the income statement is concerned. Let's look at the balance sheet though. And the balance sheet, again, what you'll see is that the growth has been extremely back-ended, but there has been growth and the growth has been strong. This is, of course, Q1 FY26 numbers. Let's look at the 3 year numbers as well, and that will give you a better picture. The growth has been good. It's been around 30% on a 3 year CAGR basis, and therefore it's positive where the loan asset growth is concerned. Also, your capital adequacy is fairly healthy. Both of those metrics adding up fairly well, but the growth has been back-ended, which is a maximum part of the growth has come in between FY24 and FY25. And that's why the tilt in the 2 year CAGR is more back-ended than anything else. That's something you want to keep in mind as well. But we've given this one a clear thumbs up. Let's talk about asset quality. Very stable where asset quality is concerned. You've seen NPA ratios largely been between maybe the 3.4 to 3.8% range, so it's fairly range bound. Your net NPA or your ECL percentage also has been fairly range bound, so no complaints there. We've given this a thumbs up. Of course, it's a risky business, but the stability with regard to the way in which assets have moved is important. Now, mind you, when you are looking at a lender, you don't necessarily get worried if the NPA ratios are high. You get worried if the NPA ratios fluctuate too much. That's what should worry you. If the NPA ratios are high, but if your margins are very, very high, that should take care of some of the credit cost. That's the better way to look at lenders. And that's why, even though it's a 1.5% kind of ECL percentage, I wouldn't be too worried about it. Simply from a perspective that some of the other metrics also matter when you look at asset quality. And that's broadly how one looks at it. So we've given this one a thumbs up purely on the basis of stability. Now let's look at some of the key metrics. The margins, again, largely stable across cycles, 11.4 to 11.5%. Margins have inched up now, and I'd want to know the reason for that. ROAs, largely again stable. Just look at the stability on the ROA. Look at the stability. This is of course Q1 FY26 on your screen. Very, very strong numbers. But let's switch focus. Let's look at the 3-year picture. And on the 3-year picture, you'll see far more stability in terms of where the numbers are. There you go. The ROA number, fairly stable. 11.23% is incorrect. The FY24 ROA is 5.84%. So between 5.7 to 6% is broadly the ROA range. And when you're looking at yields as well, it's been largely stable. It's not been too choppy. The cost of borrowing has certainly gone up as a result of the repo inching up between FY23 and FY25. Spreads also have largely been maintained. That's the better metric to look at it. So again, a thumbs up. It's tough to have that kind of stability in a business like this, in the lending business, and we've seen that. Shareholding pattern, and when you're looking at the shareholding pattern, fair bit of stability there as well. Lots of skin in the game that promoters have, and therefore we've given that a thumbs up as well. 73% owned by the promoters. FIs have a decent amount of interest, so do DIIs. Very small public interest in this one. Let's talk about the street cred now. In terms of returns, 1 month there's a 4% return, 3 months 23%, 6 months again 23%, 1 year you've seen a 52% return on the stock price. But the 5-year stock price is up just about 2.2x. So you've done maybe around 16% or 17% in terms of returns, which is fairly healthy. But when you compare it to the benchmark and what the benchmark has done in the last 5 years, mind you, compared to 2020, of course, there's been some bit of underperformance. And therefore, again, on the street cred point, we've given it a neutral, largely because the 5-year performance hasn't lined up as well with the index as ought to be. Let's look at valuations now. And when you're looking at valuations, you look at a Muthoot and largely look at a Manappuram, right? These are the 2 largest gold lenders and therefore businesses which are more comparable. You look at Muthoot, much higher priced in comparison to a Manappuram when you're looking at the multiple, right? But the multiple shrink is going to be extremely large. So 1 year forward price to book is just 3 times versus the 4 times number currently. You're going to see that shrink largely due to profitability coming in. And second, Muthoot has been relatively more stable compared to peers in terms of performance as well as in terms of the way it delivers profitability and ROA. So all of that helps it stand out in terms of the multiple that it commands in the industry. So surely something that you want to look out for, but surely something which is slightly expensive compared to peers. You also want to keep in mind that the ROA is 5.5% plus for a 3-time book, 1 year forward book company. So that's the other piece you want to keep in mind. But of course, we will try and get a better perspective from the management on what they think. This is street coverage now. 15 buy calls, 6 hold calls, 4 sell calls. Average return is -3%. Given the buy calls that are there and given that we might see tweaks with regard to target prices as well, already starting to see that, we've given this a neutral as well. But largely the upside, according to analysts, remains capped, at least for the moment. Let's sum it all up. Let's try and put it all together and give you a full picture. No thumbs down. That's the one piece which really stands out. But outside of that, you've got all of those neutrals and thumbs ups, giving it a 6 out of 8 on the KYC rating. Let's go across. We have George Alexander Muthoot, Managing Director at Muthoot Finance, joining us. Pleasure, sir, speaking to you. This is Harsh here. Let me first start off by understanding this very, very strong loan growth that you've clocked, 40% YOY, 10% QOQ. How much of that attributable to the increase in gold prices, and how much of that is actually attributable to new customers and existing customers taking new loans? Give us that perspective.
Thank you. Thank you. So, in the last 3 quarters, we have seen good growth coming from good demand coming for gold loans. I think the demand is the most important thing here. The demand is coming mainly because gold. One is the availability of funding. The fund availability with people in the last 2-3 quarters have been low, especially with regard to unsecured lending. The regulator, etc., has been actually cautioning all banks and NBFCs to reduce unsecured lending, especially the personal unsecured loans, the microfinance loans, and even the credit card loans, etc. The Reserve Bank has been cautioning. As a result, the availability of funding has been low in the last 2-3 quarters. So people have chosen to take more of gold loans. And the gold price, which is already about 40% high in the last 1 year, there is always, every day, at least 3 news items in the newspaper about gold price, about gold loans. So people are now getting more and more interested to utilize the ornaments they are having to take a loan. That is the demand part of it. The second is the gold price. Personally, people who are able to get a lesser amount earlier can get higher amounts today. But not necessarily that everybody should take the maximum amount available. Today, if you look, our loan to value, although we are able to lend up to 75%, it is only 60% of today's price, or 61%. That means everybody has not borrowed the maximum 75%. People will borrow only to the extent they require, and they feel they can repay. The third point is again about the regulatory regulations. The new final regulations which came maybe in a month back is, if you ask me, it is quite gold loan business friendly. It is gold loan business friendly both from the point of the customer and from the point of the lender, whether it is bank or NBFC. In fact, today a loan up to 2.5 lakhs, the new regulation says can be given with least formality. And that is what I think people need, and that is what I think is what the Finance Ministry as well as the Reserve Bank, the regulator, want. That is a clear signal that this gold loan business is being favored and maybe favored by the regulator. So these three things which work together in the last 2-3 quarters have been responsible for the good growth in the gold loan business. Not only for Muthoot Finance, but also for many banks and other NBFCs. Of course, Muthoot Finance was able to do better because we have a 5,000 plus branch network all over the country and a 30,000 dedicated. So that is the reason why the gold loan growth has come.
Sure. So let me ask you what the expectation therefore should be in terms of loan growth. All of this aiding your numbers, FY26, you've guided 15%. Does that change? That's my first question. Second, for an investor who's going to hold your stock for the next 3 years, what's the growth expectation that he should pencil in?
Yeah, of course. Our job mainly is to run the company well.
Yes.
मुझे तोड़ लेना वनमाली, उस पथ पर देना तुम फेंक, मातृभूमि पर शीश चढ़ाने जिस पर जाएं।
वीर अरे क्या बात है भाई, वाह वाह वाह। अगर चीरोगे ये सीना धड़कता देश निकलेगा, मैं वो हनुमान हूँ जो दिल में हिंदुस्तान रखता हूँ।
भूल गए क्या युद्ध भूमि में कीमत बड़ी चुकाई थी।
तुमने तो अपनी ही मर्जी से वतन छोड़ा था।
तब ये वर्दियां खड़ी थी तान करके छातियां।
खून माटी से जा मिला वरना आज सिंदूर ही नहीं होता।
जय जवान जो मैंने शुरू किया था ये एक्चुअली, मैं दोबारा आया हूँ आप लोग से मिलने के लिए। मुझे बड़ी खुशी है आप देख रहे हैं YouTube पे मेरी फिल्म। वाह क्या बात है, क्या बात है। देखिए जय जवान मेरे साथ 15 अगस्त को सिर्फ NDTV पर। जय जवान, जय जवान, जय हिंद, जय हिंद।
They're the force behind some of India's most respected business empires. But you've rarely heard them speak. Now, for the first time, these leaders open up on succession, conflict, governance, and inheritance. Join me as we step inside boardrooms and living rooms of India's most enduring family businesses.
What does independence mean to you? That's a layered question. You could, of course, have a very quick answer to that. The textbook definition, the guarantee of the inalienable rights that every individual must have. What we celebrate every year on the 15th of August. But if you narrow the scope and think about what it means to you, your answer might differ from your neighbors. For me, it is the ability to choose what to do with my time. This is Your Money Matters on NDTV Profit, and I'm Alex Matthew. First, on behalf of everyone here, I'd like to wish you a very happy Independence Day. I wanted to discuss what independence means to different generations, and that's why today I invited into studio Stan Alvarez and his daughter Yulette Alvarez. Thanks so much for taking the time, and along with them in studio also is Rohit Shah, the Chief Executive Officer of GYR Financial Planners. Thanks so much to all of you, and wish you all a very, very happy Independence Day.
You too.
You know, so the idea was to get very different generations. And Stan, you're 63, you celebrated your birthday this week, so happy birthday as well.
Thank you.
And your daughter, your youngest of three, is 22. Yulette, you're 22. So this is already and also Rohit, if I can throw you in the mix. Sure. You're from a very different generation. I'm a millennial, so we've got quite a mix of everything. I want to start with you, Stan. As you look back, when you were Yulette's age, and you were looking forward at the life that you would lead, and you were looking for gainful employment, and you see everything that is happening right now, and you juxtapose the two, how different is it?
As a self-made man, in my time, our priority was doing our best, getting the nearest job, making money, maybe not much of it as was possible as at that time, but doing your best, doing new things, planning for them years in advance. So you could take the leap when time became ripe.
When did you start working?
Well, I was involved in as a techno geek. I was involved in a lot of things right from college days. I used to, in the audio field, the lighting field, I used to build my own stuff. And I had a lighting business right in my college days.
Okay.
The disco era.
The disco era. Can you relate to that, Yulette?
That is something I have grown up seeing. I've grown up seeing my dad innovate and make something new. And a common term for it is jugaad today, where people like to put things together. But to me, that's just my father. That's not jugaad.
Okay. So I hear that you have two older brothers, one who is pretty much on the cusp of being millennial, and you are Gen Z. You are 22 years old. You've just started working. I'm just trying to understand from you, and we're going to talk about financial freedom. We're going to talk about independence. If I were to ask you the question, what does independence mean to you?
To me, independence has many meanings, but I'll say the two that stand out to me. One of them is that ease of expressing myself through what I do, through the way I live and dress, all of that. And the second one is to not be forced into a choice, to have all of my choices open. I think that is one of the most important meanings of freedom to me.
Okay, and that you mean by employment, what you do to earn your living, is that what you mean?
Through employment, even through, if say today I'm fed up with my job, I want to explore something different. I don't want to be backed into a corner because, oh wait, I don't have money, I cannot jump onto something else today.
Okay, I want to ask your dad whether he had that choice, because I think a lot of people from your generation, Stan, talk about the fact that they did what they needed to do to put bread on the table. They didn't really have too much of a choice. If, for example, you had 3 children, you had to bring them up. That was your foremost priority. The job market then was very, very different. You started your own thing. But would you say that your objective at that time was not, when can I stop working?
Yes, thought always occurred to me, because when I reached that era, there were people already saying we are going to retire at 45.
Really, even back then?
Yes. There were people saying that, and you see YouTube, like maybe today you see on YouTube, there were similar stories going around, and you're saying, why can't I also do it?
Oh, okay. Wow, so that's interesting. The fact that it stayed the same. Are you surprised by that, Rohit? This is not really a new concept. People wanted to stop working. Who wants to work, right?
No, that's a news. That's definitely a surprise, Alex, because what has happened is that, the way technology has gone, the new generation has become very aware. The information is available to them. And, they all have dreams and desires that don't want really to be into this 12 hours run. The other thing that you will notice, Alex, is that, what they call typically as a 1-2-3 formula. You hire one person, give him the double salary, get him to do the work of 3 people. And that's the reason what everyone wants, that when can I be financially free so that I can really do something else? And I think that's the change that I see in this generation.
Okay. Tell me about your interaction with your other children as well, Stan, because I'm sure that you would have learned things from them as well. Do they think differently from your daughter, or do they have a more or less similar outlook? And what are the kind of conversations that you've had about money, if at all? And what is the kind of advice that you've given them? Because you come with a very different lens and experience of dealing with things.
Yes, handling each of the 3 of them have had a different outlook of life. As I say, all 5 fingers are not the same.
Right.
I accept it that way. But yes, each one had varying degrees of ambition or achievements. But our overall advice to them was keep stability.
Stability, okay.
Keep stability. All of them started working the minute, they're all engineers. They're all engineers, 2 of them masters, she's just finished engineering. But our priority was that, as it may sound odd for today's, that don't laze around. Keep yourself busy, get a job the minute you pass out.
Your dad says it might sound odd. Do you want to comment on that?
It is, I guess people do find it odd because I started working fairly early. I started working just as I finished my second year of engineering. Not out of compulsion, it's just that there was an opportunity. I felt I can take this opportunity. And my friends thought it's a little insane because juggling a whole like 8-hour job with college was exhausting. And like, yeah, it is odd to people.
Okay. I want to talk about investments, and I'll come to you, Rohit, in just a bit. But first to you, because that will set the context for the rest of this conversation. Do you invest at all?
To a limited degree. I am still learning what they did and trying to decide what would be good for my money.
Okay. So when you think about your investments, of course, I'm not asking you to say what you've learned, but of course, you're exposed to a lot of information. You look at the various options available to you. For example, a lot of your cohort, your generation, look at cryptocurrency or look at relatively new financial instruments very differently from what your dad might. So what are the things that you have been attracted to when you talk about investments?
So in investments, I think to explore the riskier ones, you first need to ensure that you have a decent amount of the safe ones. So I think one of the safest things are FDs. It's very old school. My mom always says that, you know, every couple of months when you've saved up enough, put in an FD.
Yeah.
Later do what you want with your money.
So that's what you're doing now?
So that's what I've been doing so far, like playing catch up with the FD gang.
This is a 22-year-old. Rohit, are you surprised by this answer? 22-year-old investing in fixed deposits because her mom has told her every couple of months, whatever surplus you have.
I do agree that FDs are not, to some degree they do beat inflation, to some degree they're just preserving your money.
Wow.
But it's debatable.
Rohit, you want to comment on this?
We need to define what is safe.
So you want to talk about it? Why don't you do?
And I think what we really have to think more about it is that, and I think when we are starting up, fixed deposit is definitely a good idea because you need an emergency corpus.
So, but let's talk about that. Early on, did you contemplate investing in equity? Did you build an equity portfolio? Everybody looks at the relatively older generation. You're very young, Stan, I must say that, but you've had more years than I certainly have. The opportunities at that time were to invest in early companies, right? In companies that were starting out on their journey. India was not necessarily growing as fast as it is and has been over the last couple of decades. So you had the opportunity, for example, investing in Infosys or TCS or any one of these large companies today. What did you think about that?
I may have a different story for you.
Please.
Because we belong to a time where our priorities were looking after our house, looking after our dependent elders, and also your career.
Yeah.
I used to invest in electronic equipment to...
So you invested in your business?
Business, or even know my own skills.
Right.
To further my skills. And so there was, although I used to study the full investment page of Times of India, all the stocks, everything like that. But we said we keep it for a later date.
You always push it down the road because you didn't have the surplus to invest.
We may have had, but then there were other priorities crowded that came in between.
That's very interesting.
Like at one juncture in my life, it was, okay, I had, say, 50K. That was at her age, one fine day, suppose, or even less, maybe a little younger than that. And I decided, do I buy a bike or do I fix up my house?
And you chose a house?
Yes, because I said the bike can, in those days people just pick up a bike and walk off or things like that. And I said I don't want to lose that.
Yeah.
So shall I do something which is lasting?
So, but this beautifully explains how people have a very different mindset, right? So, can you even contemplate that today, Yulat? And I'm asking this effectively of you because you have a very different approach to the earnings that you have. You don't have the compunctions that your dad might have had at that time. He's taken care of his own requirements and he's not dependent on you at all. And so therefore your income is your own. Can you contemplate the fact that when he was your age, that didn't exist?
It seems like a like a very scary choice, I'd say.
Yeah. So Rohit, why don't you talk about this? Because ultimately, this is the definition of different generations within our country right now, right? Because you have a generation now that is earning, that is comfortable, where a base or a foundation has been created for them that allows them to elevate to the next level. Why is that so important today?
2-3 observations, Alex, and if you really think about, the time that Stan comes from, that generation, not specifically him, but I'm referring to that generation. See, the society is also structurally changing from a, multi-family, joint family system. We are now sort of shifting to nuclear. The other is look at the income profile. Look at the disposable income, the way it is rising. And he said it in terms of the priorities. Then, how do we really look at it in terms of where is the question of saving? Whereas for her, that's becoming an important question that, one, they're not a sandwich generation. For example, in his case, parents as well as planning and probably in some cases even taking care of the children.
In his case, absolutely that was the
and
case,
this generation doesn't need to. Stan is already taking care of himself. And that's the reason these questions are coming. I have a higher disposable income, I really don't want to do the rat race, and then can I, really be financially freedom? I think that's a generational transformation that is happening.
But I want to ask this, right? Because this then leads me to another question. Stan, you've saved all your life. You've taken care of your children. You effectively don't have financial dependence right now, right?
I shall add into that.
Right.
Both me and my better half have together planned it.
Exactly. So you've done that.
Yes.
What I have realized, and this is true for my parents as well, is that they have a lot of money for themselves, but more or less in a similar situation. But even if I give them money because they're not spending their own, they don't spend it.
Right.
So would you say that your generation has not learned how to spend money?
We believe in constructively spending our money.
How do you define that?
Is don't get something out of compulsion, or just the other person has it. Just get something. If it's useful for you, maybe flashy also, maybe it's something a little better, but it's useful for you.
Do you think that dad and mom spend enough on themselves?
So one thing about dad is he's a person of few wants, but he gets himself the good stuff when he wants to get himself something.
I've gotten my answer.
And what I'm observing, Alex, my mom has stopped buying jewelry because the government now wants 18% GST. Right? And I think the difference is that the lifestyle aspiration is a one-way traffic.
Yeah.
Right? And this generation has beautifully managed it well. Instant gratification, delayed gratification, need versus want. Whereas this generation, we're all into experiences. We don't want to get attached to a location. We don't want to marry to a job for the next 40 years. And I think those are the new interesting combinations coming up.
No, absolutely. So I don't know if it's an interpretation that I have or it's just an observation. It doesn't appear to be the case for the two of you and for your family. But what I've often found is that people of your generation, Stan, have saved all their lives. They've been responsible. But now when it comes to enjoying the fruits of their labor, they've not been able to do that. They're not able to cut loose and say, oh, I want to go to Italy this year. Or, look, I want to go to Kerala. I want to spend 2 weeks in the backwaters.
And
no, it's too expensive. Not now. Maybe next year. Maybe in a few months.
Would that be a function of two? One is a fear, money fear.
Yes.
We all have money fear, right? Will I
have enough money for the rest of my life?
Money will, run off me. The second is it's also a lack of a planning.
Yeah.
Right? Financial planning is 20 years old. In the US, it is 60 years old, correct? And the financial planning for the most traditional families is that a joint family system, which takes care of it. So when we have not done the numbers, we don't know the math, we haven't done a, safe withdrawal rate, systematic withdrawal, then it becomes very difficult to spend the money.
Yeah, and equally, what I found in not necessarily my generation, because I think we've taken a lot from our parents, you have as well. Evidently, you have a lot of the answers that I think I would look for in people of my age. But having said that, a lot of young people say, I'm going to spend now and worry about the future later. But having said that, I'm going to use this opportunity to ask you both to speak to Rohit about how to manage your own finances, because this is the perfect opportunity.
Right.
If you were to talk about your retirement and the next 20, 30 years maybe, do you have any doubts about how to manage your money that you would like to pose to him?
Yes. Yes, we have, as she said some time back, that the FD was the safest or thing like that. We don't go into adventure. But in the current, that we've always been busy 24/7. So putting it, going to some adventurous investments has always been a thought, but not put into practice. But now with a little more free time, yes, definitely. Could you give me some advice on how we could channelize our funds for better returns?
You need to have a conversation with him about how to plan.
Sure. So I'm just simply going to give you, this example that what we see here is basically a currency.
Yeah.
Right? But money is not currency. Money is purchasing power, right? And, in many words, when you think about it, money also reflects our love for the generations to come and for the causes which are very close to us. So the whole concept is that, first level, how can we, build the power of our money, whereas there is a purchasing power. And at the second level, can the money flow like a river? When you see the river flowing downstream, it gets deeper and wider, right? And the money is also like that. It can grow generation to generation. Now, when we think like that and think for the next 30 years, 40 years, which itself could be a very well period that you yourself have, then you will look at it in a very different way and probably start thinking about that if India is going to become a $5 trillion economy and even more, how can I leverage that?
Okay, so therefore I think what he's getting at is you need to have a certain element of equity in your portfolio, because this is ultimately the way that you grow is going to be to invest in companies that are part of the growth story of India, right? So you obviously still have your consultant work that you do, but if you're talking about people like Stan, and of course I'm not asking you to give him exact financial advice, maybe we can do that offline, but for somebody in his context, what are the kind of things that he needs to look at in terms of the amount of money that he should keep at the very least in his portfolio towards equity to ensure that he takes care of the next 20 years and he has something to give over to Yulet as well as the other two children?
So, one is maybe it will be a good idea for you to learn the concept of SWR. And I think this is something that all our parents should take effort and learn it, is that because the whole problem that you have, Alex has, Yulet is going to have, I'm going to have, is that how do we consume our money so that we don't outlive money, money outlives us. So that is an art and science. It's a debate. It is not a settled an issue. But the safe withdrawal rate is the concept. How do you withdraw a certain percentage of your money in such a way that you are able to grow the corpus and it survives you at least for the 3 to 4 decades of retirement? It's a huge debate, as I said, and you can take a number anywhere from 2.5% to 4%, 4.5% based on your risk appetite, based on these different
What is this 2.5 to 4%?
Right. So suppose if I have 1 crore and if I take a 3% at the age of, let's say, 65, then I can withdraw 3 lakh rupees per annum from the corpus, which basically means I can do an systematic withdrawal of roughly around 25,000 per month.
Okay.
So that's a good starting point for a 3 to 4 decades of retirement planning.
Okay. To come to you, Yulet, because you've got so many years ahead of you, I think this is the optimum and the most ideal opportunity for you to look forward and say, this is when I wish that somebody had this conversation when I was 22, right? I started very late, but I've still benefited because I started when I did. Rohit, any advice that you would give to her as she's starting out? She's been doing fixed deposits, which is a great thing to do when you're starting out, because she's creating the habit of saving. And she's already got a great foundation. I think her dad and her mom have given her excellent advice, maybe her brothers as well.
So one thing to Yulet's credit, somebody has said, one of the very maverick investor, I think Joel Greenblatt has said that one of my largest position is not where I'm expecting a huge money to be made. I'm expecting money to be not lost. Morgan Housel says, compared to other people, I have a higher element of cash. And I'm okay with that because it allows the rest of my portion, which is aggressive, long-term equity, to have a higher longevity. So when you have money with you, that's a power in today's world. So that's a great thing to do. My advice to you will be that learn this subject, study this. Depends upon what is the method you like to learn. You read a book, you pick up a podcast, you do YouTube, you read up on AI. But the whole idea is, for example, Morgan Housel has done very good work area, and there are a couple of very, very deep, insightful, resources for you to get started.
But I'm specifically talking about her investments and how she should approach that, because just the concept that I think is very powerful of obviously compounding, but what Warren Buffett talks about when he says that compounding is like a snowball on snow, right? It gathers and becomes bigger. I'm paraphrasing here, but what you need for it to become much larger is a long hill. And so therefore you need to start early, as he did at the age of 11, and you're 22, not very far away, or you need to live long, and he's over 90 years old right now. So, and he's got 20% per year, which is something that people have gotten over the last 5 years. I'm not saying that that's necessarily something to aspire to, but you can get 12 to 15%. That is the advice that I'm looking at.
I'm just thinking, because if you look at this generation, nobody is really caring about retiring at 60 and looking at the NPS or EPF. For them, 60 is not retirement, first of all. It's much earlier. But I think most of them probably tend to have only 3 goals. One is they want to have money to get married. 2, they want to have money to buy a house. 3, they want to have money to buy a vehicle. So the 3 goals.
Is that relatable, or is that not true at all?
My priorities in life are more of I'm saving up for an education.
Yes.
Because education is very expensive.
Yes.
Lovely.
That's my first priority in life right now.
Right.
Second one is maybe stepping out of my parents' house a bit. Like rents are ridiculous right now. So if I could pull that off maybe a few years from now, that would be amazing for me.
So 2 priorities essentially.
Yeah.
And you're not worried about retirement at all, but you'd like to stop working at some point.
It'll come when it has to come.
There you go. So, but if she starts today and she's got these immediate goals and she saves for 22, 23 years, at 45 she's already got a humongous corpus to fall back on.
That's right.
So, but last bit of advice on how she can achieve her immediate goals.
So, small equity exposure could be a good idea, because you need to get comfortable, NAV, fluctuation, understanding the style. But if your goals are nearby, like education, like you want to live independently, then probably you need to build a corpus which is not dependent to the equity markets, because in the short run, that's a problem. 2 years, 3 years, it's a problem. But the full cycle is 5 years, 6 years, 8 years. And then, when we look back, we are always wondering that whether we are in an up cycle, whether we are in a late cycle, whether we are in an early cycle.
Time is more important than anything else. No, I've certainly learned a lot from Stan and Yulette both, particularly Stan, because of the way that he's conducted himself and the way that you've taught your daughter. It's commendable. Rohit, thanks so much for taking the time.
Sure.
Of course, this has been a free-ranging conversation, talking about all things independence related and everything else money related as well. Let us know what you think and what you think independence means to you. Here's wishing you and your families a very happy Independence Day. Thanks so much for watching. This is NDTV Profit.
मुझे तोड़ लेना बनमाली, उस पद पर देना तुम फेंक, मातृभूमि पर शीश चढ़ाने जिस पर जाएं
वीर ने। क्या बात है भाई, वाह वाह वाह। अगर चीरोगे ये सीना धड़कता देश निकलेगा, मैं वो हनुमान हूँ जो दिल में हिंदुस्तान रखता हूँ।
भूल गए क्या युद्ध भूमि में कीमत बड़ी चुकाई थी।
तुमने तो अपनी ही मर्जी से वतन छोड़ा था,
तब ये वर्दियां खड़ी थी तान करके छातियां।
खून माटी से जा मिला वरना आज सिंदूर ही नहीं होता।
जय जवान जो मैंने शुरू किया था ये एक्चुअली, मैं दोबारा आया हूँ आप लोग से मिलने के लिए। मुझे बड़ी खुशी है आप देख रहे हैं YouTube पे मेरी फिल्म। वाह क्या बात है, क्या बात है। देखिए जय जवान मेरे साथ 15 अगस्त को सिर्फ NDTV पर। जय जवान, जय जवान, जय हिंद, जय हिंद।
They're the force behind some of India's most respected business empires. But you've rarely heard them speak. Now, for the first time, these leaders open up on succession, conflict, governance, and inheritance. Join me as we step inside boardrooms and living rooms of India's most enduring family businesses for real stories, raw conversation, resilient legacies, building legacy.
In conversation, Sunil Bachani. Mr. Bachani, thank you so much for speaking to us here. And at the outset, I mean, you're the poster boy, right, of what India wants to do when it comes to electronics manufacturing. There has been some turbulence in the recent past, right, the last 1 month, particularly with regards to tariffs in the US. Is this a serious speed bump? Is this something that we as a country tide over, and particularly the sector which you represent?
So I think, these are exciting times and challenges for us in the industry. Exciting, because we sense that we are sitting on a very large opportunity of making India the next hub for manufacturing of the world. And why we are very confident about this, because we, in this very short period, after PLI was launched, we have created a massive scale for manufacturing the finished products, especially if you look at a product like mobile phones. Where there is a substantial capacity that has been created in a very short period of time. And what is happening now is that the industry is working very hard to ensure that a supply chain ecosystem is set up. So we ourselves in Dixon are in the process of setting up plants for camera modules. We've already announced the major stake in a company which is already doing that. We are in the process of setting up a new facility for doing display modules. We are setting up a new facility for doing mechanicals, and we feel that once we have done that, we will take up the value addition to almost 40% in a product like mobile phones, which was hovering around 18%. And no country to my mind has done this in such a short period of time.
Sure.
So I think it will be a great thing done by the industry, and thanks to the government for the proactive policies due to which this has happened. Well, now to talk about the challenges. Well, tariffs are obviously a challenge, but as of now, the way things stand, mobile phones are in the list of exempted categories or exempted products where there is no duty being charged on India or on countries like Vietnam. Yes, China is paying that tax of 20%, with the fentanyl tax, which was not exempted. So right now, this is how things stand. But as we speak, this list is likely to be reviewed at the end of August. But we are hopeful that the exemption will continue even beyond that period.
I'll be forced to ask this to you, but sure. in case some of the US majors are forced to review their investment plans into India, if indeed the exports out of made in India products, mobile phones, etc., what have you, does come into effect, does it slow down what otherwise could have been a very nice pace of growth, especially for you, which is like you capture the imagination when it comes to mobile phone value addition? So therefore, this question to you.
So if you look at the hubs, the key hubs for mobile manufacturing is, of course, China, Vietnam, and now it's India. And we feel that because of the huge advantages that the country offers in terms of a large domestic market, an ecosystem already developed, the government is very keen to promote manufacturing. We feel because of these reasons, India will continue to be one of the major hubs for manufacturing mobile phones. See, let's appreciate that these ecosystems are not very easy to create, right? And besides the two other countries that I talked about, there is no other country which is giving that kind of impetus to mobile manufacturing. So I feel this issue is a temporary issue, and hopefully things will settle down. And once things settle down, I can assure you there's no stopping us.
Got it. Could you, there is so much of talk around how you yourself are trying to partner with big names, getting big names into India for what you just said, a mobile ecosystem. Sure. Can you help us imagine what that could look like? Because for a layman, what she or he is seeing is a company which is manufacturing back-end parts for mobiles, one by one, adding on new things. What do you mean when you say that you are trying to create this whole ecosystem?
Yeah. So I think for this ecosystem to be set up in India for the long term, I think there are 4 pillars which are going to be extremely critical. The first pillar is going to be scale, right? So we need very large scale to be globally competitive. And that's what we'll have to focus on as a company, as an industry, and as a country, right? So issues about land allocation, setting up mega factories, those are the things that they're going to come and play. The second issue is going to be supply chain. So as I mentioned, that we cannot be globally competitive if we do not have a strong supply chain within the country. And that work is already on, and I mentioned about a foray into products, components like camera modules and display modules. So it's headed in the right direction. The third issue is going to be on skills, right? Manufacturing is going to be very, very different from what it is now. And I think it's important that we have a large centers for skilling our people to take on the future challenges on digital transformation, on Industry 4.0. And finally, I think as a country and as an industry, again, we'll have to look at designing more and more products. We'll have to emerge as a products nation. And the focus will have to be on, not just on make in India, but designing products in India.
How far away are we from there?
Well, I think we're not very far, and I think a lot has happened in the last 10 years. But like they say, picture abhi baki. I think the journey has just begun.
No, so let me try and rephrase my question.
Sure.
While you may have borrowed some money from your father back in 1993, if I'm not wrong, as I read, and you built out this company back then, but the real impetus probably came in 2016, 17, as the case may be, right?
Yeah.
So the last 10 years journey, does your next 10-year journey, and for you and maybe for the ecosystem, dwarf what's happened in the last 10 years, you reckon?
Sure. I'm often asked this question, that what happened exactly, that how did this change suddenly come about?
Yeah, right? It's a hockey stick, right?
Yeah, absolutely. And I think, whenever this kind of thing happens, the biggest change that happens is the change in the mindset. Right.
Okay.
Almost 15 years back, our Honorable Prime Minister gave this call that, let's make in India, let's make India the hub for manufacturing. And honestly, before that, I used to find it a task, to go and convince people that, we should be manufacturing in India. So I think once that kind of call comes from the top, things change dramatically, because everybody started saying, that tell us what can we do to make sure it happens. Right, and I think that's what happens in companies, right? That call comes from the top, or that at least that vision is set, and then things just fall into place. So I think that's the biggest change. And of course, the policy initiatives have been amazing. And I think Indian entrepreneurs have really risen up to the occasion and have done a tremendous job. Because I remember, going on my road shows during, when the IPO happened. This is about 8 years back, 2017. And the first few meetings, weren't great at all. I wasn't able to convince them about the opportunity that exists in electronic manufacturing. So I think that was the biggest challenge that time. But I'm very glad that now we have the interest of our investors. Now there are, I think, more than 6 or 7 companies in our space listed on the stock exchanges, doing very well. They've provided good returns to shareholders. And suddenly, we are able to fill a room whenever we go for investor conferences, like it happened today. So that's a positive thing.
Yeah, most certainly. Well, those guys who missed out in 2017 must be ruining their chances. But the last couple of very quick questions, I know you have a flight to catch.
Yeah.
One, I'm still trying to understand. Maybe it's difficult to answer, in which case tell me so, but could the next 10-year journey dwarf what's happened in the last 10 years? Could it?
Absolutely. See, if you see what has happened in the last 10 years, we've just scratched the surface. Right, the numbers that the global market for electronics is $3 trillion, right? And we are at about 3%, right? $130 billion. So this has just started. So what's going to happen in the next 10 years is going to be transformative.
Got it. One last question, Mr. Bachani, because when we are doing this on the eve of Independence Day, India is an entrepreneur-filled country now, a lot of startups, etc. I'm asking you to go into the minds of a Dixon startup founder. Maybe you started in '93, but the real trajectory from 2016.
Yeah.
What's the message that you would give to budding entrepreneurs who kind of look up to people like you and think of how they can make their journey like yours?
Yeah, I think the message is very clear. The next 25 years, 50 years, 100 years belong to India, right?
Okay.
We have a large market. We have large pool of talented people. We have the design skills in India. We have everything going for us. We just need to believe in ourselves. We need to believe in our abilities. We need to empower our people, right? And we've shown that, in factories where we have our Indian operators, and in some factories we have, down south, we have 85% female workforce, right? And they have shown that they're the most productive in the world given the right kind of environment. So empower our people, make a great team, and, just believe in them. And that's it. Things are going to happen.
Great. Thank you so much for speaking to us, Mr. Bachani. I really appreciate it.
Thank you so much. Thank you.
And that was Sunil Vachani, the Executive Director at Dixon Tech, speaking about the company's expansion plans as well as what financial freedom means to him. But now I'm being joined by Rashesh Shah, Chairman, Edelweiss Group. And thank you so much for joining us in this conversation, sir. My first question to you would be, what does financial freedom mean to you?
Yeah, I think India got the independence freedom in 1947, but only in the last 40-50 years we have started experiencing financial freedom as a country, as India has prospered and economic growth has picked up. So for me, for an individual, the financial freedom is about having choices, having options, like whether it's retirement, whether it's career, whether it's you want to send your kids to study in a particular school. When you have choices and options which your financial resources allow you, I would call them truly financial freedom has been achieved.
Very well said. Has the possibility of more financial freedom gone up in recent times, according to you?
Absolutely. I think India always has been a country of savers. We've been good at saving because of uncertainty and all of that. But I think last 30 years, India has started investing. And I think that converting savings into investment is what really fast forwards the financial freedom. Initially, you need to save to achieve financial freedom, but only saving, which until about 30 years ago was the only way Indians could achieve financial freedom. Now we can have financial freedom by combining savings and investing. And I think the country has learned, and thanks to media channels like all of you, people are getting comfortable with the concept of investing. And I think that is what has been the key change in that. And that does bring the financial freedom or achieving the financial freedom a lot faster.
All right. And speaking of investing, do people need to change the dynamics of their investing in order to achieve financial freedom earlier in life?
Yeah, I think it's constantly evolving, Neera. I think the investing dynamic has improved a lot in the last 5-10 years as compared to last 30 years with the advent of mutual funds and new insurance products and AIFs and InvITs and REITs. I think the optionality has gone up. So, what you save, if you can convert that into really good long-term investment, it helps the country because it does facilitate capital formation, allocation of resources, but it also makes sure that you have a lot more corpus when you retire or in your future. So I think that way investing has evolved a lot, though I think India still has a long way to go. We need bond market. See, basically all investment needs are either growth or income. Now, in India, growth has come through equity markets, through SIPs and the mutual funds, through private equity options, all of that. So I think we have shown investors how to access growth. But the other part is income. Now, in income, currently we still are dependent on bank deposits, which has its own pros and cons, or things like liquid funds in mutual. Now we have InvITs and REITs and others which are coming, which are giving you income opportunities. They may not be growth opportunities. And I do think that in order to achieve a financial freedom, especially in a volatile world, I think investors will need a good mix of growth investments and income yielding investments.
A good mix of growth investments and income yielding investments. Then, can you build out a financially sound, problem-proof portfolio for our viewers?
See, again, it's a function of how old you are and what your objectives are. But I would assume that if the most common objective is, retirement savings, and let us say you start investing from the age of 30. So at 30, I would be largely equity led. And as you get closer from 30 to 60, at the age of 60, I think somebody should be maybe 50% equity and 50% in income yielding investments. So at 30, you should be maybe 100-0. At 40, you might be 80% equity, 20% into income yielding. At 50, you might be 65-35. So you keep on changing as you get older and you get closer to when you're going to use that corpus and that saving. You go more towards the income options. But if you're early on in your life, you want to enjoy the equity option, because all said and done, equity returns in India will be healthy, and especially from an after-tax point of view. So if you have a long-term horizon, equity is increasingly attractive, and we always recommend a good mix of equity and income yielding opportunities.
Definitely, sir. Then would you like to add anything else to your building the problem-proof portfolio? Anything else, a golden advice maybe?
Yeah, I would say I think investing in India is a very interesting game, but it gets easier if you take the long-term view. I think in the long term, India is always rewarded. It may disappoint in the short term. So any investor should make sure that they are able to keep a bifocal view. Keep one eye on the short term, but keep your main focus on the long term, because India has rewarded in the long term. And as all of us focus on our financial freedom, on our financial wealth, I always say that, having seen this for 35 years, I've been investing in the market for more than 35 years. I think along with building your wealth, every individual should invest in their health and their relationships, because I think the golden mix will really allow you to enjoy your wealth. Because if you don't have good health or good relationships, you won't be able to enjoy your wealth.
Thank you so much for joining us in this conversation, sir. And your advice would definitely be taken very, very positively. And viewers, next up, we have a conversation with Ashish Chauhan, who is the CEO and MD of the National Stock Exchange. So let's listen in.
Mr. Ashish Chauhan, just for this very special occasion, thank you so much for giving us the time. We're talking about 15th August this time from the context of financial freedom, and how financial freedom is so important from independence that we want, and as a nation. What are your thoughts on that?
For me, the freedom, many of us don't understand how important it is. The freedom as a country to make your own policies, to live as one group, which makes its own decisions. It's a phenomenal achievement of modern Bharat or India, that 78 years, and there were many people wanted to, at least had predicted that this country will not even survive. But we have survived and thrived, right? And for me, it is an amazing thing that today 20% of all Indian households now invest directly through NSE, and freedom to invest is as important as say freedom to leave, because you need to make your own decisions, and that's where I think today India is on the cusp of a greatness over next 30-40 years, and as Pradhan Mantri is saying that Amrit Kal and Viksit Bharat by 2047, I think we have to all work hard, but we can achieve. And in some ways, this 79th Independence Day for India is giving us that little fillip in our own mind, that all of us have not yet reached where we want to reach, or what is our potential. We have just starting to sort of go towards that, and we have a long way to go. We have come a long way, but we have a longer way to go.
What does financial freedom mean for you?
In a way, financial freedom allows you to see the colors of life. Life has myriad colors to offer. It allows you to see those colors in ways you want to see them. When you don't have the adequate finance, many of your things which you want to see or experience, you may not be able to do. And once you have the finance, doesn't mean that you will be able to sort of experience whatever is there to experience, but at least in case you want to do that, you will have that ability to see those colors, and of course also come through the trials and tribulations of life, because I always say that money is not everything, but without money again you will have many issues. So you need to have adequate money, and for that, once you have money and surplus, you need to learn how to invest.
What is the role you think of stock exchanges to allow Indians to have that financial freedom?
The stock exchange is, the stock market, especially investment in equities, is a much higher risk activity compared to, say, putting money in banks. And that's where everyone who is investing or wanting to invest, we need to explain to them this is a high risk activity. You need to understand about the company, about the economy, about the industry, about the world, and then only invest. And if you don't have time, you can invest through the experts like mutual funds or portfolio managers, but invest you must, because if you have money, it's your responsibility for yourself and your family that your money increases. And in a highly inflationary world, you need to continue to invest so that your money doesn't go down in value. And that's where it's an onus on the exchanges and also other intermediaries to ensure that we take the right message of being there for the long run, not believing in tips, not trading in derivatives for small retail investors. And investor has to be doing investment and not trading. Many times we mix up trading with investments. Buying in the morning and selling in the afternoon is not investment. We have to be there for a long term, probably 2, 3, 5, 10 years. And that's where I think some amount of patience, some amount of understanding has to be inculcated. And that is our job.
Thank you so much, sir, for speaking with us.
Thank you.
Let me bring on board Executive Vice Chairman, founder of Info Edge, Sanjeev Bikhchandani. Sir, absolute pleasure having you here today and speaking with you. I want to start off with the theme of Viksit Bharat. We're looking at another 22 years in terms of a target to become Viksit. What does India Inc. need to enable this to actually happen? What does the startup ecosystem need, and what does India Inc. need?
I think not just for startups, for all industry, for all, including SMEs, for the common citizen, I think the need of the hour is deregulation. And I'm delighted that the government has set up a deregulation commission. It was announced in the budget earlier this year. I do hope, it has a sweeping mandate I do hope the states governments play ball, and I do hope deregulation is done with earnestness and is done with depth and intensity, because I think deregulation alone, removal of inspector alone, can give us 2% additional growth. And if we want to get to Viksit Bharat by 2047, we need to be growing at 9-10%. So deregulation alone can lift growth from 6.5% to 8.5% in my view. So this is a very important agenda. At the same time, what you want to be done to get to Viksit Bharat by 2047, by the time India is 100 years since independence, I think is a big focus on education. Right? The right kind of education, the right quality of education for large numbers of people. I think India has done a great job of higher education institutions, whether it's engineering colleges or it's management schools or others. And it is the products of these higher education institutions that went on to form India's 300 million, 400 million strong middle class, which essentially is the talent pool which drives a lot of India's growth. Now, but there are 800 million more who don't have access to that education and who are poor. So if you can open the ladder of opportunity to those 800 million people by massively scaling up quality education at the school level and then at the college level with relevant knowledge and skills, I think it'll make a huge difference to this country. Then, of course, there is investment in infrastructure, hard infrastructure. The government is doing a good job of it. It needs to continue. I think in digital India, I think the digitization of India has proved to be a great lubricant and catalyst. And that is something which will be leveraged even more. I think 900 million smartphones is good. I think the kind of digital public infrastructure we have got is excellent. We need to do more of it. So you do all of this, and then of course there's whole move towards technology and investing in deep tech and AI. I think India can leapfrog and become a technology nation. We have the manpower. We have enough organizations and companies. We have government organizations and government departments that are doing a good job. So we need to have this massive move towards deep tech.
So you
मुझे तोड़ लेना वनमाली, उस पद पर देना तुम फेंक, मातृभूमि पर शीश चढ़ाने जिस पर जाएं।
वीर ने क्या बात है भाई, वाह वाह वाह। अगर चीरोगे ये सीना धड़कता देश निकलेगा, मैं वो हनुमान हूँ जो दिल में हिंदुस्तान रखता हूँ।
भूल गए क्या युद्ध भूमि में कीमत बड़ी चुकाई थी।
तुमने तो अपनी ही मर्जी से वतन छोड़ा था,
तब ये वर्दियां खड़ी थी तान करके छातियां।
खून माटी से जा मिला वरना आज सिंदूर ही नहीं होता।
जय जवान जो मैंने शुरू किया था ये एक्चुअली, मैं दोबारा आया हूँ आप लोग से मिलने के लिए। मुझे बड़ी खुशी है आप देख रहे हैं YouTube पे मेरी फिल्म। वाह क्या बात है, क्या बात है। देखिए जय जवान मेरे साथ 15 अगस्त को सिर्फ NDTV पर। जय जवान जय जवान, जय हिंद जय हिंद।
They're the force behind some of India's most respected business empires. But you've rarely heard them speak. Now, for the first time, these leaders open up on succession, conflict, governance, and inheritance. Join me as we step inside boardrooms and living rooms of India's most enduring family businesses for real stories, raw conversation, resilient legacies, building legacy.
हेलो बोलिए मैडम, डब्बा ट्रेडिंग कब से चल रहा है पता है मैडम आपको? हम और आप तो जन्म भी नहीं हुआ था हमारा।
We investigated a shady advisory firm that has spent big bucks on advertising on the front pages of national dailies.
ये आपको बिल्कुल उसका ऐसे हल्का सा भी खौफ नहीं है।
मैडम एक बार को खौफ किस लिए रखना चाहिए तो बताओ, कौन सा गलत काम कर रहा हूँ मैं?
After our report, we also saw NSE came out with a cautionary circular to the investors. Market Regulator Securities and Exchange Board of India has also come out with a release talking about the actions that it has taken. Cyber complaint has also been filed against the entities involved in this entire Dabba trading scam.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term? Buy, sell or hold?
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
जय जवान, जो मैंने शुरू किया था ये एक्चुअली, मैं दोबारा आया हूँ आप लोग से मिलने के लिए। मुझे बड़ी खुशी है आप देख रहे हैं YouTube पे मेरी फिल्म। वाह क्या बात है, क्या बात है। देखिए जय जवान मेरे साथ 15 अगस्त को सिर्फ NDTV पर। जय जवान, जय जवान, जय हिंद, जय हिंद।
They're the force behind some of India's most respected business empires. But you've rarely heard them speak. Now, for the first time, these leaders open up on succession, conflict, governance, and inheritance. Join me as we step inside boardrooms and living rooms of India's most enduring family businesses for real stories, raw conversation, resilient legacies, building legacy.
Good evening, you're watching NDTV Profit and I'm Sanjana. On this Independence Day, as we celebrate 78 years of freedom, the theme is inspiring the future. It's a moment to look beyond where we've come from to where we're going, to ask what kind of India are we building for the next generation? What are the ideas, the technologies and the ambitions that will define our place in the world in 2047 at 100 years of independence? Tonight, we bring together three leaders shaping that future in very different ways. Jaspreet Bindra, founder of AI and Beyond and Tech Whisperer Limited, helping India navigate and lead in the age of artificial intelligence. Srinath Ravichandran, co-founder and CEO of Agnikul Cosmos, taking India to new heights, literally in the space economy. And Ashok Atluri, CMD of Zen Technologies, building cutting-edge defense technologies to keep India secure in an uncertain world. So together, we're going to explore how their work and the sectors that they lead can inspire and define the India of tomorrow. Good evening to all of you and welcome to NDTV Profit. Let's start with the big canvas on the future that you're working towards India in 2047. Jaspreet Bindra, over to you first. How are you seeing AI shaping India's economic and social landscape by 2047? And what must we do now to ensure that it works for every Indian and not just a handful?
It definitely is an exciting time to be alive and an exciting time to be an Indian and alive. The reason for that is I think every generation, there's a technology which comes and shapes our future, our society, our work, and sometimes even our planet. And we are right now at that moment with artificial intelligence, a technology where intelligence will become free, available on tap for everyone. And in our case, 1.4 billion Indians who can draw into that and kind of shape their future and their country's futures. I think we have a great opportunity as we look towards 2047 to use AI to leapfrog towards that goal of a developed India or Viksit Bharat. We have lots of problems. We know that population scale problems, but we have once before used technology at population scale to leapfrog with UPI, Aadhaar, etc. And a similar opportunity exists in front of us to do that all over again. But to do that, to answer the second part of your question, we will need to forge our own path. You know, the US is forging a particular path, which is private sector led, which is very libertarian, which is very, corporate led in a sense. China is forging another path, which is very statist, very application led, very much within Chinese kind of AI models and AI. And we have an opportunity to actually do a rest of the world path, which is a third way in a sense, which combines both the exciting innovations that AI can bring in, but also how it can be used for all and for good and bring in societal good with the right guardrails, the right population scale problems for not only India, but the global South, and forge that third way and take a leadership position as the third country in that troika, leading the path to the future with India, and then followed by the global South. And we have a unique opportunity to do so as a global South leader, and also because the big AI India Impact Summit is going to happen in February 2026 with India as the chair, and that I think is the right platform to do that.
That sounds like an interesting platform and quite an interesting concept as well. So Feb 2026, we'll keep our eyes peeled for that. Srinath Ravichandran, in space technology, how do you imagine India's role evolving over the next 25 years? Because we're looking at satellite launches to deep space missions now.
Yeah, I think the biggest thing that has happened in India in the recent past in space tech is opening up of the sector to the private players, right? I think ISRO has been working with private players forever. I think that's not new. What's really changed is policy coming out that allows for private players to be mission owners. Like right now, an Agnikul's rocket can fly another private satellite from India and put it in orbit, and the Indian government will come in only as a regulator to make sure we're following the safety protocols and we're following all the other norms. So this allows for terrific expansion because suddenly 60 years of ISRO knowledge that we have gained painfully over a very long period of time is now available to actually commercialize. And I think once money starts flowing into this sector on the private side, we're going to see a lot more innovation. And I think once we see a lot more innovation, that is actually how a country's real power and stature in the world is going to be calibrated, right? I think the 3 or 4 fronts in which I think today a country can position itself, like how, a corporate company would probably be in energy, in space tech, in AI, and, a couple of other sectors, right? And I think this has been opened up now. So I think we are in very strong footing. No better time in India to be building a private space venture. No better time to be doing space tech R&D than today. Like literally, I would say this: the government has allowed for a SpaceX to be built in India if that is what people are wanting to and willing to do. Now it is up to us to go and build out these things. So that's where we've gotten today, which is a very bright way to look at what is possible.
Absolutely, reaching for the stars in every possible way. Ashok Atluri, from a national security perspective, what's your vision for a future-ready India that can really defend itself against both traditional and any emerging threat? I think you're on mute, sir.
We need to identify some Pareto technologies in the future, in the sense that we should not try to become a little of everything, but what are those future technologies that will actually help us, win a war? Like, for example, we talk about anti-drone systems, we talk about drones, we talk about space technologies. So these are all the technologies we think, 20% of these Pareto technologies, if you really, really focus on them, and then again, when I say focus, it is not manufacturing. Unfortunately, many of the people in the defense, they say make in India, but actually the make in India component is very, very less. It's about, even if you look at iPhone, it's 1.25% that Apple pays to Foxconn. But everybody talks about make in India as if it's a big deal. No, it is not. Actually, to design and develop should be the primary criteria. If we are able to, not just focus on the old technologies like the tanks and different things, but in the future technologies, the anti-drone systems, the space technology, the quantum safe communication. If we really, really start investing now, doing serious R&D in that, we will emerge absolutely number one in that. 5 years from now, we should be aiming at that. We should not play the catch-up game. We should be there. Because as they say, in war, there are no runners-up. You have to be number one. And that in technology, we should not depend on TOT and start manufacturing here. I see very large companies just going and begging that we want your technology so that we can manufacture. We are not manufacturing coolies. We are smart enough to innovate and invent ourselves. So, that is the mindset change that needs to happen. People say we want India to be the factory of the world. No, we don't want India to be the factory of the world. We want India to be the R&D lab of the world. We want to be a product nation, not a manufacturing nation. Thank you. Yeah.
Okay, I think that's quite an interesting perspective and approach. And honestly, talking to Jaspreet and to Srinath, we're seeing some pretty ambitious visions. But I think turning them into reality means solving some hard problems in the here and now, which I think Ashok sir rightly raised. So as a follow-up to you, Ashok sir, what's the biggest bottleneck that you are facing in building, say, indigenous defense tech? And how can policy or industry collaboration unlock that for you?
I'm a very Pareto guy. Recursively, if I see where does all the problems end up, I think that the time, there are companies like, Zen that have, we have 195 global and Indian patents that we have applied for, 95 granted. But the point is that once we make a product, the ecosystem should absorb it immediately. But even after we make a product, it takes, a few years for us to actually sell a world-class product to our forces. So that is the problem we face, that if people, other players look at us and they say, listen, you developed this product in 2021 and you got the order in 2025, that's a lot of time gap. Nobody wants to invest in R&D. So if they can actually incentivize the bureaucracy and the officers you process the files faster. So, I always say, if there is no penalty to any officer if they delay the file, if they take as much time as they want. But if they sign even one file in which there is a comma or a full stop missing, there is a CVC and a CBI angle. So my proposal is that if you really want to incentivize Indian R&D companies to come, make the procurement faster. And how can you make the procurement faster? By actually calculating the delay for each day of decision that you delay in taking. For example, we have calculated on 100 crore project, every day's delay costs at least 10 lakhs. And this is a component. The national GDP is delayed, the Indian defense is compromised, and the business itself. I can't sustain 2 years or 4 years of salaries and maintaining the overheads, etc. I can't sustain. So what is the day of delay? And we should mark it to the officer or the person responsible. And we say, listen, if you and again, it should be a positive thing. If they have 2 weeks to take a decision and they take it in 3 days, there are 11 days to their credit. But if they take beyond 2 weeks, then that's a minus. That's a nation suffering a loss. So if they can actually calculate this, savings and penalties with respect to early and delayed decisions, I think this speed score, which I like to call, if they can, they should actually, everybody, IAS officer should ask, what's your speed score? So, I think that would be a great day for me, actually. I think that would help Indian industry a lot. Yeah.
I think that's probably a problem that Jaspreet doesn't face in terms of using AI. The speed score is not something that he potentially faces, and he's nodding in agreement. Jaspreet, in AI adoption, what's the biggest mindset shift that India needs among businesses, policymakers, or citizens to truly embrace this transformation? Because I think where we are at the moment, because of the kind of layoffs that we're seeing, we're also seeing there is understandably so, there is a sense of hesitancy, there is some fear that is there, and it's very well to say we need to embrace it and all of that, but you have to face that it also means like there has been a loss to some livelihood. So what would you say is the mindset shift that, we need as a population?
Sanjana, I do actually face the speed test or the speed score thing, but in the opposite way that Ashok is probably referring to. In AI, things are happening so fast.
Too fast, yeah.
If we get on a conversation tomorrow, between today and tomorrow, multiple things would have changed. It's rocket speed, as Srinath would probably agree. But coming to your question, I think, look, the fact is this. The fact is AI is here. It is inevitable. We cannot wish it away. It's something like when the internet came, we had probably the same apprehensions, and we had to go through a similar mind shift. There were apprehensions regarding jobs, there were apprehensions regarding skills, there were apprehensions regarding education, what it will do to our students, there were apprehensions regarding pretty much the way our businesses were run, what would happen to our companies, everything. We took it in our stride. We had some problems, took it in our stride. And actually, if you think about it, the internet and IT has created far more jobs, created far more opportunity, created far more entrepreneurship than potentially what it was supposed to destroy. AI is the same thing. And in my book, the one thing that we need to do in AI, and I work a lot on that, I'm passionate about that, my latest book is about that, is about how we make every Indian citizen AI literate. The definition of literacy will change, Sanjana, from reading, writing, arithmetic, country being 72% literate, 80% literate, to doing all this, but also how you can naturally work with so many AI tools and possibilities out there. Much like we do with search, much like we do with WhatsApp, and now much like we do with UPI and some of the other digital public goods that are there. And the moment people become AI literate, they will stop fearing it. They will start looking at it as an opportunity. In fact, I have a name for it. I call it Jan AI, AI for the Janta. Obviously, it's a riff on Gen AI. Let me give you one example and then close. Ashok was talking about how long it takes and, how the defense forces, for example, take so long to absorb technology. We did a few days back what we call an AI literacy boot camp for the very senior officers of the Indian Army, Navy, Air Force. And for the first time in those 4 hours, they understood what AI could do for them very simply. And once they understand, that mindset change happens. Perhaps it will become easier for entrepreneurs like Ashok and others to actually bring in their technologies because people are now literate in that technology.
Right.
And I think so that's one thing that I would say. As in India, we need 1.4 billion AI literate Indians.
Okay, ambitious targets. Srinath Ravichandran, space remains capital intensive, right? So what financing or regulatory changes would make India more competitive globally?
I think the first thing actually that can be done is to figure out technology that works at a lower cost. That's really the best way in which you can reduce cost, right? And so that's a part of a lot of the R&D that we do. Don't just count on, oh, it's made in India, or rather designed and made in India, so it'll be cheap. That doesn't work in space tech. It's better if you're actually thinking about what are the unit economics, what are the commercials, what should we really solve for, and how to make the cost lower from that. Now, that said, it's still capital intensive even after all that. So in that context, I think 2-3 things can happen. One, I think the government has already announced like a space tech fund, multiple projects coming out where now private players can actually get access to some amount of government money to carry out missions. So we should be doing more of that, and people should be made more aware of that. Second, I think, is from the typical, startup ecosystem standpoint, like venture capital money or private equity money coming in. Probably there is a bit of a lack of a massive success story in this space. And so you're not seeing a $500 million funding round happening for any of the startups today in space tech, because the game also started very recently. But at the same time, I think people are also waiting for those amazing exits that they should get, and then that becomes its own fully established sector. So I think the success story part is something that could also propel things forward. The last bit, I think, is general acceptance at both the government level and at a much more local level, where people actually accept and understand that good space tech can be built here, or good aerospace tech can be built here. There's a lot of, I think, negativity, or at least some bias in thinking that India or Indians cannot design some of the engineering that's required for the most advanced space tech systems, or aerospace systems. And maybe that is driven by some bad stories of the past and so on. But I think we are way beyond that. So there is a little bit of, I think, as a community, we need to get more confident about our engineering capabilities. There is a lot here. Whatever I've seen with Agnikul, I've seen some of the best engineers out here, and I've been outside the country as well, and I work. So I know that what I'm seeing here at a global level is also some of the best people we have here. So yeah, we just need to get to that level of confidence, which will then translate into reliance, self-reliance.
All right. Okay, so if we can break all of these barriers, I think, as we've all discussed, the opportunities ahead are immense, and I think they just go far beyond just business success. So Srinath, let me come back to you. What is your message today to young Indians who dream of joining the space industry? What skills should they start building today?
3 things. One, I think, if you want to be in engineering, get your math and physics basics right. You don't need to be very advanced. You don't need to be a mathematician.
I'm out of this game then.
All you need to know is the basic math and basic physics, and a lot of common sense. The more of common sense you have, the better. Second, I think, is a slightly more softer skill, which is resilience. Anything in deep tech or hard tech doesn't happen quickly. So we should stop solving for instant gratification. Try thinking about long-term bets. We should start thinking about 50-year plans. I know 50-year plans almost looks like infinity for many of us, but without that, no massive big projects can happen in these kind of sectors. And lastly, don't wait. There is literally, this probably maybe the bestest of the best times that we have to do space tech in India privately, right? So I think if you want to do something in space tech, you have to start in the next working day, whatever, next Monday or something. You should go and start your startup.
All right. Okay. No pressure. Ashok, how can India better channel its youth into defense R&D and high-tech manufacturing, not just as jobs, but even missions of national pride?
We at Zen Technologies have a vision that, we want to make India unbeatable in war. So, when we try to hire people, we try to see people with high agency, just not intelligence. I mean, we don't really go after IITs, and God forbid IIT plus IIM is a big no for us. But we do go after people who are actually saying, listen, we want to do something for the country. And then, if you have that vision, that high agency, and, as Trina said about the resilience and the ability to stick through the tough time, this is a fantastic time for people to come into defense. And there are so many opportunities, the cutting edge technologies. And we have started using AI across all the, not only R&D, the generative AI and R&D, but across all operations, everything. Even for tender submission, we are using AI a lot. So, so this is the exact time in which the young people can come, learn these things, and become 100x more, productive than a guy again. Again, I don't believe AI will replace people. It is people with AI skills who will replace people. So this is what I tell the team, that, please learn AI so that we don't get replaced by another company with AI. Yeah.
All right. Okay. Nice. So then coming to AI, let me ask Jaspreet this. How can we inspire more young Indians to see AI not just as a job opportunity, because I think that's the general consensus at the moment in popular culture. I'm sure not at the level where you are involved, but more as a tool to solve India's biggest challenges.
Yeah, so, I absolutely resonate with what you're saying, Sanjana. Sometimes we kind of narrow down or look at the lens of AI only through jobs. Correct. And therefore, at a youth level, we tend to get nervous about it. Therefore, what's going to happen? What's my new job? See, there are a couple of things which I would say here. Number one, that there has been no better time for a young person to be an entrepreneur, whether in space tech, whether in defense tech, or anything else. AI is a massive disruptor. We are looking at the negative side and saying, oh, jobs will get disrupted. Oh, the way society is going to get disrupted, etc. But when I wake up, I see everywhere I see every disruption to be an entrepreneurial opportunity in everything. And so if I was a young person today, I would literally be in a candy store, a kid in a candy store with so many entrepreneurial opportunities. And therefore, the first thing that I would tell a young person is that, look, forget the old model of going into a job, spending 3 years, exactly. Just become an entrepreneur. Let tens of millions of entrepreneurs bloom. And that's the biggest opportunity. And it's entrepreneurs who will build India. It's not going to be large corporates which are going to build the economy. It's going to be entrepreneurs. And so that to me is number one. And number two is taking off from everyone becoming AI literate, which frankly is not difficult to do. We've had literacy targets, we've had population control targets, we've had those targets, and that's really happened. And so the second opportunity really for people who feel for the country, who feel, how they can help uplift the country. This is a very powerful set of new technologies which have come in, which can help you go in and solve some of the big population scale problems, whether it be in education, whether it be in healthcare, whether it be in defense, or whether it be anywhere else. And so I would really look at that as a mission in a sense rather than a job. And so those are the two things I would talk to youth about.
All right. Okay. I think this has been a great discussion, and in a future as unpredictable as ours, the ability to adapt potentially may be our greatest strength, and I think that's something that all of you have done effortlessly. Just some really quick thoughts, and I'm going to get the last answer in from Ashok. In national security, looking forward, how do we balance preparing for conventional threats along with fast rising cyber and drone warfare risks?
I think the threats are completely moving towards the advanced threat. The conventional threats, I think we have enough infrastructure in place to neutralize them, kind of thing. But what we have to see is it's not what happens if a drone goes and attacks a agrochemical plant. What kind of damage it will do. So these unconventional ways, where the airports, the airplanes, everything are now under threat. So how do we smartly keep innovating without disrupting? If something happens, you suddenly say, no more drones to be flown, you will kill innovation completely. So, this is the knee-jerk reactions will happen. So we have to be preemptively trying to solve the threats that, what we have seen, in Operation Sindoor, we saw lot of drones coming, and Zen's anti-drone systems are very effective there. But still, we need to up the game now. We need to have hard kill options. We need to, what is the future? What is how it was again? It was not just a war between India and Pakistan, but it was fully supported by China and Turkey. So this what happened is actually a multi-front war. How are we going to handle that? So those are the capabilities I think very, very fast self-funded private companies can do. But again, if the decision-making cycle is fast, with the speed score being installed in the decision-making process, we will be prepared for the future from the private industry. And so I think that is the fastest way to do it. Self-funded private R&D is the way to go.
All right, and with that, thank you so much to all of you for your time. And my quick takeaways from this: no better time than now to be an entrepreneur in India. Up the game, like Ashok sir rightly said, and of course, keep building on common sense at the same time. Thanks so much for that. The India of 2047 will be shaped not just by policies and budgets, but by visionaries, risk takers, and problem solvers. People who dare to imagine and build what doesn't yet exist. On this Independence Day, inspiring the future isn't just a theme, it's a call to action. From AI to space to defense, the work starts now, and the responsibility belongs to all of us. I'm Sanjana Chauhan and wishing you a very happy Independence Day.
मुझे तोड़ लेना वनमाली, उस पथ पर देना तुम फेंक, मातृभूमि पर शीश चढ़ाने जिस पर जाएं।
वीर अरे क्या बात है भाई, वाह वाह वाह। अगर चीरोगे ये सीना धड़कता देश निकलेगा। मैं वो हनुमान हूँ जो दिल में हिंदुस्तान रखता हूँ।
भूल गए क्या युद्ध भूमि में कीमत बड़ी चुकाई थी।
तुमने तो अपनी ही मर्जी से वतन छोड़ा था।
तब ये वर्दियां खड़ी थी तान करके छातियां।
खून माटी से जा मिला वरना आज सिंदूर ही नहीं होता।
जय जवान जो मैंने शुरू किया था ये एक्चुअली, मैं दोबारा आया हूँ आप लोग से मिलने के लिए। मुझे बड़ी खुशी है आप देख रहे हैं YouTube पे मेरी फिल्म। वाह क्या बात है, क्या बात है। देखिए जय जवान मेरे साथ 15 अगस्त को सिर्फ NDTV पर। जय जवान जय जवान, जय हिंद जय हिंद।
They're the force behind some of India's most respected business empires. But you've rarely heard them speak. Now, for the first time, these leaders open up on succession, conflict, governance, and inheritance. Join me as we step inside boardrooms and living rooms of India's most enduring family businesses for real stories, raw conversation, resilient legacies, building legacy.
हेलो बोलिए मैडम, रबर ट्रेडिंग कब से चल रहा है पता है मैडम आपको? हम और आप तो जन्म भी नहीं हुआ था हमारा।
We investigated a shady advisory firm that has spent big bucks on advertising on the front pages of national dailies.
ये आपको बिल्कुल उसका ऐसे हल्का सा भी खौफ नहीं है।
मैडम एक बात को खौफ किस लिए रखना चाहिए ये तो बताओ, कौन सा गलत काम कर रहा हूँ मैं?
After our report, we also saw NSE came out with a cautionary circular to the investors. Market Regulator Securities and Exchange Board of India has also come out with a release talking about the actions that it has taken. Cyber complaint has also been filed against the entities involved in this entire Dabba trading scam.
Good evening, you're watching NDTV Profit and I'm Sanjana. Welcome to this special conversation on a landmark moment for India's economic journey. Today, on the eve of India's 79th Independence Day, S&P Global Ratings have upgraded India's sovereign credit rating with a stable outlook, the first such upgrade in nearly 2 decades. This milestone underscores India's robust growth, fiscal discipline, and transformative infrastructure push, signaling confidence in its rise as a global economic powerhouse. But joining us to unpack this historic development is none other than Mr. Amitabh Kant, former CEO of Niti Aayog, G20 Sherpa, and a visionary architect of India's policy landscape. Sir, it's an honor to have you here with us to discuss what this upgrade means for India's future and how the nation can seize this moment to soar to new heights. Thanks so much for joining us.
No, my pleasure entirely.
All right, sir. We'll start off from, I think, a question that's on everybody's minds. What specific milestones or policy reforms, are we going to be monitoring for a possible upgrade in India's sovereign rating going forward, and your assessment and reading of all of this?
No, I think the important thing is that the rating agencies have started realizing that India has carried out very vast structural reforms. We were amongst the fragile 5 just about 7-8 years back, and we've moved to be amongst the top 4 economies of the world. This has not been easy, and this has been possible only because we brought in GST, IBC, RERA, lowering of corporate tax. The balance sheet of both the corporates and of the financial institutions have radically improved. We don't have the twin balance sheet problems anymore. But more than anything else, I think the government has done a huge amount of fiscal consolidation post-COVID. And I think the other thing that's happened is that we've become a very formal economy because of digitization. We've also pushed for our infrastructure in a very big way, but in a very fiscally responsible manner, that we've built houses, provided electricity connection, provided water connection, all that we've done for our citizens in a responsible manner. So I think the opportunity now is to carry out more and more reforms in the Indian economy, which would mean, as you asked me about reforms, I would say it means that there should be more simplification of the goods and services tax. There should be, I think, to my mind, there is a need to lower the SLR is almost about 18%. That means banks have to buy 18% of government bonds, which is very high, which needs to be brought down so that the interest rates for private sector can come down. And thirdly, to my mind, there is a need to really drive economic growth by laying a lot of focus on improving our cities, because urbanization will be a very big driver of growth. And fourthly, I personally am a great believer in the quality of spending. We spend, but the quality of spending in terms of better outcomes and better outputs is very critical. It's not just the fiscal spending, but outcome focused monitoring is very important. And the last point I want to make is that we need to remove a lot of red tapeism in our economy by eliminating a lot of processes, procedures, paperwork, and digitizing so that no one needs to come to the government with at a personal level or interact on a physical level, but all interaction must be digital. A lot of these reforms have been carried out by the central government, but we need to push them now to the state government. And we need to make our regulators far more developmental in nature. The regulatory regimes have to become far more proactive and far more developmental.
All right. So, sir, the government has credited the fiscal consolidation for the upgrade. But with declining revenue numbers, how do you think India can sustain both consolidation and high infrastructure spending?
Yeah, so the challenge, to my mind, really is to push consumer spending in a very big way, and that's a valid point. Now, the challenge for India is also to sustain its growth at high levels despite the 50% tariff. My two views on this is that it's not the spending needs to be enhanced for infrastructure. We need not rest happy with a spend of about 4 to 4.5%, but take it to about, to my mind, the infrastructure spend should go up as much as 6%. Secondly, there's a need to push for privatization and asset monetization in a big way so that government revenues increase. Privatization is, we need to push the pedal on privatization. We need to push the pedal on asset monetization in a very big way, not merely at the center, but at the state government level. That's critical. And thirdly, we need to, the allocations have been made by the government for urban infrastructure, 1 lakh crore scheme, which needs to be pushed and implemented. These are 3 or 4 things which will see a lot of spending on ground. So these are 3 or 4 things that are critical to my mind.
All right, sir. So, you know, we've seen the government linking the upgrade also to its vision of Viksit Bharat by 2047. How does the ratings boost influence policy priorities or any upcoming reforms?
So the key is that when your rating improves, your ability to get credit is at a lower interest rates, which means that you are able to provide credit to the consumers and to the private sector at lower rates of interest. It's part of your economy becoming far more efficient. That means you are able to then raise resources in a much larger manner at a lower rate of interest. And that's a recognition of your efficiency of your economy. And that, to my mind, the country's sovereignty will greatly help in our ability to raise resources in a much bigger manner and push for infrastructure creation. Our private credit to GDP ratio is still very low at about just about 50%. If you look at countries like USA, it's 220%. It's China, it's 180%. Korea, it's 200%. So the extent of private credit needs to be enhanced. If India is to grow, it has to grow on credit. No country has grown without credit. So the credit to private sector needs to be enhanced, and we need to push the private sector into taking more credit. That will be possible if they are able to get credit at lower rates of interest, and that is what rating is all about, to my mind.
All right, so I'm going to address the other elephant in the room and in the market, and something that everybody's talking about and it's on everyone's minds is the recent US tariff hike, and of course the impending geopolitical volatility, and because of that. And I think in the past you've called the hike a once-in-a-generation opportunity for reforms. How do you see this upgrade aligning with trade challenges posed by the 50% US tariffs? What does it signal about India's economic resilience? We just spoke with S&P director just a few hours ago, and he's of the opinion that there's not going to be any impact in India's growth because of these tariffs.
Well, he's absolutely bang on that. First of all, I think the nature of tariff, you look at Trumpian tariff, one day it's 25%, next day it's 35% in the case of Canada. In the case of Brazil, it was 25%, raised to 50%. In our case, he's put in, because of Russian oil, it shows the level of hypocrisy that China buys more oil than India does. Turkey buys more oil than India does, and yet you have slapped 25% on India, which is absolutely bizarre to my mind. My view on that is that India should never lose its, strategic autonomy or its energy security because of this policy of Trump. Because 2.5 decades we've pushed for, both bipartisan in the United States of America has pushed for closer relations. Whether it was Democrats or Republicans, they pushed for closer relationship with India. And so has India pushed. It was an evolving process for the benefit of both countries. It has to be done with mutual respect. You can't just slam India down like this. And if you succumb now, you will keep succumbing throughout, and it'll have long-term repercussions in a very big way. So my view on that is very clear, that we need to be, it'll have very little implications, but it is also a huge opportunity for India to carry out very vigorous reforms in its economy. I mean, we need about 10, 12 states to grow at high rates. So we need to push the states. We need many more large companies, but we need to become very easy and simple. And we need to make a simplification in GST and many of our regulatory regimes and push for digitization and carry out massive amount of process reforms. It's also an opportunity to carry out reforms in the judicial system and carry out reforms in the dispute resolution mechanism. You'll never get this opportunity again. This is the opportunity. This is a once-in-a-generation opportunity for you. Trump has given us this opportunity. We should seize it. We should not let it slip.
So let's talk long-term resilience and outlook now, because I think the government's shift towards a capital expenditure now at 3.1% of GDP has been highlighted as a key factor. And as someone who has championed transformative policies, what role do you see infrastructure playing in India's long-term economic resilience? Because that's also something that the S&P was looking at very closely, is the quality spending and, of course, the spending on infrastructure.
I think they should raise it further. 3.1% is not adequate.
Okay.
We should take it up to 4.5%. In the next coming years, we should take it to 6%. My view is, if you want India to grow rapidly on a sustained basis for 8 to 9% per annum, year after year, for 3 decades, we are talking about a 3-decade period. We are talking about taking India from 4 trillion to a $30 trillion economy plus, which means sustained growth of 8.5%, 9%. And that means that your GDP has to grow 9 times, your per capita income has to grow 8 times, your manufacturing has to grow 16 times. All this will not have a benefit without a huge focus on massive thrust on infrastructure, and the quality of infrastructure creation is very, very critical. Secondly, I believe that we need to give a far greater impetus to free enterprise. There's too much of public sector. There's too little of private sector. Disinvestment has happened in India. We need to do much more asset monetization. Too many assets are in the control and too many capital goods are in control of the government. They need to be taken out and put through a transparent process in the hands of private sector so that we can get more efficiency out of them. That is important.
So my last question before we let you go, and thanks so much again for your time. Looking ahead, what message would you like to convey to global investors about India's economic potential, given this upgrade and the stable outlook that has been projected?
So India's had a very clear vision, and it has carried out massive structural reforms. It has digitized its economy. It has created infrastructure, and it has gone for a green economy. It's also pushing for technological leapfrogging through artificial intelligence mission, quantum computing mission, semiconductor mission, and the green hydrogen mission. This demonstrates India's great determination to drive growth in the coming years and take it from being just a $4 trillion economy to a $30+ trillion economy. And I think, to my mind, we need another upgrade very quickly. So the S&Ps of the world need to look at the quality of spending much more closely. And I think they need to upgrade India once more after a short while.
Thank you so much, sir. And that brings us to a close of an incredibly insightful conversation. Mr. Kant, thank you so much for sharing your insights on this rating upgrade and painting a very compelling and interesting picture of the opportunities and, of course, even the challenges ahead. Thanks so much.
Thank you. Thank you.
And earlier we did, in fact, speak with S&P Director Yi Fan Phua on these global ratings. Let's listen to what he had to say. And let me quickly bring in Yifan Phua, Director of S&P Global Ratings, joining us from Singapore. Good evening from India and welcome to NDTV Profit. Thanks so much for joining us. We're looking at the rating and the fiscal outlook. This is a big rating coming in for India. So give us a sense of what specific fiscal milestones or policy reforms is S&P monitoring for this upgrade in India's sovereign rating.
Hi, good evening. Thanks for having me. Yeah, there were a few factors that we were looking at when we decided to act on the positive outlook and upgrade the ratings. The first thing, as we mentioned earlier, was really the government's demonstrated commitment to fiscal consolidation. The second factor that we were looking at was also the fact that nominal GDP growth continues to be very healthy in India, and this healthy GDP growth is actually helping to steady a lot of the credit metrics, especially given the fact that despite the fact there's still there is some fiscal consolidation, deficits are declining, but it's declining at a very slow level. So this fast GDP growth has helped to stabilize the debt level of the government, at the same time also to gradually bring it down. The third factor that we saw was very important was the monetary policy settings and its development, how inflation has been controlled at a much durable rate over in recent years, and that we think speaks forth to the increasing strengthening transmission mechanism from the RBI.
All right, so thank you so much for taking time out to join us. I do want to quickly add on to that question and understand a little bit more. Now, for the longest time, credit rating agencies, including S&P, of course, has held back on a rating upgrade on concerns regarding India's central as well as aggregate debt. So what is your current view on that? We do see some fiscal consolidation and consequently some debt reduction as well. But what are the estimates you are looking at? How reasonable are these? Would you rather see debt consolidation taking place at a faster pace?
Pallavi, thank you for that question. I think you hit the nail right on the head. That's actually, in our statements when we talk about future upside movement is really even faster pace of fiscal consolidation. If you look at India's overall fiscal picture, for us, we look at it from a general government perspective, which is central plus the state governments. Now, as you can see, the central governments, in terms of deficit declining, actually has been quite fast, right? During COVID, it was deficits were as high as 9.6, I recall, at the peak of COVID. And back then, the finance minister was already very clear to say that within 5 years, we'll bring the deficit at the central level to below 4.5. And they've certainly achieved that. On the other hand, the state governments themselves, the deficit has been coming down a lot slower, or perhaps even staying at almost the same level, between 2.8 to 3% of deficit GDP every year. So I believe that going forward, yes, the central government will continue to put in a lot of effort to consolidate its spending, but at the same time, I think the state governments perhaps will have to also chip in to help the overall deficit get smaller as well. But deficits aside, the other thing to really take note of is that sometimes it's not just the deficit that matters, but also the quality of the government spending. And that we see has been improving in the last 10 years. Increasingly, the budget has been tilting more and more towards infrastructure spend. And as a share of budget, subsidy also has been coming down. Now, that's very important because as your infrastructure improves, as your connectivity on the ground improves, that actually allows India to grow at a faster pace than what it is right now. So we are recognizing the fact that this is still an emerging economy where spending has to be done to support the economy, to also build infrastructure. But this all we believe that has a positive impact on India's metrics going forward.
Okay, Yi, I'm going to actually address the elephant in the room, and of course in every newsroom at this point of time, which is the global volatility around the tariffs. And I think in the past you have noted that US tariffs on Indian goods will have limited impact due to India's domestic demand orientation. What sectors or metrics would you monitor for any negative surprises if trade tensions escalate further?
Thank you for that question. I think overall, our view is that India's, as we said earlier, it's not a very export-oriented or export-reliant economy for its growth. A lot of India growth, I believe, around 60% or so drives from domestic consumption, and therefore, we do think that the tariff story will have limited impact on India's growth, right? As we see right now, India's export to the US is about 2% of its GDP. But once you factor in the sectoral exemptions on certain products like pharmaceuticals and also consumer electronics, their exposure is down to about 1%. So that's the reason why we feel that the tariff, even though it could have some impact, but it will be quite manageable. And overall, the long-term growth story for India remains quite healthy.
Okay, I do want to add on to that. While you have explicitly detailed, even in the report and in your comments, that the tariffs are not expected to have any detrimental impact as such on the long-term growth prospects. Back here in India, we do have some concerns regarding the impact the volatility and global uncertainty is having on investments which have already been fairly stagnant despite the government's bid to push up the number, especially in the private sector. That alongside the fact that we have seen demand, especially in urban areas, remain fairly lukewarm. What are you making of these mixed sort of trends domestically, and how concerned would you be regarding those as well?
Yeah, thanks for that question. I think it's very important to have a sense of relativity here and comparison to India and its peers, right? If you look at a growth number of 6.5% for this year, this clearly puts India in terms of growth compared to other emerging economies as a clear outlier. It probably ranks, top few in the world in terms of its actual growth momentum. And I think that's very key for us. Of course, there could be some divergence in the economy, as you put it. Urban sector is perhaps not growing as quickly, but a lot of the growth is rural and so forth. But if you actually look into the detailed numbers of FDI inflows, especially last calendar year, even though net FDI numbers doesn't look so great, but actually net gross inflow actually continues to be very strong. Coming into sectors like services, into financial services, consulting, IT. We see a lot of that still keeps coming in. I think that certainly speaks to the fact that investors still have a lot of confidence in India as an attractive investment destination, especially the fact that you have a very large domestic market, and also the fact that the middle class is getting larger and larger. So all these are factors for investors to look at India and to come in to invest in various industries.
And Yi, our last question before we let you go, and thanks so much once again for your time. What's the one metric you'll be watching most closely for India in the next fiscal year?
Right. Yeah, great question. I think actually we pointed it out in our outlook statement. It will probably be the deficit that we are watching out for, how quick the pace of consolidation is. One thing also we're also watching out for is the pay commission's recommendations to see how what kind of deficit level we're going to be talking about, recommended by the Finance Commission, and also in terms of its recommendations to states and also to central government in terms of the revenue sharing arrangements and things like that. So we'll all be watching out for that as well. But in our outlook statement, I think we put very clearly that future potential upward will continue to rely on. Will be dependent on India being able to keep up its fiscal consolidation efforts, continuing to focus on its infrastructure investments. Also at the same time, having a very conducive monetary policy environment and having inflation being kept under control as well.
Right. Yi Fan Phua, thank you so much for your time and for actually breaking that down for us so comprehensively. We'll continue tracking this and keep coming to you for all of your insight and analysis.
मुझे तोड़ लेना वनमाली, उस पद पर देना तुम फेंक, मातृभूमि पर शीश चढ़ाने जिस पर जाएं
वीर अरे क्या बात है भाई, वाह वाह वाह। अगर चीरोगे ये सीना धड़कता देश निकलेगा, मैं वो हनुमान हूँ जो दिल में हिंदुस्तान रखता हूँ।
भूल गए क्या युद्ध भूमि में कीमत बड़ी चुकाई थी।
तुमने तो अपनी ही मर्जी से वतन छोड़ा था,
तब ये वर्दियां खड़ी थी तान करके छातियां।
खून माटी से जा मिला वरना आज सिंदूर ही नहीं होता।
जय जवान जो मैंने शुरू किया था ये एक्चुअली, मैं दोबारा आया हूँ आप लोग से मिलने के लिए। मुझे बड़ी खुशी है आप देख रहे हैं YouTube पे मेरी फिल्म। वाह क्या बात है, क्या बात है। देखिए जय जवान मेरे साथ 15 अगस्त को सिर्फ NDTV पर। जय जवान जय हिंद जय हिंद।
They're the force behind some of India's most respected business empires. But you've rarely heard them speak. Now, for the first time, these leaders open up on succession, conflict, governance, and inheritance. Join me as we step inside boardrooms and living rooms of India's most enduring family businesses for real stories, raw conversations.
Born in 1946 from the milk pails of Gujarat's villages, Amul began as a dairy cooperative empowering millions of farmers. It went on to spark India's white revolution and became the nation's top food brand, with its butter alone holding 85% of the market. Today, with a turnover of 90,000 crore, Amul is expanding across the globe. From New York to Spain, its cheese, ice cream and fresh milk are winning hearts, boosting exports and taking on global dairy giants. Amul, proudly Indian, making the world a little more butterly delicious.
S&P Global upgrades India's rating from BBB- to BBB with stable outlook. India gets an upgrade for the first time since 2017. Commerce Secretary Sunil Bhartwal says India's exports grew substantially in July despite uncertain global policy environment, adds that the proposed export promotion mission is currently under inter-ministerial consultation. Benchmarks end the week 1% higher as Nifty snaps its 6-week losing streak. All sectoral indices barring FMCG close with gains. Broader markets underperform marginally. Tax authorities issue inquiry notices to individuals over foreign accounts seeking details of how and where these accounts are disclosed. Notices mainly sent to Indians with accounts in UK and European countries. Supreme Court hears petitions challenging the order on removal of stray dogs from residential neighborhoods, raps Delhi government for not implementing animal control guidelines. Over 35 people are dead and 100 injured after a massive cloudburst in Jammu and Kashmir's Kishtwar region. 120 people have been rescued. Death toll is expected to rise as more people are believed to be trapped. Hello and welcome. A very good evening. This is Profit 360 on NDTV Profit and I'm your host Malika Mishra. Along the next half an hour, we will be bringing you the latest on markets as well as national and international news. Big news coming in. S&P Global has upgraded India's long-term sovereign credit rating to BBB from BBB-. The agency cited economic resilience and sustained fiscal consolidation as reasons for the upgrade. S&P Global had revised outlook on India's rating in May last year to positive from stable. My colleague Pallavi Nahata is standing by with more on what this rating upgrade means for India and the rationale behind it.
Right now, Malika, as you said, in the big news of the day, S&P Global has raised India's sovereign rating to BBB from the previous BBB-. Let's remember that BBB- is in fact the lowest investment grade rating. Now, what this essentially means could be lower borrowing costs for the Indian government, also lower borrowing costs for corporates from India that are borrowing from abroad. We in fact already saw a little bit of a reaction on the India 10-year benchmark bond yield, which did ease by 7 basis points at its close today. Let's have a quick overview of what S&P did say in its release when it changed the rating. Now, it did emphasize that India has continued to prioritize fiscal consolidation and the government has demonstrated continued political commitment to delivering sustainable public finances. S&P also did make note of the improvement we have seen in the quality of spending as well, while the government continues to maintain its thrust on capex. Now, robust economic expansion is also having a constructive effect on India's credit metrics, the global ratings agency said, and it said that it expects India's economic fundamentals to continue to underpin the growth momentum over the next 2 to 3 years. S&P does estimate GDP growth for the ongoing fiscal year at about 6.5%. It has also added that it does not expect the impact of the tariffs imposed by the US on India to be substantial. It does not also expect the impact of the tariffs to be long-term in nature. Now, in terms of outlook, S&P has said that continued political stability and high infrastructural investment continue to support India's long-term growth prospects. Added to that, a cautious fiscal as well as monetary policy is expected to help regulate the government's elevated debt and interest burden, and that's what is going to be watching out for as well. In fact, we spoke to the team at S&P regarding what could possibly help improve India's rating further, and what they said to us as well was also the fact that fiscal consolidation is what they're going to be watching out for, and a faster pace of fiscal consolidation is what is most likely to get India a further upgrade.
Right, Pallavi, thank you so much for bringing us those details on India's big rating upgrade. And Chief Economic Advisor V. Anantha Nageswaran has commented on S&P boosting India's credit rating, stating he is pleased with the development. He also said that India's macroeconomic fundamentals had warranted this rating upgrade and that the country has been steadfast in its promise and delivered on it. Let's listen in.
I think obviously we are very pleased with the development. We felt that India's fiscal macro fundamentals warranted this ratings upgrade. We have been, as you know, we have a formal conversation with them every year, twice a year, etc. And we have been highlighting the fact that while we know that interest payments are as a percentage of revenue, tax revenues on the high side, etc., we borrow in domestic currency and we have a very stellar track record. And the fiscal prudence exemplified by the fact that the government committed to from 9.2%, we would bring it down by more than 50% to 4.5% or less, and we delivered on it. And that should be recognized. And I think while the track record of several other countries on the fiscal front has been mixed, India has actually steadfastly stuck to its promise and delivered on it, and that should be recognized. That is what we have been saying, and we are very appreciative of the fact that Standard & Poor chose to acknowledge the commitment to fiscal prudence, fiscal stability, and given us the recognition of that.
Earlier today, we spoke with Yifan Phua, director at S&P Global Ratings, to get his views on India's BBB credit rating. He believes the impact of tariffs on India's economic growth is likely to be limited. Let's listen into this as well.
I think overall our view is that India's, as we said earlier, it's not a very export-oriented or export-reliant economy for its growth. A lot of India growth, I believe, around 60% or so derives from domestic consumption, and therefore, we do think that the tariff story will have limited impact on India's growth, right? As we see right now, India's export to the US is about 2% of its GDP. But once you factor in the sectoral exemptions on certain products like pharmaceuticals and also consumer electronics, their exposure is down to about 1%. So that's the reason why we feel that the tariff, even though it could have some impact, but it will be quite manageable. And overall, the long-term growth story for India remains quite healthy.
And responsible fiscal consolidation post-COVID, rapid digitization and the needed infrastructural push has worked well for India, says former G20 Sherpa Amitabh Kant. While speaking about the reasons behind India's rating upgrade, he added that the balance sheet of financial institutions have also radically improved. Let's listen in to a part of this exclusive conversation with him.
The rating agencies have started realizing that India has carried out very vast structural reforms. We were amongst the fragile five just about 7-8 years back, and we've moved to be amongst the top 4 economies of the world. This has not been easy, and this has been possible only because we brought in GST, IBC, RERA, lowering of corporate tax. The balance sheet of both the corporates and of the financial institutions have radically improved. We don't have the twin balance sheet problems anymore. But more than anything else, I think the government has done a huge amount of fiscal consolidation post-COVID. And I think the other thing that's happened is that we've become a very formal economy because of digitization. We've also pushed for our infrastructure in a very big way, but in a very fiscally responsible manner, that we've built houses, provided electricity connection, provided water connection, all that we've done for our citizens in a responsible manner.
And Dinesh Khara, former chairman of the State Bank of India, highlights the importance of fiscal prudence alongside a supportive monetary policy. He notes that India's inflation trajectory is favorable, paving the way for a focused infrastructure push while ensuring sustainable economic growth.
I think fiscal prudence was given enough importance, and at the same time, even the monetary policy is also very supportive, and it is actually getting reflected into the kind of inflation print which we get to see. So I think inflation numbers also giving the indication about the inflation expectation, that being low, focus on the infrastructure, fiscal prudence. These are all very welcome areas when it comes to ensuring the sustainable growth of the economy. And I think once the international rating agencies could develop that kind of a confidence, they have upgraded.
And moving on, July trade deficit widens to $27.35 billion and exports are up 7%. That's the word coming in from the Commerce Secretary routine briefing on trade data. Commerce Secretary Sunil Parthwal also said that negotiations with the US for the bilateral trade agreement are ongoing. He also said that trade between India and China have improved. My colleague Grishab Bhatnagar was at the briefing and he joins us with more details on this.
Right, important set of commentary coming in from sources on India's export scenario as well as trade data. What we're seeing firstly is the fact that despite the uncertain global policy environment, we've seen that India's exports have continued to grow, both in July and the April to July quarter. This is also much higher than other countries and what the global export growth rate has been. Interestingly, what we also heard from official sources was the fact that trade between US and India, as well as China and India, has grown over the past month as well as the past quarter. So that is a positive that is being seen. Very importantly, India is fully engaged with the US on trade talks so far. That is what we're picking up from official sources. The BTA talks, the bilateral trade agreement talks, are still on. What we don't know so far, and we'll only know closer to the date, is the status of the August 25th negotiations round. Remember, US negotiators were set to visit New Delhi for the 6th round of in-person negotiations. So that status of whether that round is on or not, that's not clear yet. We'll only know closer to the date. Perhaps around the 20th August mark is when we'll know. But the fall deadline for the BTA continues to be in place. On China trade, what we've seen is that trade with China is moving positively. Imports and exports both have gone up over the past month and quarter. So trade developments are moving forward positively, given the fact that business visas have also issued, apart from tourist visas, from China to Indian citizens and companies. What we're also seeing is that these additional 25% tariffs that came in from the US, those were because of geopolitical reasons, and we'll have more clarity because those 25% have not been implemented yet. They come into effect starting August 27th. So a lot of geopolitical events coming in, and also the most important being the Trump-Putin meeting that is set for in the next 48 hours or so. So that is something that is also being tracked in India. What is also being tracked is the front-loading bit, whether or not there's some sort of front-loading of orders being seen by exporters. That is something that Commerce Ministry sources are telling us that they are tracking. And also a very important one on rupee trade with Russia. There will be a high-level delegation that will comprise of Commerce Ministry officials as well as External Affairs Ministry officials that will be traveling to Russia very soon to engage more and further on India's rupee trade. So that's what we're picking up on the trade front.
Right. Thank you so much for giving us all those trade-related updates, Rishabh. Now, time for an NDTV Profit exclusive. Indian tax authorities are intensifying scrutiny on offshore holdings with widespread inquiry notices sent to individuals holding foreign accounts, mainly in the United Kingdom and Europe. My colleague Shrimi now joins in with more details on this.
Well, that's right. Very crucial information coming in. What we are picking up, that Income Tax Department has started sending inquiry notices to several individuals across India on its, over its foreign holdings, foreign accounts. And in fact, sources tells us that inquiry notices being sent under Section 131, seeking explanation on how and where you disclose these accounts. Now, the action follows the huge number of data which Indian authorities recently received under common, reporting standards via automatic exchange of information India has with the foreign jurisdiction. And what we are also, understanding from the sources that so far about 2.5 lakh of account and the information of those have been received so far, and majority of them is now picked up by the Income Tax Department, and all of them are actually under scrutiny. Now, sources also indicating that the matter is currently at the inquiry stage because they want to first know and awaiting the reply from all these individuals, and also kind of try to send signal that, look, if you have not disclosed your foreign accounts, this is the time you can do it, instead of going for a full-blown investigation. And they are expecting individual to come forward. Otherwise, if they later establish that these accounts were not disclosed, then they clearly will face action against under Black Money Act, which is a very rigorous act, attracting jail term up to 3 years plus up to 100% of penalty on the undisclosed amount. The other important aspect here also emerging, that how Indian authorities are using all those data coming through the global cooperation, because at one point of time it was very challenging for them to kind of trace all those money stashed abroad. So now with real-time data, they have solid proof to go after all these individuals who are have money illicit money stashed abroad, and clearly they have all the data and documents to back that.
Right, and as we wrap on this edition of Profit 360, our 79th Independence Day isn't just about commemorating freedom. It's about reflecting on the daring reforms, bold bets, and visionary leaders that helped shape India what it is today. We're stronger, bolder, and brighter. We're not just implementing transformative changes by the day, but making an indelible mark on the world stage. Here's a special report, a countdown rather, to the top milestones, policies, and mavericks that turned India into a global giant. Take a look.
In 1947, India broke free, not just politically, but economically. From a 30 billion fledgling to a 4 trillion powerhouse, the journey has been anything but ordinary and wasn't built in a day. It was carved out by daring reforms, bold bets, and people who refused to think small. This is the ultimate countdown of the policies, milestones, and mavericks that turn the dream of a global India into reality. Number 5, 1951, the first 5-year plan. Our first blueprint for growth placed its bets on agriculture and dams. In just 9 years, GDP jumped from $30 billion to $42 billion. Over 2,000 community projects taught villagers to run their own local economies. An idea so ahead of its time, the world later copied it. But as fields flourished, one question remained. Could India feed itself in the face of a growing population and frequent droughts? Number 4, 1965, the Green Revolution. Enter MS Swaminathan. His high-yield seeds and modern farming turned Punjab and Haryana into India's breadbasket, boosting grain output by 70% in just 5 years. Quietly powering this change were women farmers. Food security was one thing, but to truly grow, India needed fuel. Not the kind you burn, but the kind that you bank. Enter number 3, 1969, bank nationalization. When 14 banks went public, credit finally flowed to rural India. Branches quadrupled in a decade, funding the first rural cooperatives, today responsible for 1/5 of agricultural lending. Yet for all this progress, there was still a ceiling, the infamous license Raj that kept entrepreneurs chained. That is, until the 1990s. Number 2, 1991, LPG reforms. Liberalization, privatization, and globalization ripped away red tape. FDI shot from $132 million to $5.6 billion in just 4 years. And in a twist few expected, these reforms also ignited India's first private TV channels, unleashing a media boom. With markets opening and businesses booming, India was ready for its most radical tax shakeup in history. Number 1, 2017, GST, a single unified tax system in the form of GST in 2017. By digitizing compliance, GST slashed paperwork time by 40%, setting a global benchmark. In 2024 alone, it brought in 1.7 lakh crore. Now, policies can open doors, but it's what walks through them that changes a nation's destiny. The reforms laid the track. Now let's see the trains that roared ahead. From institutes that redefine learning to revolutions that fit in your pocket, these are the milestones that turned India's potential into performance. Coming in at number 5, 1951, IIT Kharagpur, the first IIT that trained over 1 million engineers, powering India's tech rise. And while they were building computers, another dream was taking shape, putting India on wheels. That's right, number 4, in 1983, the good old Maruti Suzuki launch. The Maruti 800 made cars affordable, selling 2.9 million units by 2014. India's first wind tunnel, built just to test it. But it was the 1990s where India found a new export, not a car, but brain power. Number 3, 1990s, the IT boom. By 2022, IT was 8% of GDP, employing 5 million people. India's Y2K fixes alone earned $2 billion and cemented its place as the world's tech help desk. So with tech thriving, policymakers wanted to supercharge exports, and so entire cities of opportunities were born. Coming in at number 2, 2005, the Special Economic Zones. The Special Economic Zones Act transformed exports from 22,840 crore to 7.59 lakh crore in 16 years, pulling in $100 billion in FDI and creating 2 million jobs, half for women. But India's biggest transformation wasn't in factories or farms. It happened in the palm of your hand. Number 1, 2016, UPI and digital payments. 131 billion transactions by 2024. A $400 billion digital economy. And an open source model so good, over 10 countries adopted it. Every milestone has a signature, and behind every signature is a leader with a vision. These are the people who didn't just ride the wave
with zeal and enthusiasm. These are the days that specially remind us of our being proud Indians. The 15th of August is a date etched in our collective memory during the long years of colonial rule. Generations of Indians dreamt of the day of independence. Men and women, old and young, from all parts of the country yearned to throw away the yoke of foreign rule. Their struggle was marked by robust optimism, which has continued to propel our progress since independence too. As we salute the tricolor tomorrow, we will also be paying homage to the memory of all freedom fighters whose sacrifices on India independence on the 15th of August 78 years ago. After regaining our freedom, we also became a democracy with universal adult franchise. In other words, we the people of India put the power to shape our destiny in the hands of each of us without any restrictions of gender, religion, and other factors that had barred many people from voting in other democracies. In spite of many challenges, the people of India made a successful transition to democracy. The transition was a natural reflection of our ancient democratic ethos. India had the oldest republics in the world. It is rightly acknowledged as the mother of democracy. When we adopted the Constitution, it provided the edifice of democracy. We built democratic institutions that strengthened the practice of democracy. We prize our Constitution and our democracy above everything else. As we look back on the past, we must not forget the pain inflicted by the partition of the country. Today, we observe Evasion Vibhishika Smriti Divas. Terrible violence was witnessed and millions were forced to relocate due to partition. Today, we pay tributes to the victims of the follies of history. Dear fellow citizens, our Constitution contains 4 values as the 4 pillars upholding our democracy. They are justice, liberty, equality, and fraternity. These are our civilizational principles that we rediscovered during the freedom struggle. At the heart of them all, I believe, is the notion of human dignity. Every human being is equal and everyone deserves to be treated with dignity. Everyone should have equal access to health care and education. Everyone should have equal opportunity. Those who had been traditionally at a disadvantage needed to be given a helping hand. Keeping these principles foremost in mind, we started a new journey in 1947. After the long years of foreign rule, India was in utter poverty at the time of independence. But in the 78 years since then, we have made extraordinary progress in all fields. India is well on the way to becoming a self-reliant nation and is moving ahead with great confidence. In the economic field, our achievements are all the more noticeable. With a GDP growth rate of 6.5% in the last fiscal, India is the fastest growing among the major economies in the world. Even amid stress in the global economy, demand at home is pacing ahead. Inflation has remained under control. Exports are rising. All key indicators show the economy in the peak of health. This is as much due to carefully calibrated reforms and sagacious economic management as due to the hard work and dedication of our workers and farmers. A large number of people have been pulled out of poverty through good governance. The government has been running a series of welfare initiatives for the poor and also for those who have risen above the poverty line but are still vulnerable, so that they do not fall below it again. This is reflected in the rising expenditure on social services. Income inequality is reducing. Regional disparities are also disappearing. The states and regions earlier known for weaker economic performance are now showing their true potential and catching up with the front runners. Our business leaders, small and medium industries and traders have always exhibited a can-do spirit. What was needed was removing the bottleneck in the path of wealth creation. That is so visible when it comes to infrastructure development over the past decade. We have expanded and strengthened the national highway network under the Bharatmala Pariyojana. The railways too have innovated, introducing new types of trains and coaches equipped with latest technologies. The inauguration of the rail link in Kashmir Valley is a major accomplishment. Rail connectivity with the valley will boost trade and tourism in the region and open new economic possibilities. This engineering marvel at Kashmir is a historic milestone for our country. The country is rapidly urbanizing, hence the government has been paying special attention to improve the conditions of the cities. Addressing the key area of urban transport, the government has expanded metro rail facilities. The number of cities with a metro rail service has gone up multifold in a decade. The Atal Mission for Rejuvenation and Urban Transformation, or AMRUT, has ensured more and more households have access to a tap with the assured supply of water and a storage connection. The government considers the basic amenities of life as rightful claims of the citizens. The Jal Jeevan Mission is making progress in providing tap water supply to rural households. In the healthcare sector, we have been witnessing a paradigm shift with a variety of initiatives under Ayushman Bharat, the largest healthcare scheme of its kind in the world. This scheme has already provided cover to more than 55 crore people. The government extended this benefit to all senior citizens of the age of 70 years and above, regardless of their income. As inequalities in access are removed, the poor and the lower middle class also benefit from the best possible healthcare facilities. In this digital age, it is apt that one sector in India that has seen the most dramatic advances is information technology. Nearly all villages have 4G mobile connectivity, and the remaining few thousands will be covered soon. This has made possible large-scale adoption of digital payment technologies, in which India has become a world leader in a short span. It has also supported direct benefit transfer, which ensures that welfare benefits reach the intended beneficiaries without glitch and leakage. More than half of the total number of digital transactions in the world take place in India. These developments have created a vibrant digital economy whose contribution to the country's GDP is increasing year on year. Artificial intelligence is the next stage of technological advancement and has already entered our lives. The government has launched the India AI mission to strengthen the country's AI capabilities. It is also helping to build AI models that answer to India's specific requirements. As we aspire to become a global AI hub by 2047, our focus will remain on making the best use of advances in technology for the common people to improve their lives by improving governance. For betterment of the lives of the common people, there is equal emphasis on improving the ease of doing business as well as on improving the ease of living. Development serves the purpose only when it helps those on the margins and opens new opportunities for them. Moreover, we are increasing our self-reliance on every area possible. This has added to our self-confidence and increased the momentum of our journey towards becoming Viksit Bharat. Last week, on August 7, the country celebrated National Handloom Day, which honors our weavers and their products. Since the year 2015, we have been celebrating this day to commemorate the Swadeshi movement, launched during our freedom struggle in the year 1905. The spirit of Swadeshi was strengthened by Mahatma Gandhi to promote the products made by the sweat and toil of Indian artisans and craftspersons and by their incomparable skills. The idea of Swadeshi has been inspiring our national endeavors like Make in India initiative and Atmanirbhar Bharat Abhiyan. Let us resolve to buy and use Indian products. Dear fellow citizens, the all-round economic growth complemented by social sector initiatives has placed India well on the path of becoming a developed economy by 2047. With the nation marching ahead during the Amrit Kal, I see all of us contributing to the best of our ability. I believe there are three sections of society that will lead us on this path: youth, women, and the communities that had for long remained on the margins. Our youth have finally found the right environment for the realization of their dreams. The national education policy has brought in far-reaching changes, aligning learning with values and skills with tradition. Employment opportunities are booming. For those with entrepreneurial aspirations, the government has created the most conducive ecosystem.